personalities of investors. So there is celebrity, there is adventurer, there is a straight arrow. Those kind of personalities I have tried to capture in this article. These are citations. So we have been cited by leading business newspapers and magazines for different market cycles, etc. What are our views? They have been covered. For client engagement, we have been working on podcast. So sorry about this slide. There is some. So we have been doing podcasts on different topics like migration, investment, etc. Then these are the different events. One is we talk about spirituality in corporates by Nivesh, who is with this one. Then we had discussions with fund managers and offices in ambition of our office. And also we had one very interesting lecture by Swami Vigyananand, who is a Hindu economic forum, where he talked about economic history of India. When he talked about what was GDP contribution of India to world before Google era, during Google era, during British era, to post-British era. Three values stress simplicity, growth, IGP, all this and that. Now, we'll take you through India's story. I think most of us are convinced that India's story is very strong, but we'll present some numbers to validate the same. So do we have somebody in the house who feels that India's story is weak or India is going down? Because we will be using some numbers on those parameters on which India is going down. And before I start this, thank you Ria for making this presentation on Nivesh. So I am doing only the cosmetic part of presenting the presentation, all the work has been done by our team, very proud about that. So I'll appreciate if you can have a So first I'll cover those parameters on which India is going down. Unfortunately, when it comes to analyzing our economic prosperity, economic growth, or lack of it, we become very polarized. We are either pro India or we are like that everything is going down. So I'll try to cover both parts. So first I'll cover those parameters of which India is going down. So this is one parameter, and I think no other parameter covers the great Indian story as good as this one parameter covers. Our rank in global GDP is going down. We were 13 in GDP ranking globally in the year 1990. So we had our liberalization after that. So we always, put liberalization as a very good, event to be celebrated. But ideally, we should be looking and introspecting why it happened so late. Why did we have inspectors? Why did we have licenses? But anyhow, better late than never. So post that from 13 we moved to 10 in 2012. So it took us 22 years to jump 3 ranks. And in the next 12 years we jump from 10 to 5. So I'm very emotional about our country. I will appreciate if we can, celebrate this occasion as a very good grand occasion for us as a countryman. We can clap for this occasion. Right now we are in the and in next 5 years we will be top 3. So America, China and India, certainly the difference between India and China and America is very huge. And it will be another jump that we will make. But still, Indian talking globally, it is, says 100 years of being independent is a big achievement and we all should be proud of it. There is no cause which is as big as poverty. So if you don't have money, you can't do even your religious work properly. And a large part of our population had been suffering from this curse for a long time. Thankfully, now we are going down on this parameter as well. But more than looking at poverty from one dimension of income only, let's look at poverty from multi-dimensional parameters like access to wealth, education, etc. Over there also we have been rapid distress. So while about 55% people are suffering from multi-dimensional poverty, we have come down to around 12% in 22-23. Again, big achievement. So these are the parameters which India is going down. Unemployment, as the world began. So we have not taken Indian data because then again people become very polarized on the same. As the world began, This is how Indian unemployment
is going down. Certainly, we had a spike in 2020 because of Corona, but since then our unemployment rates are coming down drastically. More than half of our population was illiterate 35 years back. More than half of our population.
And you can't expect any growth
until your population is educated. From that level, our illiteracy rate is down to 23%. And so even this 23% is mostly those 52% people who were illiterate in 91. So right now we have got almost 100% school enrollment, almost universal school enrollment. So even the absolute number of illiterate people, not only percentage, absolute number of illiterate people is going down year on year. Fiscal deficit. So there have been 2 times recently when Indian government raised fiscal deficit beyond good number, beyond the manageable numbers. One was in 2008, and other was very recent 2020 with the Corona crisis. But since then, our fiscal deficit is coming down drastically on a regular basis. Again, a big achievement. So right now it's 5.6%, and government projection is it will come down to 4.4% by financial year 26 within next 2 years. Dependency ratio. So when it comes to workforce, how many people are working and how many people are dependent on working people, that ratio will be 30% only in 2050. So it always keeps personal population growth, but sometimes it has got positive side also if we have more young population. And
I always
believe that all the world capital move towards those countries which have got younger population to work for. And even if that country is not working towards that direction, that capital will force them to work towards that direction. There was one time when our ease of doing business come down from 151 to 144, and it was a huge achievement. There was a lot of hype that we have achieved such improvement, but now it's down to 63 as per the last ranking which came in 2020. So from almost 150, we are down to 63 in ease of doing business,
even by UN.
Now let's look at those parameters where India is going up. And again, there is there is one saying low base effect. So certainly we have got a long journey to undertake, but we certainly is on the path to that journey. And as Indians, we should be proud if we are in rapid distance. I know certainly people start making comparisons with China, with Southeast Asia, but there are many achievements on which we can feel proud. GDP in billion consistently going down, except for minor jobs like Corona, etc. This is a very interesting slide. So, there was a report by American professor, I just including that report over here. Before Mughal era, India's contribution to world GDP was around 27-28%. By the time Mughal era ended, it was down to 14-15%. By the time British era ended, it was down to 5-6%. The worst part was that even after 1947, our contribution to world GDP was going down. Even when we had so-called independence, even when we were ruling ourselves, we were not growing as fast as the world was growing. So that's why our contribution to world GDP in 1960, like 60 years back, only was 3%. And now we are inching towards that number post 1990. From 1960 to 1990, it was going down only. GDP per capita by 2031, in next 5 years, we will be in middle income economy.
If we take today's
definition of middle income economy, and the good thing is we have jumped 2-3 stages of income levels as per IMF within last 20 years. This is another very steep curve which shows you how our GDP per capita. So as a country, so my mother used to tell me when I was a kid, India is a rich country, but its people are poor. But now in us, this has become richer. So our GDP per capita is growing rapidly since 2005. This is exports. I'll show you some more numbers in coming slides when we talk about PLI and Make in India. But again, our exports are also going up. Certainly, we would like them to be even faster, the pace to be faster. But again, consistent growth. India's export as a percentage of global export. So हम तो बड़े हैं, but are we growing at the pace at which world is growing?
Our contribution to global trade has increased from 1.5% to 3% within last 20 years. Life expectancy. So our life expectancy was only 38, now it's 71. When it comes to internet now, for us it may be luxury, but for a lot of our bottom of the pyramid people, it's requirement. So for a Ola driver, for a Uber driver, when he has access to cheap internet, he can be part of the new age economy. Otherwise, he will remain limited to Kali Pili taxis. So that access to cheap internet is not only helping to grow new ideas, new startups, it's also helping a lot of our bottom of the pyramid or middle of the pyramid to have access to information and to new economy. One of the biggest entry barriers for anybody, I come from a very small town in UP, so I can vouch for it, and many of us come from very, such kind of backgrounds. One of the biggest entry barriers that we used to have in India was information arbitrage. With the advent of internet and access to internet at a very cheap price, that arbitrage, that entry barrier is coming down. Now this is something which we should be very proud about. So I'll show you in further slides how FIIs are taking out money consistently, but even those times our market was either going up or it was not going down as much as it used to. All because of this very strong SIP book. So Nirmala Sitharaman made a statement in the parliament where he mentioned the contribution of SIP warriors in fighting the outflow of FII's money. These are some of the numbers which shows that in last 4-5 years how FII money has moved in or out and how that has been countered by local money and what kind of effect it had on market returns. So if you look into 2022, there was almost 3 lakh crore worth of money taken out by FIIs from Indian markets. But to almost similar amount of money was put in by DIIs, domestic institutional investors. Who comes in DIIs? A very proud part of our economy, AMCs, mutual fund industry. EPFO, so all the money that goes into employee provident fund, 5% of that incremental money is being moved to markets. NPS, a lot of NPS money is also going into the market. So these 3 pillars, SIP, NPS and EPFO is what countering FII outflow. So if you look at this chart, this shows us month on month inflow and outflow of FII money and DII money. We can see virtually all the money that has been taken away by FIIs has been replaced by DII money. Now I'll show you some of the government interventions of last decade which has helped us to grow, which has helped us to fight corona crisis, which has helped us to grow at this pace. I'll be covering 5-6 interventions. One is GST, Startup India, NCLT, UPI, Make in India and PLI scheme. So in 2018, almost 12% of Indian assets, banking assets were part of NPA. So what happens when we have huge NPA? NPA means that banks can't lend money more. There will be lesser money in the market. And all of this was possible. All of this happened not because we were passing through some economic crisis or anything. It happened because of crony capitalism. Because earlier a lot of money was distributed to a lot of business ideas which eventually became part of NCLT process. From 12%, that number is down to 2.7% in March 24. And when I'll show you the kind of companies that went into NCLTs, they were the companies who used to rule the Indian industry, who were the leading players. The power of NCLT was so strong that most of them got auctioned under NCLT. When NCLT was introduced, top 20 defaulters of India were made a part of the list, and all of them went through a time-bound process which helped us to bring this gross NPA number down. Before NCLT, the recovery mechanism was SARFAESI, and the recovery rate in SARFAESI was around 14% in addition to evergreening. So evergreening is the process where a further loan is given to pay interest on your old loans. So this practice was very prevalent by Indian PSU banks, where they will give you new loan so that you can pay back interest on previous loan. In spite of that practice, only 14% was the recovery rate under SARFAESI. That is now around 40% under NCLT. Recently, its number has come down, but in initial years, it was giving recovery rate of 45-50%. That too in a very time-bound manner, in a very transparent manner. These are some of the companies which became part of NCLT initially. We have covered name of the companies, total debt, then resolution amount and haircut and the acquirer. I won't take you through this in detail. We can will anyhow be distributing hard copy of this presentation to all of you. Startups. I count there has been 4 phases of Indian industry. One was Tata Birla Goenka stage, where after independence some groups became very big in manufacturing. They controlled almost all the manufacturing of India. Because during license stars they had access to government and they could get their work done. Nobody was able to challenge those houses because it included not only huge requirement of capital, but it also required a lot of access to government and bureaucracy. Second phase was nationalization of banks. The third was Indian emergence of Indian IT industry in 90s and early 2000s. And now we are witnessing the fourth phase of Indian industry rise, which is startups. So they are breaking all the glass ceilings. So you can see kids in early 20s and 30s. I hope I can afford calling them kids because I am in late 30s now. So people wearing knickers will be millionaires, will be owners of companies whose values are $1 billion. $1 billion valuation is something which introduce it to top 500 in listed space also. So number of recognized startups, of which Nivesh is also one of the recognized startups as per Government of India, is 128,000 in 2024. So it has grown by more than 15 times in last 6 years. Number of unicorns. Unicorns is companies with valuation of $1 billion is 120 now. And almost all of these companies are promoted by first generation entrepreneurs. Just think of it how we are breaking entry barriers. People come from small towns, from big cities, from every kind of social background. They come to institutes. Some of them doesn't even come to premium institutes. Then they build their businesses and they become owners of billion-dollar valuation companies. Just think of the kind of radical shift, tectonic shift that we are witnessing right now. This is another very interesting scheme, PLI scheme, Production Linked Incentive Scheme. So what government did, government brought 2-3 steps. One was import substitution, which is very typical, where they increase import duties on certain components. Then they introduced PLI, where they gave certain subsidies provided to achieve some given targets of manufacturing and billing as well. So these are some of the outlays which are expected in, which have been committed by government in many sectors. Government tells so what government does, they try to give a kind of a stimulus to industry, but only if they achieve certain targets. When they roll out PLI scheme, they tell you if you achieve these many numbers, then we will give you this much subsidy, post achievement of those targets. So it's nothing like subsidy is giving at the advent itself, it is performance linked. So corporates में one of the biggest headache is performance linked incentive. They are implementing in corporates in production as well. It has resulted into huge amount of export in electronics. It has resulted into employment generation. This is something that shows the performance of Indian manufacturing, Make in India and PLI in a very strong manner. So right now we are exporting around $15 billion worth of mobile phones. So from being net exporters of mobile phones, we are now net exporters by a huge number. Mobile phone production in India is 4100 billion. So I am not going very far, but even if we go into 2017, in 2017 we were net importer of mobile phones, and now in 2027 we will be exporting mobile phones of $76 billion. $76 billion will be around 2% of Indian GDP. These are the production forecasts for different industries, which again will be around 3% of total Indian GDP. This is India's electronic exports. In 2022, we exported $25 billion worth of electronics. $25 billion. The most shining example of technology manufacturing in mass segment is iPhone. And one of the most inspiring personalities of modern century has been Steve Jobs. And Steve Jobs once claimed that I can't move out my production assembly from China because there are so many interlinkages. India has been able to move out iPhone manufacturing out of China. So we have proven Steve Jobs wrong. Our contribution to global shipments of iPhone is 10% now, expected to be 1/4 in next 2 years only. And the best part is there was another misconception or maybe that only players, Chinese players like Foxconn etc. can do this. But now Tata is buying out those players' Indian facilities, and they are saying कि we will manufacture for iPhone, we will manufacture for Apple. So there was one time when one politician made a joke in the parliament, do you expect poor people to make digital payments? And now we have those times when people are taking arms. आर्म्स बाय मीन कि जो हमारे यहाँ साधु संत वगैरह आते हैं, they are taking donation to UPI. UPI is being introduced in number of countries. So we should be so proud. When I was in Dubai, I was working in 60s and 70s. Indian rupee was the currency of circulation currency in the Middle East, and from there we lost all our gold over there. Now UAE will be having UPI payments. They are implementing UPI payments. So now we are exporting such mass technology out of India. And even if you look in India, the number of transactions which are happening by UPI and number of times of transactions which is happening by global duopoly of MasterCard and Visa. Recently, we got some discounts on income tax in the budget, and that has been made possible only because our indirect tax collections have grown very well. So our indirect tax collection has grown 4 times in last 10 years, all thanks to GST. Even for planning this event, GST was a major component because we had to ensure that it is paid very well and we can claim GST component. So GST has become a very indistinguishable part of our economy, and it is helping us in organizing businesses, in making businesses organized, and also in bringing as more and more players in the tax radar. I know when GST was introduced, the bigger issue that many MSME players cited was we will come under the advent of income tax. That was also one of the unsaid objectives of GST. So thanks for being such a good audience, for listening to the PPT. And let me thank the team which made this PPT. Jinal played the pivotal part, assisted by Utsav and Srihan, and designing part. Thank you. So now I'll invite Mallika to take the session forward.
Thank you so much, sir. I think that was pretty great. A warm welcome to everyone who's present here. My name is Mallika, and I'll be heading the session forward. But before we begin, I would like to invite Aditya sir on stage for a small surprise that we have for everyone. Let's welcome him, please.
Thank you everyone for joining us today. And so this is about, we often get this question, what is my ID card? So wanted to launch this and this event and clarify this question that many people are having. So my Mumbai is a digital brand of Nivesh. And let me just give you some backstory when we were starting. We always, there was about 4% participation in mutual funds in India. And we thought there is a big gap in this industry, and there should be more and more participation that should be coming from young people in India. And when we were starting, it was 6 months down the line in the business. We were getting acquisitions. We had built the brand of Nivesh. We were strong in the HNI business. And then it struck us that we are not able to cater to that population which requires this service the most. They have the most doubts. The traditional wealth outfits, traditional firms are not able to reach that crowd. And we wanted to create a brand that can cater to those individuals. So we first started with a content brand where we launched our YouTube channel, Instagram page, and we have posted more than 30 videos with more than 10,000 views till now. And it appeals to the young generation. So that's what we wanted to create. And as you can see the faces of our team, average age of our team is 24, and it makes me look old. But these guys are running this brand so that it appeals more to the young people. And now, about 6 to 8 months back, we realized that we also have to give them an execution platform. So we have launched this app that's called My Mini Partner. It's a brand under Nivesh, where there is a different kind of user experience. The backend is same, but there's a different kind of user experience that appeals to the young people, Gen Zs. And we'll just show you the videos of the onboarding, of the transactions, and about the features of this app, of this particular app. The digital onboarding process, we wanted to complete the onboarding process in less than 5 minutes. one feature that is very helpful for all the investors. So this is With one OTP, you can fetch your entire mutual funds portfolio, be it you invest with us or be it you invest outside. And with one OTP, you can check all your analytics on your mutual fund portfolio. You can get the complete review of your internal as well as external at one place. And we are currently live with MFs on MyMoney and we are launching new products like corporate FDs, small case, US stocks on the particular app. Thank you so much.
Check. All right. Alright, so that was mostly about our MyMoney launch. I hope that helps all of our guests who are present here to guide you through the process. Regardless of that, our whole team will be there to help you out at any point of time that you need it. Once again, a very warm welcome to everyone who's present here. I know 10:30 in the morning, coming all the way to Lower Parade on a Saturday. We are really grateful to have you all here. My name is Malika. I will be guiding you out through the next couple of hours of this event. So let's begin with it. Alright, now let's turn our attention to one of the most anticipated discussions. How Budget 2025 aligns with India's economic trajectory for the next 5 years. To lead this conversation, we have with us Mr. Pradeep Bhattacharya, Chief Investment Officer, Equities at Edelweiss Asset Management Company. With over 2 decades of experience in Indian and global markets, he has been instrumental in building market-leading investment strategies. Today, he will decode key policy changes, growth opportunities, and the impact of the budget on businesses and investors. Let's welcome Mr. Pradeep Bhattacharya and Mr. Aditya Gupta on the stage.
Good morning, everyone. I'm delighted to be here. I'm delighted to be here for 2 reasons. One is that, looking at the impressive growth journey of Nivesh, I'm glad that we got a chance to showcase what I think about markets in front of you. And second, I believe that most, if not all, the customer base of Nivesh IPs, not that they are kind of against any other clan, so to speak, but I think, like myself, graduated from my last 96, so when I was calling the age of these, very important kids, and my grandkids, but in that context, I've presented across the globe, and I'm glad to be presenting, and I feel part of the community when I present present to fellow audience that we have here. The task that I have in front of me is kind of talking about budget and what it means for the country and whatnot. What I will do is actually put the budget in the context of where India has been and where India is headed over the next 5 years. Now the thing is that you have heard and seen the structural growth story of India as they presented over the last half an hour. So I will actually take you through more practical parts, which is kind of from a market context where we are headed. They say in English, hearing a fresh from the horse's mouth. Yesterday I was in Delhi, where Honorable Finance Minister and Chief of Economic Affairs has called a few CIOs to sort of hear about feedback on the budget. So I certainly gave mine there and heard a few thoughts from their side. So hopefully, kind of, as I go along the discussion, you will gain some of this. Great. So the slide I come through. This is my presentation. Allow me if I talk through the slides to get to the main point of the speech today. Right. So, my title today is Seeing Before Being. And sorry, I know, we are doing rounds, but let's get down to practice. What is the issues that we have? 2024 was actually a year of elections, not just in India, but globally. Some of my analysts who are you know that more than 50% of the top 20 nations had elections last year. What that meant is there were many narratives. There were a lot of things were said and nothing was done. Okay? In some countries, leadership changed. In India, we know that the vote count went down from 400 expectations to 40. Right? And that is only the case. So likewise, across the globe, there were changes that came about. So I thought, 24, the year of elections. What were the implications? The implications were that, and if you hear me out, you probably can understand the story, you will probably get to where I am getting at. We started off last February thinking that we will spend about 11.5 lakh crores in capex. Now, by the time we crossed Maharashtra elections, we had only done half of that. That is the impact of elections that we have had here. And my sense is, if I take the sugarcoating off the numbers we talked about in public forums, this budget or this spending actually might turn out to be 8 to 9 lakh crores versus 11.5 lakh crores we thought of. This is the capital spend. All the infrastructure that we see. So there is a shortfall of 25% on the base of India. That is a on top of that, consumption had a bit of a soft patch because the inflation was unusually high. And again, taking the sugarcoating off the monthly numbers that you see, 5.5-6%. Inflation was not. Inflation is about inflation, the real inflation for human beings anywhere between 12 to 15%. It's basically higher than an average salary increase that happens. So courtesy these two phenomena, what we saw in FY25, and you can see here in FY25 point, that of the companies that are reported in India, that are listed in India, we saw an earnings cut close to about 10%. And you must be noticing the result season that is kind of come through. There will be further cut of about a couple of percentages. What does that mean? We started FY25 with growth expectation of 15% earnings growth. And earnings growth of 15%. We are now at less than 5% growth for fiscal year 25. for people who are kind of not really financially kind of don't understand what this is growth, think of markets as a slave of earnings. जैसे earnings grow करेगा वैसे market grow करेगा. एक very simple rule. Over 3 years and longer, this rule follows very religiously true. If earnings don't grow, market will grow. Right? In that context, when I say that earnings cut of 10 to 12%, matlab, when we started the year, we were talking about a 15% growth. Now we are talking about less than 5% growth for fiscal 25. Right? April 24 to March 25. And my sense is by the time we get to the end of FY 25, we call FY 25 as the year of no growth. Almost 50% growth. Now, what I did so what happened? Who is the culprit? So the first thing is almost 25, almost 70% of the reason behind what happened was because 25% shortfall versus what the government and the 25 or around 25% is taken down to consumption weakness. And that's where we are. The private sector companies also did spend because, on the third factor, which is Trump. As I said, 2024 was a year of elections, Trump taking over early 2025. Even his team members don't know what his plans are. Maybe Instagram knows. So, given that level of uncertainty, it's very difficult to expect any sort of proper entrepreneur putting money to work on the ground. So, private sector capital is completely right? So, after this heavy dose of what India is so good, this is the practical reality. I'm sorry to wake you up in case you face a So, that is where we are. And so, factoring all of this, you have a market correction which is of about 10 to 12%, which is very similar, surprisingly, to the earnings cut that we have seen. What were you expecting? You were expecting that earnings growth will not come when the markets keep going up. As I said, there is no reason. If I relate to real-life applications, when I tell you, if you don't score marks, then the chances of you doing better or you might go down. That's a simple That's where we are right now. And hence I'm taking some time to get you to appreciate where we are, because there's a lot of narrative in media, narrative about sales, this, that, the other. And somehow in all of that noise, the main core reason behind why we are here gets lost. And that is here. That earnings have been weak. And hence, my first proposition would be, till the time earnings come back, don't expect markets to grow. And then we'll have a chat through how earnings is going to happen. That's the next part of the presentation. But the first point is, till the time earnings rebound, it's very difficult to expect markets to rebound on what? On liquidity. That's also very risky. So that's where we are right now. So where do you go from here? Well, 2 or 3 things happen as we get to FY 26, which is the period starting next year, April 25 to March 26. First of all, we are finally out of the era of elections. For the last year and a half, the entire narrative world is finally coming to an end, in the sense that everybody whosoever has been taken to power has been there. And for the next 3 or 4 years, the macro narrative is not likely to change. It is a great starting point if you are an entrepreneur. Because मैं अभी कुछ करूँ, कुछ 6 महीने में कोई और अगर कुछ और होते तो मेरा तो plan बन गया. So it's the first and very important starting point. After a lot of time, after almost 1.5 years, we will move from political narrative on populist narrative to more earnings-driven environment where all this posturing is kind of out of the way. That's number one. Second, last year, and this was the this is where probably we in front of you, is that when we were talking about the reasons behind the shortfall, and in no words, as I said, we spent 25% less, how do you expect the results to come through? That is seeing a very high realization in non-profit. And they think that in come FY26, which is the year in front of us, you will see the entire capex being spent. You're already seeing some signs of it. Now, versus the 9, so they underspent last year. But from a base of 8-9 lakh crore, if they spend 11.5 lakh crore, it's almost like a 29% growth. So meaningful comeback in government spending will happen next year. That's the second point. And the third point is, again, taking a bit of feedback from what I heard yesterday, government is a little fed up of private sector capex is not happening. He said, if last year they gave tax cuts, they will neighbor this year, we're going to incentivize the consumers. So what they did is, they gave 1 lakh crore to the consumers in this budget. And this is where the budget comes handy. What is the relevance of this 1 lakh crore, you might ask? So, if I put it in terms which you can appreciate, basically for a middle class consumer in India, that means your average state salary has gone up somewhere between 2 to 8% on the back of this tax. Okay? Across the base of India. Now, if you compare this with actual salary growth in India, it's about 5 or 6%. So it's almost government giving you an additional salary hike. Not many things have happened. So it's a meaningful sort of boost that government is giving to consumption in the form of budget. And that's why I said that if you look at FY26, you will see a balance being struck between both government capex coming back and consumption coming back. Consumption has a multiplier effect of almost 45 times, which usually means that subsequent to that, the production changes and capex comes. That's kind of economics. But if you keep that aside, all of a sudden, from a year of no earnings growth in FY25, assuming these two things come back, which is government capex and consumption, we are talking about a 17% growth in FY26. And that, ladies and gentlemen, is something worth setting up and listening to. Because when that happens, of course, in the near term, markets have been weak, have been celebrating the earnings cuts, if you may call it that way, and a whole bunch of emotional narratives around that. But once the growth comes back, it will kind of equally gather pace before you realize it. Then the question is, when will this happen? And there I would encourage patience. This is different from, this correction is different from the previous correction. Because in the previous correction, earnings were still going up. The only thing that happened is share price corrected for some macro reasons and it came back quickly. This time earnings have also gone down. We have kind of discussed that at length. So, and earnings come back takes time. If any of you have many of you run companies, you would say earnings come back takes time. That's very important to understand. So for earnings to come back, if you ask me, it will be the earliest will be this festive season. This year's festive season, which means second half of fiscal year 26. And if that happens, basically stock market generally preempts maybe 2 or 3 months prior. So as we think about the next 12 to 15 months, that's the way we should think about markets, in the way I think the whole situation will evolve. For the last 5 months, I have been saying that overall this is earnings driven correction. It will take time, and nobody is or we had takers, but suddenly when the market moves by about 10%, you suddenly realize what happened. Usually that's how market behaves. But that's why we are sort of saying that FY26 will be a year of comeback. Okay? Now, just to go with the flow, so if we sort of think about FY26 as a year of comeback, how do we think about investing? So if FY26 earnings will come back in the back half of 26, the first thing that you should do is stay away from lump sums. Put money more in a staggered manner all the way for the next 4 or 5 months rather than 1 month. That's one thing very clear. This ain't coming back as of tomorrow. Right? Nobody has been able to call the market bottoms, and neither will I tell you the false impression. So investment in at least a 6-month kind of an STP mode is the best way to go about this, because hopefully that way you will cover the underbelly of the market. And I'm sure, as you sit with Nivesh, they come and talk to you about personality and all that. I would actually put the kind of investors into very simple 3 buckets. And you can think to yourself, in one of the 3, but you have to do this. If you can't do it yourself, sit with Nivesh and do that. It's very important for you to do this. One is conservative investors, second is basically a medium risk investor, and third is an aggressive risk investor. You need to think where to position yourself. What are the characteristics of a conservative investor? Market corrects by about 5%. You start making newspapers, you start making events, and you are thinking about taking money out of the market. So, or historically you've been invested in FDs, fixed income instruments and stuff like that, and hence volatility is another. For them, if you think about the core part of the portfolio, the category that might suit well, it's a very blanket basis to something like flexi cap. It is large cap heavy, it is kind of conservative stuff, and generally what that is over a period of time, it will give you a bit of a earnings curve from a small cap, but at the same time you will use it. If you are in the medium risk bucket, you do get feel left out when the markets go up, but when the markets go down, you don't want too much down. If you draw down, you're okay. The medium risk investors or the confused investors. Most investors that I come across are in this category. For them, you would recommend the multi-cap risk category. Roughly 50% large cap, 50% risk. All else covered. When markets actually participate, markets fall, you also participate. But for them comes the third category of business, which sometimes need hand-holding. This is a business who have been there in market for 10-15 years. They understand that earnings can be lumpy, stock market returns can be lumpy, and are willing to ride that through, have a horizon of 5 to 10 years or longer. For them, and they want to play the wealth creation from India, the young now, and all that, who are trying a lot of things in their hands or not, then you would recommend the mid-cap. With roughly about 15% to large cap, the rest is more. Over a period of 5 to 10 years, you would add value. This doesn't change, even if when we are seeing a bit of correction right now, when it's small cap. I would argue it's a good time to graduate it. Graduate is something that I would say. So, when you think about investments, these 3 options that I suggested are for the core part of your portfolio when you think about investments. And I leave it to you, discussion with Nivesh, to figure out where you are and what you want to go about. The final bit of the presentation that I wanted to cover is, we talk about markets in general, we talk about the hypothesis on earnings across market as a whole. But are earnings across the whole likely to be strong? No. There are certain pockets which do probably better than that hypothesis. Right? And we really at Mumbai tend to organize ourselves or our portfolios in and around those areas where we think earnings are likely to be strong. And the logic is very straightforward. As a CIO, one of the things, driving principles that I drive, probably the portfolio that I have my team runs, is that the markets are sustainable world. That means wherever earnings are likely to be stronger, the stocks will do better. Sometimes in absolute terms, sometimes in relative terms. Because if earnings are good, then more than half the job is done. So, with that in mind, these are the areas where we think earnings are likely to be resilient over the next 5 years as part of the topic of economy and where earnings are likely to be over the next 5 years. These are the markets that do well. And on these Of course, we went through the story of underspend last year and gradually recovery in spending this year. But basically, the whole point is India's capacity utilization is a high number. Can anybody guess what the number is? Anybody else from that side? Anybody from the back? Very, he's right in very good audience. It is 79%. Why is that important? Some of you might know this. That when capacity utilization reaches close to 80%, people start thinking about capex. There's no other way. Your existing facilities are used. Now, you can debate whether the capex will be strong or weak, but there will be some sort of capex cycle happening. That's the reason we think that manufacturing is one sector that will do well. Hopefully, with government spending coming back, that will stand to kind of do better as well. Second is basically real estate. Now, in India, there is a term which I want to introduce called housing unsold inventory. इसका हिंदी में मतलब ये होता है कि बिल्डर ने फ्लैट बना दिया वो बिके नहीं, सारा खर्चा हो गया बट सेल नहीं हुआ. You will be surprised to know that in India, the housing unsold inventory that is 7 years low. That is 7 years low. What that means is there is no inventory in the system. Low inventory in the system. No inventory. That's the reason when in Gurgaon builder launches this project, which was supposed to be there for 4 months, it gets over in 4 hours. So we are sitting there, but we want to show that post all the regulations that we have seen, very little inventory that is there in the system. So we think real estate will actually do well. Now, if the rate cuts happen even better, but real estate. Third is NBFCs. Now, this is one area where valuations are reasonable, and we think that with rate cuts starting to come through, they actually benefit in terms of the growth. So, third, that's another area that we are moving. Fourth is technology. Now, with Trump coming in and for all the narrative that he brings about in social media with regards to making America great again, if 50% comes through, this sector as an internet beneficiary would start to do well. And hence we kind of like the near-term risk of some of the tariffs that might come through. We'll see how that goes. But nevertheless, we think that if we take a 12-15-month view, then technology is another sector that will come out well. And finally, consumption. We started the year with consumption because our also started in right? The budget has really been a short term. Those kind of meaningful amounts of stimulus given to consumers. We think that will be another area to grow. So net, these areas comprise about 70 to 80% of our portfolio. And we think because the strength anchors around earnings, this is a good place to be. So that brings to the end of what I wanted to talk about in terms of, first the practical dose of reality with regards to potentially market correction, why, what are the reasons, and we went through the understanding of the government, and also with regards to a weak consumer, we've seen for the first time in the last 3 years earnings cut. That's the reason if I start to see market erosion, almost no correction, almost about 10%. Then when we about how things are likely to change as we get on to 526, and realize that, as we get to 526, from the year of lost earnings, 526 is well the year of earnings rebound. Because those two important engines of growth, investment, and consumption are likely to come back. And hence, as a parting advice, basically, while of course the correction always shakes a bit of your conviction, the best way to approach the correction is understand what the reasons are we went through, understand where, how long it will take to rebound, we also went through, and third, designing a course of action. And the course of action could be staggered way over the next 6 months, certainly that I will do your portfolio. well-wished that I kind of make it shine even better. So that brings us to the end of what I want to say. I give the mic back to Malika for I think there were some questions I'm making or already.
I remember 1st of February was the budget and around 11 that started and we were in office. So we all just huddled up together really quickly, turned on the news and we were all watching it. I think budget was one of those insights we all were really personally looking forward to. I now would like to invite Mr. Aditya Gupta and I would like to open the question.
Thank you so much, sir, for such an insightful presentation. And I think you have covered most of my questions. And my first question was about the earnings. And I truly believe that when their earnings returns are bound to fall. And when I invest in equity markets and I advise my clients, and just not looking in the short term, but in long term, I look at like 15 to 20% earnings growth in long term for India. And do you think that we can achieve that kind of growth in long term? Short term, you said that there was an earnings cut of about 10%. So for FY25, we have about 5% earnings growth, and next year we can expect about 17%. But in long term, can we achieve 15 to 20% earnings growth? And what are the major drivers or the structural changes that would drive this growth?
So let me sort of start with talk about the twin engines of growth. One is manufacturing, the second is consumption. The story in consumption is basically how the spend goes from currently which is $2.4 trillion to $4.2 trillion over the next 10 years. So the 2 and 4 interchange places. And as that happens, it creates a CAGR of close to about 20%. And there are segments of consumption which kind of stands to benefit. But in many ways, the consumption habits of interchange, if I take a poll here, how many of you have not used Zepto or Blinkit or any of these apps over the next year or two? Please raise your hands. Zero. There is a message in this. How many of you had heard about these names 3 years prior to this? That's again zero. So this is the perfect example of the changing consumption habit of India, particularly when we are talking about urban consumption. Okay? So this is the most glaring example where, overall, while earlier we used to go to the local retail store, shop around and whatnot, now almost like Aladdin and the gin, you rub it off and you say that this is what I want. Before you reach home, the product is there. So that's one glaring example of consumption having changed. Second, I would say is that usually all of you once you have traveled, you would know that one of the things that we think about in India is US में हुआ India में 6 महीने बाद हुआ. That's all we think about. You would be surprised to know that the quick commerce hasn't happened in US. It hasn't happened in developed markets. It's happening in India. To a certain extent in China. Right? So in many ways we are now leapfrogging in the way of our thinking ahead of examples which are there in the Western world. This UPI example that I think you quoted. UPI is not present in any of the developed markets. It is very difficult to survive now in the US because everywhere you don't have, whereas we have got into a habit of not having. So these are two examples, glaring examples. And third, which I will talk about is, I'm sure you follow sort of earnings. Hindustan Unilever in the last quarter earnings call reported volume growth of anybody? 0%. Indian Hotels bhakti really gets tested. But the point is, it's the same consumer. It's not that people are not spending on dacha, but that spend is constant. And the volume goes to zero. But because the spend earnings are going up, the salaries are going up, now you are going to, or an average, is kind of going to hotels, going to QSR, more than what was earlier, which is the reason behind the growth. So these are the three examples where consumption is changing. Manufacturing. If you ever go to North India and you look at the road infrastructure that is being created, you know that if I simply connect a place like Mumbai from Mumbai, like Consenting, right? By one road, the GDP of that small roadway goes up 9 times. This is academically proven result. So just by improving the infrastructure and the road infrastructure of India, connecting the different parts, that itself has a meaningful 8 to 9 times multiplier. So hopefully with the infrastructure and the adoption with examples, these are the changes which are happening in India right now. This is what happened in United States around about in the 90s, and you saw the GDP per capita really rise up. And that's the reason why India, driven by these two factors over the next 10 to 15 years, you would be, you find it difficult to recognize the face of India. We are just kind of happy to be inhabiting in India at this point in time when these things are changing. हमने कुछ नहीं किया है. So that's the reason I think net earnings growth of 15 to 20% is something which is certainly doable. What we have to be mindful is how do we participate in that? And how do we stay away from the legacy areas and make sure we are getting to the right areas so that we can capture that as part of our portfolio. But grow India for sure it will.
And truly we just lead the way in the digital economy and the inclusion. The kind of digital banking, the UPI system that we have created. A lot of billion-dollar startups have been built on this just tech stack. And even when we were just starting, we had a lot of tech stack sorted by our UPI, even our exchanges. So we can build on top. So it becomes very easy for us as entrepreneurs to start it with something. So we talked about earnings, and the other factor that on a technical side drives the market returns is liquidity. And there has been a lot of talk about it. FIs, we have seen a tremendous market from 2020 till September last year. And then since September, we have seen majority of FI outflows. There has been a lot of talk about it. What do you think? Does this seem a temporary change due to geopolitical events? Or is it a structural change that the ownership of our market is shifting from FIs to DIs?
So I think their behavior is cyclical. The second part is structural. Why I say the behavior is cyclical? Imagine you are a US investor. You earn your return in dollars. Now over the last 6, 9, 12 months, dollar is appreciated somewhere close to mid-single digits or high single digits. So for the return that you make in a country like India, rupees, by the time it is translated into dollars, it kind of grows almost 7.5%. It's practically for all practical purposes. The India growth story is eaten up by the others. Why should it be? So they are very logical in doing this. But the answer lies in pretty much the question itself. That the moment the dollar stabilizes, you would see FII starting to come back. When the dollar stabilizes, hopefully after the Trump policies and tariffs and values and all that he wants to do, once we are out of the way the market had adjusted, I think the dollar will find its equilibrium level. We have got to wait patiently with that for that to happen. So this is the cyclical part of where we are. The structural part is basically finally, I find the Indians are the Hanumans of the generation. Basically, we have a lot of power till we forget our own power. So, finally, actually it was a movement when everything else was closed, only equity markets were open. Gradually, people have woken up to the power of equity. If you look at number of accounts opened, you also done well, and many players have seen the benefit coming out of it. They say, why? They don't liquidate it. उसमें पैसे बनते हैं. So the power of equities is just about starting in India. So there, in terms of the transfer of ownership from FIIs to India, you will actually see this trend accelerate via your SIP book, via your growth, and also, broadly speaking, across India over the next 10 years. And this is just the start of that.
Yeah. And so my last and final question, there has been a lot of talk on mid and small caps. You manage more than 10,000 crores in your mid and small cap funds. What do you think about the valuations in this space? And are you able to find good opportunities when the mid cap index is trading at almost 30 to 35 times and mid small cap at about 27, 28 times? Are you able to find good companies at reasonable valuations to allocate?
So, I've just written an article which is getting published in Monday or in May. It talks about that, but here is a preview about this. At BBB for the next growth event, just to explain. So what market, what's happening in markets? We've had 4 years of strong markets. And as a result of this 4 years of strong markets, 2 categories of stocks have done well. One is what I call the beta type, or the stocks that fit the narrative. They are mid and small. They are those glamorous sectors where everybody is talking about. But inherently, their business model is weak. Right? And I'm sure you understand what some people retailers as what those things are. But some of those went through the roof like crazy over the last 3 years. The second category of companies are just general business. For example, since you talk about very large business small cap, do you know that the largest AMC, the India's largest AMC is the mid cap? India's largest chip maker is the mid cap. India's largest developer is the mid cap. And you look at their earnings, their business model, their business model is choppy cheese, absolutely fine. They're growing 20-30%, even in this correction they are off, but 5-10% is like general. So these are the alpha trades. These are those general growth stories which will also fall in a sentiment market. But it is this part of the market which one needs to capture in the portfolio. So the market in the current phase, when it related everyone over the last 3 years, we were brought to the market, it is now separating the beta and the alpha. And hence I argue that overall the idea should not be run away from the market. The idea is to invest in those strategies which can take the second category of stocks, the alpha, the winners. Because, and it's important for you to know why. Because everything is corrected now. But what will come back are those second category of stocks. What will not come back are the first category of stocks. So if you held those which form in the second alpha or the growth categories, then when you come back, one compound category will start to generate. This is significantly larger. And that's how supernormal wealth creation happens. That's how alpha generation happens.
Thank you so much, sir. And now I would invite questions from the audience if you have any questions for sir.
Hate to interrupt this audience. We would please request you to kindly keep your questions to the limited and thank you so much.
Thank you, Mr. Bhattacharya, for explaining the whole gamut of markets and the analogy of markets. 2 slides you explained beautifully. My question is, with your presentation as well as Alki's presentation, if India's contribution for global GDP is only 3%, that means the growth story in India is purely based on the domestic growth story. Most of our large companies, whether it's big cap or large cap, are catering to the Indian market. So how technically is basically purely sentiment-driven market where FIS are going out of the market comes down, and there is a huge funds behind DA and local participation. Unlike China, where most of the market is for export and all. How you see this Indian market be behaving in the near future, because we have a lot of indices to capture. in terms of consumption, FMCG or fuel or anything? Even
It's a great question. Thank you for asking that, and allow me to take one of the minutes to answer this. And it is a boon like any other thing that we are domestic driven, number one. And I've written simply because imagine, understand what's happening in the globe. Everybody is trying to do a make it their own country version of the economy, right? Make in India, make in US, make in here, make in Pakistan, even if there might be guns or whatever that might be, but make it every individual country is going. Right? So what that means is everybody is trying to go domestic, whereas they are already domestic. The second aspect of this is while China and some of our North Asian neighbors have tried as much as they want to United States, and it is when Trump took over, they have been losing their sleep. We are kind of breathing fine because they can't Trump kya kar rahe. You know, they need us as well as we need them. It's a great advantage position to be in there, which is why Modi ji, when they were there, you know, Trump is, all of a sudden, Trump is one of the best friends to Modi ji. Why? Not because he loves him. Simply because he hates him. He hates us. He needs them because that's what we have. So it's a boon, like any other thing. At the current moment, we need a domestic driven. No, if you link it with what I said, we are Hanumans in our own well. But if you look at when our well, 95% of our well, correct, is kind of, you know, is situated in real estate, gold, basically non-equities.
About 40% is in fixed deposits.
There you go. So, you yourself have not placed any confidence in Indian entrepreneurs who have been actually surviving despite government regulation for the last century.
exactly.
And finally, over the last 10 years, you have seen India has become the startup economy. So 10 years regulation has started to become a little helpful. So, and hence I said that as the India's participation in India's growth story increases, our own belief factor in our growth story increases, the domestic part of the story which is there in terms of earnings will start reflecting itself in the holding pattern of the equities, and it will be a great transition to be had. In fact, there is another part of the presentation where I have compared, or I had written an article in Hindu Business Line, where I compare India's growth story with what Japan, Korea, Taiwan went through their own times. And what one finds is that it is a 20-30 year journey, and basically the equities are the main way to play this journey for any country. India is right at the cusp of that from a 5-10 year perspective.
Thank you very much.
Thank you so much. Thank you so much, sir, for this lovely presentation, lovely insights. Now I would like to invite our investor, Mr. Suripta Chatterjee, to facilitate Pradeep, sir.
Can we have Mr. Sudipta Chatterjee on stage, please?
So I would like to invite Shekhar, sir, to please come and facilitate Pradeep, sir.
Moving forward to the next discussion, valuations play a crucial role in investment decisions, helping investors identify opportunities and risks across different segments of the market. With India's market continuously evolving, it is essential to assess sectoral valuations and understand where growth potential lies. To help us navigate this, we have Mr. Vinay Sharma, Equity Fund Manager at Nippon Life India AMC, with over 18 years of experience in fund management and equity research at ICICI Prudential AMC, AIG Global Asset Management, and JP Morgan India. An IIM Calcutta alumnus and CFA charter holder, he has led NFO launches and global investment initiatives. Joining him is Mr. Anand Sharma, Fund Manager at ICICI Prudential AMC. Has nearly 11 years of experience with a strong focus on managing equity funds and PME strategies. His deep sectoral insights across pharmaceuticals, metals, and financial markets make him a valuable voice in this discussion. Let's welcome Mr. Vinay Sharma, Mr. Anand Sharma, and Mr. Aditya Gupta for a panel discussion on this interesting subject. Give them a round of applause, please.
Thank you so much, Vinay and Anand, for joining us today. Mr. Vinay Sharma is a senior fund manager at Nippon India Mutual Fund. He manages more than 15,000 crores across Nippon's focused equity, banking and innovation fund. And Mr. Anand Sharma is an equity fund manager at ICICI Mutual Fund. And he also manages 15,000 crores plus across ICICI's multi-cap and housing opportunities. Thank you both for joining us today. And it's an interesting topic. We have covered some part of it in the last session on India's valuations across different market cap and sectors. My first question is to Vinay. There has been a lot of talk on valuation these days. And hence we have kept the session specifically for the same. And I want to start with a very basic question. And in the audience, we have many experienced investors, but some of the investors who are starting in equity markets. So what drives valuation in the market? Because then only we can understand that whether it's expensive or not.
This is a very, very complicated question to answer, but what drives valuation at an aggregate, although we follow things like PE and PEG, and stock, but what drives valuation at the end of the day is how much cash can a company generate over its lifetime. That is what fundamentally drives valuation. And if you drill down further, that means when we are valuing a company as a fund manager or an analyst, what we try to analyze is what is the potential of that industry, how large can that industry be, then within that industry what is the potential of that company, how large can that company be, what can be its market share. What can be the market share of that particular company, the profit of that industry. And then based on that, finally you come down to what would be the broad value of that company in the near future or in the next 4, 5, 7 years. Depending on the time horizon can be different for different class of investors. As mutual fund and this fund manager, we are looking at what would be the value in the next 3, 4, 5 years. If you are an entrepreneur or a private equity investor or an angel investor, you will look at what would be the value of my company in the next 7, 8, 9, 10, 15 years. So the time horizon difference is there, but the way to value a company is simply what profits can it generate, what cash can it generate, and based on that, what market will give some sort of multiple. That multiple criteria is different for different industries. For example, NSs are valued on export and price of profits. Most of the companies, traditional companies are valued on earnings. And there will be more complicated ways to valuation. answered this question in a simple manner, because frankly there is no simple way to answer this question. It is a complicated exercise. Valuation is not easy, and most of us go wrong even after working for 20 years. Most of the professors in Stanford and Harvard they go wrong after teaching it for 50 years. So it's a very, very difficult thing to do, frankly.
Thank you so much. And I think you've pretty much covered it, as you rightly said, the cash flows, cash that the company can generate, or like in last session, earnings can the company generate. My next question is to Anand. When we look at valuations at the index level, large cap is trading at almost 22 times price to earnings, mid cap is about 30 to 35 times, small cap is around 26 to 28 times. How do you see these valuations at the index level? And do you, in your funds, are you able to find good opportunities at reasonable valuations? I asked this question to you, sir, as well. But it's my question to every fund manager that at these valuations, are you able to look at good opportunities at reasonable valuations for your fund?
Sure. Thank you so much for this question. First and foremost, when you break down this large cap, mid cap, and small cap, all three different categories of investment, I typically what we always do in life. Life is all about something that we expect versus the reality that could occur. So basically, even in investments, the problems occur when there is a big mismatch in your expectations versus what is the reality. Now, if you actually look at what's happened in the last 3 years, and I'm going to take 3-4 years as an example, because most of the investors in India have actually come into the markets in the last 3 years. We've seen a lot of IPOs, for example, and many of us have seen IPOs. Majority of them have been in the mid and small cap space. And all of us, when we look at IPOs, the most important thing that we track is what happens to IPO on listing day. Most of us, we are just doubling of stocks on listing day. So there has been a certain expectation that has been created in these mid cap and small cap indices that they will continue to grow at a very, very fast pace forever. Which is where the problem lies right now. I'll just give one data point. And if I go back 10 years, and 10 years is a very long time as far as equity is concerned. 10 years back, the large cap proportion of Indian market cap was about 75 to 77%. Today that's about 60%. And it's not that large cap companies have not necessarily grown in the last year. So I think what you are seeing today is still a valuation mismatch. So today, if I look at it and answer your question, large cap I think are very comfortable as far as valuations are concerned. Maybe we have a year where probably investors might not make money, but I don't think anybody comes necessarily into markets just to invest for a year. Right? I mean, we are all here to make wealth, and this is never made in a day. I mean, I always say Rome was not built in a day, right? So wealth cannot be built in a day. If you have horizon, which is long term, and what Nivesh also suggested, I think long term basis, large caps can still continue to make fairly reasonable compounding wealth. If you look at Nifty, for example, typically it has always generated, you take 10 years, 15 years, 20 years as time frames, it generally gives you between 20 to 40% average return. So I think that's the kind of expectations that one should always expect from large caps over the next few years, decades. I think mid and small caps probably still have some more time where we have valuations need to come down a little bit. But I think I always make this statement, the beauty about India is there are so many sectors and so many stocks available that as a fund manager, you will always have sectors and stocks where you can bet on and take calls. So I will not make a blanket statement here, but I think it's safe to assume that today large caps is a far safer investment compared to mid and small.
Thank you so much. And now coming from market caps, because it's a broad-based view, I'll come to the sectors. And Vinay, you, apart from focused equity fund, you manage banking and innovation fund as well. And we have seen Indian banks facing deposit pressures, but we have also seen their balance sheets have never been so strong. Their net, India's gross NPS come down from 11% in 2018 to 2.7% now. So how do you see the growth in this banking sector, and what are the key drivers of growth in this particular sector?
So, let me take you to the second part of the question first, because that's a very easy answer. Basically, the Indian banking system is made of three broad segments. About 35 to 40% is your corporate, another 35 to 40% is your housing plus personal plus everything, and then last 20% is your equity plus SME plus rural loans and all of that. So broadly, fairly simple sort of banking system we have. Now, what has been happening over last say 10 years is that retail was the primary driver of Indian banking industry, and retail, personal, housing loans, depending on which segment we are talking about, they were all growing between 10 to 25%, and the under-penetrated categories like personal loans and LAP and all that were probably growing at 50%. The more penetrated categories like housing and all were growing close to 10%. So that 40% was growing between 10 to 25%. On average, you can say that they are growing at 50-60%. What has been not growing, or what has been growing very slowly for last 4-5 years and before that also, but the reason for different is corporate loans. So 2016 to 20, corporate loans were not growing because India was in the midst of an NPL crisis. And banks were all trying to solve their own balance sheet and try to repair it, and we went through that bankruptcy process where a lot of corporates had to go through that, and most of those problems are solved today. But we have problems in lots of sectors, in infrastructure, vendors, textile, and a lot more. So 2016 to 20 just went away solving the corporate issues. The problem after that was that since 2020 to now, while economy has done well, corporates have also done well, loan growth is still quite low, is because corporates are flush with money. They have made so much money from 2019 to today that most of the countries are actually flush with money. They don't really need much capital from outside. Second, in India there is this perception that equity money is actually cheaper than debt money. And because markets have been so good, corporates are getting easy access to markets. Equity, as we have seen in the last 3 or 4 years, everything when you come in an IPO, most of the time it was oversubscribed, QIBs, and all of that IPOs are doing so well. So equity markets are actually contributing to the low growth of banking system. For the next 3-4 years, I would assume Indian loan growth can be between 10 to 15%, and the rationale is like this. I think personal loans will keep growing at this between close to 14-15%. I know last 1 or 2 years RBI has come hard on personal loans and they have tried to clamp down, but broadly with the new RBI governor and most of the problems now getting sorted, I think personal loans can keep growing at that. Corporate loans, if equity market remains stable like this, then we don't come into the bull phase anytime soon. I don't think they are coming back very soon. Then I think corporates will also start using the banking system more than also because of this rupee depreciation. Foreign loans have also become a little more expensive, and so people will move to domestic markets a little bit more. So I think corporate loans can grow at around 10%. And if you combine the 15 and 10, I think broadly we can grow it between 12 to 14% for the next 3-4 years. So that's the growth and the drivers of growth in Indian banking system. What was the other part of the question? Sorry.
Yeah. So, I think very well answered the question. Anand, my next question is to you. You manage a housing opportunities fund. It was launched 2 years back and it's performed relatively well over the last 2 years. What is the eligible universe for you when you say you manage a housing opportunities fund? And same question here, you see the growth coming in this sector. What would be percentage contribution of rural area in this particular sector?
To be honest, actually many people listening to this name housing opportunities, the common misconception that people have is that it's only about real estate. But actually, if you look at the economy of India or for that matter any other country, take China or take US, actually the housing ecosystem is very important for countries' GDP growth, both on a direct basis and on an indirect basis. Let me take one example today. Today, for example, the entire housing ecosystem is more than directly contributes more than 8% of India's GDP. So that's definitely not a very small number. In a place like China, it's almost 15%. So that's how important this entire housing ecosystem is. And I'm going to take the example of what Pradeep had also presented. That what happens is that when you have a housing ecosystem that develops around an area, it's not just a real estate company that benefits, right? You have an entire plethora of companies and sectors. Let me just, if I run through the ecosystem, right, tomorrow, if you want to buy a house, the first thing that you will actually do is you will actually approach a bank or a housing finance company to get a loan, right? First and foremost, that building or a housing society needs to get constructed. So there is going to be a real estate company which is also going to use things like cement. Once the house is constructed, there are going to be a whole host of sectors like say upgrade, consumer durables, white good appliances, your kitchen appliances, your sanitary ware, etc. So essentially, when we talk of housing, it's not just about the real estate. It's actually about the entire ecosystem of about these 7-8 sectors. And finally, after a house is ready, you even need a good power supply to run all these appliances, whether it is an AC or a cooler or even all the kitchen appliances, etc. Right? So there are about 7-8 sectors which play a very important part in this entire housing ecosystem. Now, I just give one example as to why this is important for the country growth also. If you look at the period between say 2013 to 2019, 2020, just before COVID, for all the good work that India had done, we were actually not growing all that fast as a country, and our growth has significantly picked up post-COVID. Right? Now, one of the reasons actually in those 6 years that the growth was very high was actually because this entire housing ecosystem had almost collapsed. Right? You had a housing ecosystem with very high prices, so essentially people were not buying them, and so fresh inventory was not getting created. To a large extent, our urbanization rate in India, for example, today 35% is the urbanization rate, and of course the world is more than 50%. So logically, over the next 5 years, we should be moving towards that number. But in those 5-6 years, this urbanization rate did not increase that highly, and that eventually reflected in the economic growth of the country being not as high as it should have. So to that extent, this ecosystem doing well is very important. To be very honest, for housing to do well, I would say urbanization is a far more important driver than the rural ecosystem. Does that mean that it's not necessary that rural should not do well for housing? Of course, that's not a good case, but if I have to place them on a scale, I think for housing ecosystem, urbanization is a bigger driver, because in rural India, obviously, you're going to have a far more number of affordable housing schemes, etc., which obviously the government will have to run in order to ensure that people have home. But I think it's far more of an urbanization play than necessarily a rural.
Sure. And you both manage broad mandate funds, to manage focus equity fund, manage multi-cap fund. What are the sectors, so my first and then Anand, what are the sectors that you're currently overweight on and sectors you're currently underweight?
So, see, first of all, let me clarify, this answer is only by me, not like at Nippon, we run each fund manager runs according to his own beliefs. We don't have a team as such. We have collaboration, but it's not like necessarily what I like, Salish like, or Meenakshi likes. So each person can have different views, and that might be reflected in funds as well. But at this point of time, actually a lot of us are very overweight on banking and financial. That is a common theme across a lot of our funds. And broadly, the reason is very simple. Dekho, I have been looking at banks for 20 years now. 2007 se pehle, some retail banks were trading at discount because of that ICICI crisis. 2015 to 20, corporate banks were available at very cheap prices because of the NPL crisis. and retail was very, very expensive, all the Ritik stocks and all of that. Today, in the last 2-3 years, has been a time period that it doesn't matter whether you are retail bank, whether you are corporate bank, whether you are a mid-cap bank. Almost, other than a few NBFCs, large NBFCs, and some small stocks here and there, most of the financial industry today is available at a huge discount to Nifty. That I have not seen in 20 years of my career. That the entire financial industry is so at a discount to Nifty, to the extent that some of the large banks in India are available at 9, 10 P, 7, 8, 9, 10 P. And I'm talking of private banks. I'm not saying PSU banks. PSU banks are obviously always available at single digit P. But today the large cap private banks are available at that P. Some of the NBFCs are available at close to 12, 13, 14 P sorts. So I think obviously there are some technical factors like FII leaving India and all that. But a large part of that, why financials underperformed to me was that in that 2022 to 24 boom phase, there were some sectors which came out just out of despair, like power. No one looked at power before 2022. Suddenly everyone realized that power is a sector that India is falling short of, and we have to do huge investments in power, and power order books are growing and all of that. So there were few sectors which suddenly either earnings grew at 20-30%, or the order books grew at 20-30%, or the news flow was very good. And financials had no such narrative. They were growing at the same 10-12%, earnings were at the same. So the difference between some of the sectors and financials became too large, and that's why financials have underperformed. I think going forward in FY 26 and 27, financials will grow as much as Nifty earnings. I don't see a scenario where financials will underperform. My personal view that financial actually might do better than Nifty earnings over the next 2 years. And therefore the biggest overweight for us is financials. The second big overweight that I run in my funds today is consumer discretionary. And when I say consumer discretionary, it's a mix of a lot of sectors, which could be your normal discretionary items like auto, it could be going out of home, it could be some part of media, multiplexes, a lot of, this urban consumption, high-end urban consumption, as we call it. That is my second largest overweight. And then mostly it's bottom-up picks, including power, manufacturing. And what I'm underweight on is global stocks, which is your IT, metals, oil and gas, most of the global sectors, basically. I continue to believe that India or Indian domestic economy will do much better than global economy. There is no doubt in that. And the good part about Indian domestic sectors is that they will keep getting share in international manufacturing as well. And therefore, even in exports, some of these domestic companies will grow faster than some of the traditional global economy oriented sectors. And to that extent, portfolio is heavily overweight domestic sectors, and within domestic, it is consumption plus financials.
And sometimes looking at some of the financial stocks, it looks like growth is not priced in yet. Yeah, same question to Anand.
So I'll answer that as well. So obviously, maybe some part of it might sound repetitive. So I'll take the places where I have maybe some sectors where I have a different opinion. For example, I think one of the top sectors for me personally, and which is represented in my published funds at this moment, I think cement is one of the most interesting sectors at this point of time. In India, we hear a lot about this capex has not been happening, etc. But actually, if you look at cement as a sector where you have the two largest players, instead of actually putting fresh capacity, what they have essentially done is they have just gone on a buying spree. And in the last 3 years, they have just bought out all the small players. In fact, if you switch on CNBC, it's likely that every 1 month you would have heard about one of the top cement companies buying one small cement company. So I think what's happened is that rather than just expanding the industry pool per se, they've essentially consolidated the industry. And in the last 9 months, and especially if I look at this entire financial year, actually it's been now 10.5 months, basically government capex, has not happened in a big way at all. So you've had a situation where the industry has gotten consolidated, the government capex has not necessarily happened in a big way. Plus, of course, when you have people wanting to buy small players, they will ensure that the industry doesn't make money. I think it's logical economics. So I think what you will see over the next 2-3 years is that you will see some improvement in price in the industry, and that's when the top 3-4 players can actually benefit. So I think it's a very interesting sector in my view, cement, and I think over the next 2-3 years, it's one of the few sectors where both the volume growth as well as pricing growth can happen. I think Vinay spoke a lot about banks, but I just want to add one more point to that. You know, historically, if you look at banking industry in the last 15 years, in the past, you know, we used to hear a lot about mistakes in the banking sector, whether it was PSUs or whether it was private banks. Of late, you actually don't hear too much of that. Partly the reason is that the regulator is like sitting on them like a watchdog. They've ensured that they've also not grown at a very fast pace, but they've also ensured that too many mistakes have not happened. And it's partially, I think, also the reason why there has been possibly an irritation amongst the investor community that there is too much watchdog happening. And at the same time, FIs have obviously pulled out a lot of money. But I think what you will see is that the large financial institutions, whether it is the large private banks or the large PSU banks as well, I think they are in for a stable growth regime over the next 4-5 years. There is one sector in financials which I think is very interesting, which is life insurance. And why do I say that? In the last 3 months, there has been a lot of noise by finance minister, regulator. Essentially, what they are trying to tell the industry is that you need to make the product more customer friendly. Now, in the mutual fund industry, we've also had a lot of cases where the regulator has told us to reduce expenses, etc. And ultimately, when the product has become more friendly for the customer, it has always resulted in possibly short-term period of pain, but long-term, it's fantastic for the industry. So I think life insurance is a very interesting industry for me. I think just like Vinay, even I'm a little worried on global stocks because frankly, I think it's better at this point you bet on the local economy. I think consumer durables is something I will be very positive on at this point, and part of it is because, see, when COVID happened, all of us were sitting at home. All of us probably pre-ordered everything that we needed for 3-4 years. I think that phase has now passed. And just because I'm also positive on real estate and housing ecosystem, I think over next 3-4 years, as people start taking possession of houses, I think you will see some of these sectors also start doing well. So I think for me, there is a mix of sectors which is going to be linked to capex, like say a cement, or a mix of sectors which is going to be consumer oriented, like consumer durables, etc. I think power is a sector, and I'm going to say this, it's slightly unfortunate, but over the next 3-4 years, I think India is still in for a power deficit. We might not probably face that because we are lucky to be in tier 1 cities, so we'll have all kinds of generators, etc. But I think people in tier 2, tier 3, tier 4 cities, I think they are still going to continue to face power crisis, and these problems are not solved in 1 year. These problems take about 3-4 years to solve. So I think next 2 years, even power as an industry should continue to do well. So yeah, these are the sectors which I am bullish on in my published portfolio. And I mean, the sectors which I am worried on will be mostly global exposure sectors where, you know, either which could be hurt due to tariff or whether China could play spoil sport, etc.
I apologize
so
for
much.
the interruption.
My last question to both of you. Any other market apart from India excites you at this moment?
See, the issue with that is one, I've always invested only in India. So, so the entire, studying of other markets is purely academic in nature. That's part of my job, so I have to do it. But I'm really not an expert on global markets. But US is definitely very expensive. Also, I think what has happened in last 1 year or so, that this narrative has come that US and China are the only two players in high-end manufacturing, and they are the only players in artificial intelligence and all of that. I think this narrative it is just hogwash. This will just go by in the next 1-2 years, and then people will realize economy is the same. Just because a new fancy thing has come called artificial intelligence or blockchain, or it doesn't mean that India has no relevance or Mexico has no relevance or So to me, I think internationally, I don't know what is exciting, but US is definitely not exciting at this point of time. Broadly, I think domestic-oriented economies might be better off, as Anand said, because of this Trump tamasha and tariff wars and all of that. So some of the domestic-oriented economies might be better off than global-oriented economies. So India, Indonesia, these two countries which are broadly considered more domestic-oriented versus the other comparable peers. Also, see, one thing that I always say in my talks is if you look at comparable countries, countries which have the same sort of liquidity, same sort of market cap of at least $2-3 trillion and above, there are hardly a few countries. Only 10 countries, 7-8 countries are there with this sort of market cap. Half of them are not growing because their population is declining and they have grown old and basically they have no future. And some of them are hurting themselves by either being too on the right-wing side or involved in a war. Like Turkey was very promising at least a decade back, but the way Turkey has moved from being a reform-oriented economy to becoming more and more sort of right-wing, if I can say that, Turkey has hurt itself. Brazil I don't like because it's just too much of commodity orientation and I really don't like the working culture also of Brazil in that sense. So comparable to India, I find very, very few countries which can be compared to India. In the long run, I would still be bullish on Mexico because the way world is changing, manufacturing is going close to consumer and Mexico is still the closest to US. And at some point of time, I'm sure Trump will realize that Mexico can produce things far cheaper than what US itself can. And to that extent, no one can replace Mexico. So I would still be okay with Mexico, but that in the very long run. In the short run, I think Mexico is in for a very troubled time if Trump continues. So to me, the best place to be in for equity investors is India without a doubt.
So just to take that point further, in investment, one of the challenges that, even for professionals like, me and Vinay, the amount of time we spend just on knowing India, there are times we still end up clueless as to what happens. So imagine spending time on other countries across the world. US at least is a different beast, but if you look at other emerging markets, the amount of time you spend and the return on time invested that you get, it may not actually, suit everyone. So to that extent, I think I would actually today, being an investment profession myself, I would actually spend a lot of my time on India itself because this is a market that I and many others understand fairly well. At least we know what's happening. There is still a higher amount of predictability. And I think one of the things why India has greatly benefited compared to the rest of the world, firstly, we underestimate the stable political regime that we've had over the last 11 years or so. It's actually benefited us a lot. And the other point, if I go back 25 years, right, when India actually did that test at, Pokhran, the first thing that the world wanted to do was ban us, right? US wanted to ban us. Today, when the Russia-Ukraine war happened, India was actually buying cheap oil from Russia, but still we were able to maintain our neutrality with many other countries, which was not possible in the past. So to that extent, I think India is in definitely a much better, stable political condition compared to many of these emerging market countries where some leader comes and then changes the total fate of the country. So I would personally spend most of my time in India. I know a lot of people get excited about China. Last 10 years, China has had a very bad experience for the investor community. Can China make money? Why not, I think. But the problem is that it's a totally opaque economy. Even the information that you get out publicly, you are not sure how to even ratify that information. So can you allocate maybe 1-2% of your portfolio to a country like China? It's possible. But I think that's the call that we as investors need to take, that because we are today in a country like India where at least there are a lot more predictability about the country,
I think you should allocate majority of your capital to India, and maybe you can have a small capital which you can, daggle in maybe some of these emerging markets when the time is right, when valuations and markets have a global problem. So, yeah.
Thank you so much. Thank you so much, both of you, for joining us today.
Thank you for inviting
Any
us.
questions from the audience? Thank you so much. I'll invite now Mr. Sudipta Chatterjee to come and felicitate Mr. Anand Sharma and Mr. Vinay Sharma. Can we have a round of clap, please?
Check. Moving a little off track from wealth, but not exactly diverting from it, I would now like to move on to the next session. We focus on building wealth, but ensuring its seamless transfer is just as critical. Succession planning and nominations are often overlooked, leading to unnecessary legal complications. To simplify this crucial subject, we have Mr. Jugal Popat, co-founder and director of Wilgenie, India's first and most trusted succession services company. An MBA from SPJ in Mumbai, Mr. Jugal has worked with Swiggy, Uber, Lintas, and Book My Show. He is on a mission to make succession planning affordable and accessible for all Indians. Today, he will guide us on how to safeguard and transfer wealth efficiently. Let's welcome Mr. Jugal Popat and Mr. Ankit Garg on stage.
So before we start, I'll just steal 30 seconds. So we run a podcast channel also by the name of My Money Panda by Wealthy Nivesh. And my podcast with Jugal was the most well-received one with the most number of visits. And Jugal, so today, one of the most awaited sessions was Jugal's session only. So welcome, Jugal. Welcome to the... So Jugal will start his presentation, then I'll have a panel discussion with Jugal, and then we'll open the session for Q&A from the audience.
Hello. Thank you. Hello everyone. Thank you for the warm welcome. Thank you Ankit ji for having me. अंकित जी आपसे एक शिकायत है मेरी. अंकित जी आपसे एक शिकायत है मेरी. जब से आपसे मिला हूँ तो मार्केट से प्यार हो गया है. एंड वैलेंटाइंस वीक में मार्केट ने प्यार का रियल टेस्ट ले लिया है अभी पिछले हफ्ते में. एंड स्टिल रीलिंग इन विद दैट. बट सो या टेस्ट वो ले रहा है और मतलब लॉयल्टी मेरी टेस्ट हो रही है मार्केट से. I hope with you I get to cope up with it. So friends, today we're here to talk on a topic of succession planning. Circle of life. हम सबका एक circle of life होता है. Okay? We start with education, whatever college, undergrad, postgrad, जो भी degrees हम लेते हैं. We move on to build wonderful, beautiful careers. Mostly here from financial space or from businesses that we're here from. We build a corpus for ourselves. हम savings करते हैं for the family, for family's education, kids' marriage, things like that. We work on investments. We're here to learn about investments. What do we do with our money? Kahan diversify kare? Multiply kare? Where do we multiply that wealth from? Diversification, like I spoke. What next? We are spending so much time in our lives on all these aspects. Every day, in and out, you're thinking, okay, Nirmala tai se tax kitna bacha lu? How do I, get 1% more out of the market? If I take a debt versus an equity, how will I, over the period of next 15 years, make some more money? But the last step of the financial planning, which we are missing out on, is succession planning, right? What happens to the money, the wealth, the savings that you've earned over your life, whatever your age be it 40, 50, 60, what happens to that entire corpus? Let's say if you were to vanish all of a sudden. I mean, this is a question that nobody had answered for the last, or had spoken about for the last 100 years or so. Indian Succession Act 1925 में बना था, 1925 में. आज हम 2025 में हैं, 100 साल बाद, और हम इस चीज के बारे में बात क्यों आज कर रहे, पहले नहीं कर रहे थे? Because the way Indian customs have changed. Like you would know, पहले के टाइम पे, if something happened in the family, the next head of the family, who was the most eldest, they used to take care of the reins, and the family used to follow. Now as we move towards more nuclear families, families spreading apart, kids going abroad, settling out in another city, what is happening is there's more independence that people seek. That what will I get? What is it that I have to do? So that connection, that bond is reducing, and it's a fact and it's a reality that as India moves forward, this will only increase. So we're saying that while the West has been doing succession planning very normally for the last 40, 50 years or so, India में अभी इसकी ज़रूरत आना शुरू हुई है because of the fact that that इसके बारे में stigma है, people don't want to talk about it, which is why I'm here, so that I can openly share some knowledge that we have with all of you here on a topic like succession planning. Life is unpredictable, and it's a pressing concern that most of us have been facing without any plan in mind. See, we are the only product of the nature which does not come with a date of expiry, right? And you can't predict it. So that is one of the driving factors of this this service. But why particularly will or succession plan in India at this point? Number one, घर में कोई finances की बात ही नहीं करता है. Like if a father is owning a business, अच्छा business कैसा कर रहा है, क्या stake है मेरा, partner का क्या stake है, what was this year like, or if someone has invested a lot of money in the markets or gold or debentures for that matter, pension कितनी आ रही है. All these things are not very openly talked about with next generations. So there is a information mismatch. I don't know how many savings accounts, how many DMATs does my father have for that matter. I mean, I actually do, but most people don't. So there is very little information in the family, even with the spouse. लोग अपनी wife को भी openly नहीं बताते because it's been the custom that she won't understand right now or whatever. And then when a time comes, they're clueless. They have to go on a treasure hunt. And it can also, besides the treasure hunt, can trigger some kind of confusion within family. We're not saying all families are debonded or struggling to stay attached. But when that time comes, right, emotions are on a high. And in that case, the peace, the bonding that the family had can go for a toss. So why take that risk? A will solves for all these problems in a very simple manner. We are trying to normalize that a will is a simple piece of paper जो आप एक tax planning करते हो हर साल के अंत में या investments review करते हो. Your will is a similar thing. You're planning like what's going to happen with my money if I'm not there. Similar to an insurance. If you have an insurance, like I bought my insurance at the age of 23 when I got my first job, thinking that मुझे कुछ हो गया तो मेरी फैमिली को, मेरे स्पाउस को आगे जाके सपोर्ट मिले. So if I'm thinking of contingency at such a young age, and I'm sure a lot of you bought insurances at young ages, why are we associating will to a very different connotation? It's the same connotation. It's on contingency, right? So Viljini, our company, helps in affordable solutions for Indians in succession planning. There are a lot of myths people have. यार मेरे पास इतना पैसा कहाँ है? पैसे बनाऊंगा तब जाके will लिखता हूँ. Now there's something that we all know that अगर मेरा घर 50 करोड़ का है तो मेरे फैमिली के लिए वो 50 करोड़ बहुत मायने रखते हैं. सिमिलरली इफ माई हाउस इज समवेयर इन द रिमोट पार्ट ऑफ इंडिया, उस घर की वैल्यू 20 लाख रुपए है, तो मेरी फैमिली को उस घर की कीमत बहुत ज्यादा है, बिकॉज फॉर माई फैमिली दैट इज द मोस्ट वैल्यूएबल एसेट. सिमिलरली ऑल ऑफ अस, द रियल एस्टेट दैट वी ओन माइट प्रोबेबली बी द मोस्ट वैल्यूएबल एसेट इन आवर फैमिली, likely. Otherwise also the net worth of the family is not relative कि मुझे succession plan बनाना चाहिए कि नहीं. For them, for their peace, for no legal hassles in the future, it's important. So we are saying that don't associate that when I'll make X number of money or when I turn X age, उसके बाद में करूँगा. No, it's something that you need to start doing today. It's a plan that you are making for your family's safety and protection even when you're not here. सेकेंड मिथ दैट पीपल हैव, यार मैंने नॉमिनीज ऐड कर रखे अपने सारे एसेट्स में, फिर विल की मुझे क्या जरूरत है? वाई डू आई नीड अ विल इफ आई हैव नॉमिनेशन डन? नाउ द थिंग विथ नॉमिनेशन इज अ वे दैट गवर्नमेंट हैज मेड टू इंश्योर एसेट्स आर ट्रांसफर टू द फैमिली. किसी एक जन को दे दिया, दे टेक केयर ऑफ द एसेट्स, सो दे आर अ कस्टोडियन. अ नॉमिनी इज अ कस्टोडियन ऑफ माई एसेट्स, and it's their duty to distribute it to my legal heirs. Okay, for example, my nominee is my wife. Okay, now if something happens to me, my wife will get that asset, but वो उसका नहीं होता है. She is not the owner. It is her duty to ensure it goes to all my legal heirs. अब legal heir कौन होते हैं? Legal heir for a Hindu male, for example, I am a Hindu male. My legal heirs are my mother, my wife, and all my kids. In equal proportion. So it's my wife's duty to distribute it amongst all my legal heirs in equal proportion. वो नहीं करे, किसी ने कुछ नहीं बोला, तो it's good, well and good, family is cooperating. But if someone raises a question कि यार मुझे मेरा हिस्सा क्यों नहीं मिल रहा है, then it's nominee's fault. So nominees as a government उन्होंने बोला है कि okay, बैंक पैसा दे देगा नॉमिनी को, नॉमिनी आगे का काम खत्म करे, या society will give the flat, but it's the job of the nominee to transfer it. So it's two different things, not to be confused. A will still has to be made. We talk about another thing that अगर मुझे कुछ हो गया तो मेरे पार्टनर को सब कुछ मिल जाएगा. Like I just previously said, every family or every individual is governed by their religious laws. Hindus are governed by the Hindu Succession Act. Christians, Parsis are governed by the Indian Succession Act. Muslims are governed by the Sharia law. So in that case, if something happens to an individual without a plan in place, so the religious laws kick in. So the government or the law will decide who will get your money. Like I said, in a Hindu male, wife, mother and all kids get it equally. But if my wish is that no, my kids are all well off, I want my money to go to my wife or my mother, I have to make a plan, right? Because in my absence, things are not in my hand. Another myth that people have, एक बार मैंने will बना दी तो मैं इसे बदल नहीं पाऊंगा. So let me hold off, let me then make it when I have made my mind what my family deserves or what I have in place. But we are saying that will can be written every year, every day for that matter. आप हर रोज भी लिख सकते हो. Ideally speaking, 2-3 साल में review करना is a great thing. That what I write in a will today, I'm looking at it after 2 years, 3 years. There are 3 reasons why someone can want to make a change in a will. ठीक है? एक होता है कि there's some major change in my asset. कोई बहुत बड़ी property buy sell हो गई. Or there are some changes in my family structure. Some birth, some death, some marriage, some divorce, right? Third is some relationship has changed. So if किसी के साथ relationship सार हो गया, खराब हो गया, or with someone my relationship has improved. In that case, I'll change my will. So we're saying every 2-3 years, just like you review your other financial documents, have a look at it. It's not a big deal, it's just a piece of paper. Registration of a will is compulsory and a complex process. First of all, registration is not mandatory. लोगों को लगता है कि मुझे कोर्ट जाना पड़ेगा, I have to do a lot of rounds with lawyers. No, आप घर बैठे बैठे अपनी will लिख सकते हो. With platforms like ours, things have become very easy. Like from the comfort of your homes in 15, 20, 30 minutes, will बन जाती है. Registration is a optional process. We recommend आप गवर्नमेंट के पास जाके थप्पा लगाते हो. It's good, it helps your will, but अगर वो नहीं होता है फिर भी it's valid, it's submissible in all courts of law, including the Supreme Court, right? So that being said, that should not be a blocker to procrastinate your want to make a will. So we've spoken about will. There is something else that is doing rounds and gaining some popularity in the Indian families is the private family trust. You would have heard of the word trust, Tata Trust, Reliance Trust, Birla Trust. So a lot of bigger families in India have been making trusts for a long time. Why should a family like mine or yours, a normal family, which is middle class, upper middle class, affluent, so on and so forth, should opt for a trust? See, the trust is a wonderful tool available to Indians to do a secured succession. It is an entity that I'm creating for the safety of my family. It's like creating a private limited company, right? When you create a private limited company, there are board of directors, right? There is someone has a veto right, someone has there's a beneficiary. So in a trust, you are making a company of sorts. You're saying that, okay, my trust will be managed by these trustees, and it's for the benefit of my kids, my grandkids, or spouse, or whatever. So it's made in such a way that it can't be attacked from outside. Nobody can challenge a trust. Okay, once a trust is made, it's made. You can't go back. Someone can't challenge it. When you make it, you can cancel it, but someone else cannot make you, cancel it or remove it. So we are saying trust is a wonderful tool today, and we are making it affordable and accessible to the common folk. लोगों को पता ही नहीं था कि ट्रस्ट क्यों बनाते हैं, किन लोगों को बनाना चाहिए. For example, we say that these are the set of families or people who should make a trust. HNI is affluence, yes, of course, because higher the wealth size, it's more important that they make a more secure succession plan. There are businesses. हम कहते हैं कि if you have a business, you should make a trust so that ownership of the business is well managed in your absence. क्योंकि आप rules लिख के गए हो. I've written the rules that every month only this much money can be used, or annually this much money can be invested in XYZ things. And that rule is applicable to everyone who is in the trust. We are seeing families that have a special child. We've made more than 50 such trusts in India where the family had a special child. When I say special child, someone with a neurological disorder who cannot take decisions of their own. Families are always worried कि मेरे जाने के बाद who will take care of the kid, right? In my presence, of course, I am giving all the love and care for the kid. But मेरे जाने के बाद उतना प्यार, उतना देखभाल कोई कर पाएगा कि नहीं? So we're saying, make a trust, okay? Because when you make a will for such uses, the money will go to a guardian, right? Who may misuse the funds, not for the benefit of the kids, so on and so forth. But when you make a trust, you're creating a very solid structure. कि भाई ये trust है, इसमें मैंने whatever 50 lakhs डाला हुआ है. It can only be used for these reasons, and you can't withdraw money for your own use. So it's a very legally sound structure that helps families in such cases. Minors hai, let's say you have a 5-year-old, 7-year-old, and you want to put it in a trust so that nobody influences that minor. अब किसी बच्चे को guardian रहेगा, guardian can influence the minors that okay, you can put money here, you can put money there. Oh, sorry. Matrimonial disputes. We're seeing a lot of, talks happening these days that people are worried about their assets in case of matrimonial disputes coming along in their lives in the future. A trust is a tool being used by families today where they put money inside this structure, and that money is not theirs anymore, so they are safeguarding their assets. So in the future, if alimony or fights happen over assets, they are safeguarded. तो अगर मैं मेरे पैसे, मेरा whatever properties or mutual funds or anything that I have, I put it inside a trust. It is not mine anymore. It is for the benefit of my kids, my grandkids, my mother, or whatever. So someone from the outside can then not attack on that trust because it's not my money, it's my family's money. So again, being used quite frequently for families in matrimonial disputes. Business owners use it to ring fence their assets, कि creditors पैसे claim ना कर सके, charity, philanthropy. Muslims in India cannot, make a majority of their distribution via will. So a trust is a wonderful tool for them to plan their succession. NRIs is a very, very new thing that we are serving since the last 2-3 years. We are seeing a lot of outflow of Indians, UK, US, Australia, wherever they are going. Now their parents are in India. Okay, what is happening is parents are living in a house. They have some savings, and they say कि मेरे जाने के बाद my kid should get everything. But the kid sitting out there is worried. How will this inheritance affect my visa status? They're worried, okay, my taxes will get affected in the US, I'm on an H-1B visa, or I'm applying for a green card. So I don't want international assets or taxation to affect my status. Similarly, they don't want to come to India again and again, कि भाई यहाँ पे inheritance के लिए legal process जाना है, sign करनी है, again to and fro करना है. So in these cases, we suggest the family to make a trust. What happens is the family makes a trust, they put assets in the trust slowly, and the kid there in the US or UK is the trustee. He can manage the trust indirectly and say that I'm not the owner, I'm managing the trust, and when the trust is finished, I'll be the beneficiary. But right now the trust is just operating in India and I'm managing the trust. So that way they are safe from their international assets or tax, right? Vilgini as a company has been in the space for 10 years. We've been doing this for customers across 480 cities, 32 countries, NRIs. And today we have offices in Bombay, Delhi, Bangalore. Although physical office does not limit us to whom we can serve, but it helps people if they want to walk down to our office. We have 2 offices in Bombay also. So we're a team of lawyers basically who ensure that families get the right guidance. So we're trying to make succession planning accessible and affordable to Indians that way. Vilgini is tied up with the major financial names that you would know. Like we are the official succession planning partner for an HDFC group, a Tata group, ICICI group, Yes group, IIFL. All these are our channel partners, so their clients get their succession plans made via Vilgini. We are their only partner that way. And because of the industry, which is very new in India, we've gotten some love from the media, from the news, media, print, TV, whatever, to cover this topic because families don't know about it. So we're helping drive that also in the country. Yeah, that's about it. That was a quick one from my side. Thank you so much for hearing me out. Do we have time for any questions or are we running short? Yeah.
Check. Do we have any questions?
Yes, sir. Sure. So HUF is the original way where Indian family businesses, majorly so, could ensure that everyone was an equal partner. So an HUF, Hindu Undivided Family, is governed by the rules set by government. So if I have a family of 5 people, everyone is an equal partner in the HUF by law. I cannot change that. And by default, the head or the eldest member will become the karta, as we know. Everyone else is a co-parsoner. Now what is happening is, everyone is not okay with equal distribution. And I can't change that. So a family trust is, I would say, like a HUF on steroids, right? Because the government is giving me the leeway to make changes. That, okay, this person will be a beneficiary of only this much. This person can withdraw only, let's say, 1 lakh rupees from my trust every month or every year. So I can set up rules in a trust deed, which is admissible in court of law and has to be followed. We are saying that it's a much better version of an HUF. And now with more people coming to know about it, like recently in Mint also, there was a good coverage that was done by Mr. Neil on the taxation for HUF. A lot of people feel that there are a lot of benefits with HUF taxation. But we are saying the difference is so nominal. I would consider taxation as a neutral thing, because the whole plan of the person is to ensure transmission of wealth, no fights in families, things like that. So if taxation or saving 1 lakh rupees in the entire transmission process is the goal, then you're mixing things up. The goal of the family should be that I'm creating a structure which helps the family, because everyone wants independence. मैं बोलूँगा सब लोग equal है, you have to listen to the head of the family. I don't think it works in today's time. They all feel, okay, we'll be whatever percentage, but we should all have a veto power on how things work. We should sit and have a consensus. So these ways a trust deed really helps. It gives a lot of flexibility in terms of transmission.
We will not be taking any more questions as of now. We have lunch after 5 minutes and the networking session. You can ask your questions personally to Mr. Popper.
I'll be right there in the corner of the room if you have any questions. Thank you so much.
All right.
Thank you.
To felicitate Mr. Jugal Popat, I would like to call Mr. Harsha Pai on stage. I am pretty sure, and I can see it in everyone's faces, that you all are hungry, and I know you want to have lunch, but I promise from my side, this is going to take 5 minutes of your time. This event that we're having today, it would have not been possible without our investors. And I would like to call upon stage our investors to felicitate them. Firstly, we have Mr. Harsha Pai and family. I also request Mr. Jugal Popat to kindly felicitate them. Can we have a huge round of applause for Mr. Harsha Pai and family? Next, I'd like to invite Mr. Ankur Tayal on stage. Do we have Mr. Tayal here? No? All right, moving ahead. Mr. Harshvardhan Shah. Mr. Milap Kaur. I'm pretty sure everyone's hungry. Mr. Rahul Trivedi. Can we have a huge round of applause for Mr. Trivedi? Thank you so much, sir. Mr. T.C.S.M. Gupta and Mrs. Sarita Gupta. Could we please have a huge round of applause for them? Mr. Sudipta Chatterjee. Saitra, you can also join us. And last but not the least, Mr. Manik Goyal. We have a round of applause for Mr. Manik Goyal. Your continued support and partnership inspire us to strive for excellence. And as I promised, 5 minutes, you can all head for lunch. Thank you so much. We'll see you back in an hour.
So just a small request. We have got a lot of our college seniors from IIT Delhi and IIT Roorkee over here. So if they can come on this side of the hall, we'll take one group photograph. All the IIT Delhi and IIT Roorkee alumni, please. Thank you.
Check, check. I request all the guests to please settle down. We'll be starting in the next 10 minutes. Thank you.
Hello, hello. I request everyone to please settle down. We'll be starting in 5 minutes. Can you please get me a tissue? We will. Hello, hello. Hi everyone, I hope everyone has enjoyed their meals. I'm Saki Babari and let's move forward with the event. The financial world is evolving and quantitative strategies are redefining traditional investing. How can investors leverage data-driven models to enhance returns and manage risk effectively? To explore this, we have Mr. Sharvan Goyal, Fund Manager and Head, Passive, Arbitrage and Quant Strategies at UTI AMC. With 16 plus years of experience in risk management, equity research and fund management. He has played a key role in developing systematic investment approaches. Joining him is Mr. Sailesh Jain, Fund Manager at Tata Asset Management with 20 plus years of expertise in fund management, broking and derivatives. Having led institutional derivative desks and worked extensively with quant-driven strategies, he brings deep insights into how these models are shaping investment decisions. Together, they will help us understand how quant-based investing compares with traditional investing strategies and it means for investors in today's markets. Let's welcome Mr. Sharvan Goyal, Mr. Sailesh Jain, and Mr. Aditya Gupta on stage.
Thank you, both of you, for joining in us today. And it's a very popular topic, the world of quant. There's an entire AMC about it and a lot of news. But not many people understand what goes behind these quantitative strategies. So let us understand this better in this session. My first question is to Shravan. You manage an active quant fund. And you've recently launched this. Can you describe the strategy of this fund and how do you differentiate this fund from your other active funds?
Thank you. Thank you, Aditya, for having me here. And I'm delighted to see such a large audience paying attention to so many topics. So quant is a very wide area. Anything which is using quantitative models, algorithms, or statistical analysis to prepare portfolio is called quant strategy. So there are three broad approaches to portfolio construction. Fundamental way of constructing portfolio. Second one is quantitative way of portfolio construction. Third way is technical way of constructing the portfolio. And in the sense, to some extent, fundamental and quant are linked to each other. So we believe that quant is an alternate way of constructing the portfolio. And it's not a direct competition to fundamental way of portfolio construction, because to some extent, even fundamental based portfolio construction use some kind of quantitative techniques to design the portfolio and construct the portfolio. We at UTI are, in the sense, UTI Quant Fund looks at quantitative way of portfolio construction based on factor analysis. If we look at longer term performance of the market, then we will see that there is a lot of cyclicality in performance of these factors. The 3-4, in the sense, very well known factors are momentum, quality, value, low vol. So UTI Quant Fund dynamically allocate money across these style factors based on performance trends of these factors in different equity markets environment. So there's a top-down allocation across these factors, and stock selection is bottom-up based on factor ranking. So let me dwell a bit on these two elements of portfolio construction. As I mentioned earlier, there's a lot of cyclicality in performance of these factors, right? For example, post-pandemic, we have seen that there was very strong value cycle. While prior to COVID, there was very strong quality cycle from 2017 to 20 period. And the return gap in such cycles is extremely huge. So in last 4 years, from October 2020 to June 2024, which was extreme value cycle, value style delivered 450% absolute return in a market which has delivered just about 120% return. 4x returns for value as compared to broader market, right? And post which we have seen that in last 6 months, in a slightly difficult macroeconomic environment, quality style started performing very well. So we use two decision tree, which are quality value indicator and momentum low vol indicator. And these two decision trees are decided based on longer term performance track records of these factors. And based on that, we construct the portfolio. As I mentioned earlier, it's an actively managed quant fund. So the portfolio stock selection is basis UTI coverage universe. So we have 14-member research team, which tracks about 430 companies. And out of these 430 companies, we remove about 20-25% companies based on liquidity, size of the company, as well as governance of the companies, and then select companies basis these style factors. So basically, because of cyclicality in factors, we keep changing allocation across various factors. So currently, our model is suggesting about 70% allocation to quality style, which was struggling in last 4 years, about 20% allocation to low volatility style, which is a defensive style and perform much better during tight equity market environment, and remaining 10% allocation towards momentum style.
Yeah. Thank you so much. And then these factors keep on rotating. And not many people understand that when we talk about hybrid funds, and we have been shifting our clients' portfolios towards hybrid almost from the last odd year. And there's a lot of quantitative strategies used for the asset allocation, to determine asset allocation. And majority of the AMCs are using some or the other kind of model to determine asset allocation. And Sailesh, you have worked extensively on the passive and hybrid strategies. And you use an asset allocation model in your equity savings fund. So can you describe the model used to determine the asset allocation? And what was your asset allocation 6 months back, roughly around September versus now?
Fair. So thank you team Wealthy Nivesh for having me here. Good afternoon, audience. And thank you for giving me this opportunity and hearing me out. So let me start with what we are talking about, two different funds. One is the Balance Advantage Fund at the moment, which is also a part of the hybrid, and then we are talking of the equity saving fund. Now in Balance Advantage Fund, what we did was that when we were launching this fund, this was way back in 2019, we realized that most of the Balance Advantage funds were working on the PE model. What we realized was that when we were only working on the PE model, there were a lot of flaws in that. Either people were using the trailing PE or they were using the forward PE. What I was interested with the job of finding a way which will actually ensure that these things are taken care of. I came up with the idea of creating two models on which will define the equity allocation for the fund. The first model was basically the PE-based model, but what we did was that we took the average of the forward and the trailing PE. Now, by doing this, what we did was we eradicated the problem of the trailing PE when the valuation always look stretched in a growth market. And also, while averaging out the forward PE, we also took out the exuberance out of the market, because whenever the markets looked where the earnings will start depressing, the forward will always look cheap. So when you average that out, it actually takes care of both the things. What we did was that after creating that, we created the bands. So once you have the PE model defined, you have the equity allocation bands around it. So let's hypothetically case that current PE is at around 21.2. So what we have done is that anything about 21 PE will be a 40% equity allocation. Anything which is between 19 and 21, the equity allocation goes up to 50%. So here the band changes, which means your equity allocation increases by 10%. This band is very well kept, is easily available on our website for everybody's perusal. What we also realized that above and over and above this model, we needed something which captures the momentum in the market, right? Typically, the momentum is on both sides. Whenever the market is in rally, it extends the fundamental or it goes beyond the fundamental. When the market corrects, it actually goes beyond the fundamental sanity levels, right? So here, if you really see now what we are into phenomenon where there is too much of fear in the market, right? Just 3 months back, 4 months back, there was too much of exuberance where everybody was thinking that there is no way into the market. So the point is that we realized that we needed a model over and above this, which will also capture those things. So what I did was that, I mean, hypothetically, I'm sure everybody, when everybody gets up in the morning, the first thing, it doesn't mean that you get up in the morning and just check your mobile. The point is that the first thing what you look before starting or watching the Indian equity market is basically how the world markets have behaved, right? The first thing you will look, any of the website you will see. The second, you will start looking at that, how has been the volatility in the market. And the third, if everybody are quite proficient, then they will start looking at the charts, that how has been the momentum in the market, right? So what we did was that I realized that these are the most important things. What I did was that I captured all these commonsensical things into a model and objectified it with saying that how much equity I need to add if these things are correcting. So basically, I just objectified this thing, and what I get was that I add 10% equity over and above the PE model, or I cut 10% equity over the whatever if the PE model has been decided. So let's hypothetically case that with the current PE, the model says that 40% equity. And the model part B is saying that I don't think it's the right time for you to invest because global markets are not doing well, whereas it's actually the other way around where global markets are doing very well now versus India. But the point is that if the model B says that you need to add 10% equity because global markets are doing well, volatility is in control, and your momentum indicators are indicating that sort of you are sort of very near to the bottom, or you're sort of, so you will add another 10% equity. So if your equity P model is saying 40% equity, you add another 10%. To put it simply, 70% of the equity allocation return comes from the P band, 30% of the return is coming from the model B. So the model B is actually as important as the model A. This is what the BAF model was based on. To be very honest, this is also a model which actually gives us indication as far as all other funds are concerned in terms of the equity allocation. Now this is for the BAF. BAF honestly has done very, very well for us from 2019 when we did the NFO. We collected around 600 crores in the NFO. Today it's a 11,000 crore fund. So in 5 years, we have reached to this, and clearly the equity allocation worked very well and the equity selection worked very well for this model. Now coming back to the second question, which was the equity saving fund. What we have done in the equity saving fund was that if you really understand, equity saving fund is actually a phenomenal asset allocation fund. It takes care of a lot of issues which everybody would be facing individually. Now, put it simply that what is this fund all about? This fund has 3 different sectors into it, or 3 different parts to it. One is that you have a net long equity, you have arbitrage into it, which includes the cash future arbitrage, and you have the commodity arbitrage. The third part is a debt portfolio. Now, so what we have done is that we have restructured this fund with saying that at any point in time, we will have only 20% net long equity. 20% net long equity. The balancing figure to make it an equity fund, which is a 45%, which you need to make 65% equity, we will do arbitrage. Now, so basically, let's put it simply, a second allocation will be 20% net long equity, 46% will go into your equity arbitrage. That makes it an equity fund for all equity taxation. The balance is the balance is basically the option to select between a debt and a commodity arb. So if your commodity arb, which I think we are the only fund in the whole industry who is enabled to do commodity arb, which includes agri and non-agri. So the idea is that if my commodity arb is delivering me better returns than the debt, then we will put money into commodity arb. At the moment, we have close to 5 to 6% of our money into commodity arb. Commodity arb was delivering anywhere around 9 to 10% arbitrage returns, whereas debt was giving me 7% return. So we deployed money into commodity arb, and the balance will go into debt. The point is that why this fund is superior, because this fund, the objective of this fund is, one, to deliver better returns than the arbitrage funds, and two, in terms of risk and return, it is one notch below the balance advantage funds. So if you really see the ladder up, you have arbitrage funds, which are typically the risk-free funds. Then you have the equity saving funds, and you have the balance advantage funds. So for us, if you really pick the equity saving fund, hypothetically, if the market does a 10% or 12% CAGR return, which has been the historical return for this fund will deliver anywhere around close to 9% return. So the linearity of the return is very, very good. If hypothetically market corrects another 10% from here, okay, this fund will still deliver a 4% positive return. So what I'm trying to say that this fund has significant linearity. One, it has the arbitrage angle to it. Second, it has a touch of equity, the net long equity. So if market does well, if market does 20%, it will even give you a 12% return. So the point is that this is one fund which is a very linear fund. Typically, almost virtually as little risk as you can think of. Even if market corrects by 10%, it still delivers you a 4% positive return. If market goes up by 10%, then you will definitely make an 8-9% return on this fund. So it is a very good fund for people who are keeping money into your saving banks, or they are keeping money into FDs. This fund will deliver you a FD plus 1% return. And this is with the tax advantage. So your taxation will be short term, which will be around 20%, and long term will be around 12%. So it has a tax advantage also. Post tax, this will be way better than your FDs.
Thank you so much, Shailesh. And Shravan, Shailesh touched about the momentum factor. And you also talked about momentum, quality, value, low vol. And currently your model says 70% on quality, then on low vol, and then 10% on momentum. And we have seen momentum used very frequently in the market. Can you explain for the benefit of our audience, what do we mean by momentum? And it has been, if we see there is enough academic research, enough data, that momentum has been the most consistent factor over the last 30 odd years. My question is in two parts. What is momentum and why have we seen the most correction in momentum stocks over the last 6 months?
See, momentum is basically a trend investing. In a trending market, when markets are consistently performing well, stocks which have performed well in recent past continue to perform well going forward as well. So momentum is based on the hypothesis that whatever has worked in the marketplace in the recent past, the same hypothesis or same set of stocks will continue to perform well in the medium to long term perspective. So it's based on that particular hypothesis. Generally in a trending market, momentum strategy perform exceedingly very well. If you look at longer term performance track record of momentum strategy in India as well as global market, then we will find that momentum strategy is able to perform consistently very well from longer term perspective. Although whenever market trends reverses, typically momentum strategy underperforms as well. And that's what we have witnessed in last 3 to 4 months period. Mr. Eugene Fama, who is Nobel laureate and father of efficient market hypothesis, he mentioned that momentum is an anomaly to efficient market. Typically in an efficient market, various styles perform well in a different market environment, but they all converge from longer term perspective. But because of consistent better performance of momentum from longer term perspective, he coined this particular word, that momentum is an anomaly to efficient market. The reason for momentum doing well could be multiple. So a couple of reasons could be, generally whenever a particular company reports good results, generally market underreacts to that better performance or even on other side as well. So market will keep on rewarding that particular company as and when that company continue to perform well, right? And because of that reason, generally momentum holds on to the performance. Second, as we look at style shift from one style to another, there is a typical 3-year cycle. As I mentioned earlier, in last 20 years, if we draw market cycles in India, typically every 3 years market cycles are changing. First 3 year value is doing better, next 3 years quality style is performing well. And then it keep rotating every 3 years. They could be 6 month plus minus gap, but typically there is a 3-year cycle. Momentum is agnostic to any particular investment style. It is neither linked to quality, neither linked to value. Whichever style is working well in the marketplace, it will shift towards that segment of the market. And because cycles are playing out over 3-year period, so momentum will also ride on that particular momentum till the time that particular style continue to perform well. And because of this reason, momentum strategy is performing very well. There is a macroeconomic element to this as well. Generally, there are 4 macroeconomic cycles, 4 macroeconomic regimes. First one is slowdown, then initial recovery, then you have maturity phase, and then extreme rally, right? Generally, momentum strategy underperforms during slowdown and recessionary kind of environment. And because of steady macroeconomic environment in India, we never talk about GDP growth being less than 4% in India. While developed markets such as US and Europe, they go through recessionary phase as well. Because we don't have all 4 cycles, pronounced 4 cycles, so that's why momentum effect is much more pronounced in India. And generally, momentum strategy is performing much better in developing countries as compared to developed countries, mainly because of this particular element. As you rightly asked, that in last 3-4 months, momentum has gone through difficult phase. Because after 3 years of very strong rally in the marketplace, the market momentum has reversed in last 3-4 months, mainly because of changes in macroeconomic environment. And because of that, momentum strategy has underperformed. So in the sense, every now and then, whenever market trends are reversing, in that kind of environment, momentum strategy has tendency to underperform. But as and when market trend establishes again, then probably momentum strategy could ride on that momentum going forward as well. So no strategy can give you 100% results. So that's why generally we advise people to combine counter-cyclical factors. So to get steady return across different market cycle, if you combine momentum and low volatility strategy, which is counter-cyclical to each other, generally your results are much more steady and consistent as compared to investing in a single style. Because no style can give you consistent alpha across different market cycles. So either you have to understand the market cycle and accordingly build your portfolio and keep rotating the portfolio the way we are doing in UTI Quant Fund, or other way is to invest in 2 counter-cyclical strategy so that you are not getting exposed to a particular cycle in a very big way.
And Shravan, you talked about shifting from momentum to quality. So are there specific conditions where you rotate these factors? What made you choose rotate these factors?
Because these factor styles are extremely cyclical in nature, right? Every 2-3 years, they keep on changing. If you keep on holding one segment, then whenever that style is not performing well, then in that period you go through difficult phase, right? To ride on that particular element, we have through two decision tree, which are quality value indicators and momentum low vol indicators, we have studied past market cycles and then identified common link among these factors. And accordingly, we are changing allocation across these factors. Typically, there is a 3-year cycle. So at the back end of cycle, my model starts signaling that now it's time to shift gears towards other style which is underperforming in a big way. So for example, value style was doing very well from October 2020 to June 2024. But about a year back, my model started signaling that now value style has performed significantly very well. Valuations are expensive for this style. So now it's time to shift from value to quality. So our model started signaling shift from value to quality about a year back. Whether one can time to the perfection, answer is clearly no. Nobody can identify shift in style. But whether one can predict the cycle from next 2-3 years perspective, answer is clear yes, that typically styles change every 2-3 year period. So our ability to predict what is going to work well from next 2-3 years perspective is much more better as compared to exactly pinpointing when styles are likely to perform well. So we are more or less using mean reversion characteristics in these styles and accordingly changing allocation across these factors.
Sure. And you both have worked extensively on the passive strategies at your AMCs. And there's always a debate of active versus passive, particularly in US when we see there's a big passive market. And there's always a risk of overcrowding in strategies. So if there are too many active fund managers, then passive would do well. And then if a lot of people are allocating in passive, then active fund managers would do well. How do you see the passive strategies and the smart beta strategies market developing in India? And is it at nascent stage, or it's just coming up, or we are growing at a good pace? So, and how do you see a debate between active and passive in India?
Okay. So actually a very good question, and why this is actually a question which keeps on coming time and again, and I think this will continue till I think everybody's alive. So honestly speaking, what are the advantages of passive, right? Let's put it simply. And to be very, very honest, Indian people, or rather people in India who are investing now, have started accepting newer passive funds, right? The first, let me start with what are the advantages of passive, right? One, there is no emotional bias in a passive, right? Absolutely no biasness. If a particular stock sector is, if there is a particular fund which is dedicated to a particular sector, you put money into it, it will straight away invest into the stock. It doesn't care about the valuations, where the stock is, what is it right time to invest? So absolutely no human bias, which is actually very good in turn. The second part is that no management has a view on that, okay, whether I need to add this stock, eliminate this stock, absolutely out of it. The third part, what I want to say is the cost. The cost is substantially lower, right? I mean, in a normal active fund, you will be charged at 2.25% on your AUM fees, right? Here you will be anywhere around 50, 60, 70 basis points. So if you logically see, if this fund you invest for another 10 years, okay, let's put it simply, you will be typically paying a 20% only on the average TER on this kind of active funds, whereas in a passive fund you will be paying close to 7%. So your 13% actual net return only comes from the management fee. So the idea is that this kind of debate will keep on coming, but the point is that passives what is happening is, where people also make one mistake, is that they jump into the passives without being the guidance of the advisors. The point is that you can invest into a passive fund, but you need guidance on understanding what is required and what is not required. So it is very easy to blame a passive fund at any point in time if your investment thesis itself was not correct. So if you are guided by a person, whether you invest, so assume, let's take a hypothetical case that today I want to invest in a mid-cap fund. Now I have the option of investing into an active mid-cap fund or a passive mid-cap fund. I will be theoretically correct in both of the places, right? Some will deliver 10% higher or 5% higher return than this fund. The point is that, was my trend in selecting mid-cap was correct or not, is what the question comes in. In a point when your large caps are doing well and I invest into mid-cap, either active or passive, I'll still lose money. So the point is that is very critical in when you have to select. But coming back to passives, the beauty is that the cost remains very, very low. And the good part is that the human bias or the emotional bias is out of it. Now, what is also important for us or what we have done in Tata is that we have launched multiple passive funds, which includes your sectoral, typically like, let's take a tourism fund, right? So we are the only one in the industry who have launched a tourism fund. Now in India, the tourism is growing by leaps and bounds. Mahakumbh is a classical example of what's happening around, right? You have 40 crore people visiting. If the number is correct, then you are almost like you have every third person, leaving person has actually visited Mahakumbh. The point is that tourism, if you really see how the hotel rates have moved in, Taj, if you really go, there is no Taj which is available at 10,000, lesser than at 10,000 on an average, right? The ARR, I'm just saying. The number of luxury hotels which have gone up, your travel has gone up, the number of airports which are coming in. So typically, what I'm trying to say is that this is one index. If you believe that India is going to grow, then this is one index you can invest. Now, this is an all-time season. We also have another passive fund, which is like a capital index fund, which is just straight away related to capital markets. If markets in India is going to do good, irrespective of whether where the market goes, if the interest in the market remains, the interest in the passive funds remains. So here, what I'm trying to say is that a lot of passive funds have been launched, which with a different sectorial approach, and those will remain. Those will continue to see interest. So yes, this debate will continue that passive and active overcrowding will always be a question whether overcrowding will run. But the point of overcrowding also remains in active fund. The point is that if a particular sector like railways and defense were doing very well, everybody was jumping into railways and defense, right? The point is that overcrowding will also remain in active fund. It will also remain in the passive fund. The point is that being in which sector or being in which space is more critical than actually thinking whether active or passive at the moment.
So just to add a couple of more perspective, see, active and passive are both same sides of same coin, two sides of same coin. So whether you have to select the right product, be it active or passive. One should not get carried away by past 2-3 years returns. As I mentioned earlier, market continue to go through different cycles, and in different cycles, different segment of the market continue to perform well, right? So one advantage of passive is while buying, you know what you are buying in advance. So just simplest passive fund is Nifty 50 index fund. When you are buying Nifty, you know you are buying top 50 companies which have stood test of the time, right? Similarly, these factor strategies have come in a big way in last 5 years. So, but rather than getting carried away by past performance of these strategies, you should understand market dynamics and try to understand in which kind of market environment, which factor strategy could help me generate better return. Typically, in a very strong macroeconomic recovery phase, value style perform exceedingly very well. Because coming out of recovery, generally starting valuations are cheap for value style, and then from that, in a recovery phase, generally the earnings growth for these cyclical companies are much more stronger. So generally that segment perform very well during recovery phase. When we look at difficult market phase, then typically quality and low volatility strategy perform much better. Just to give you one example, on 1 year rolling basis in last 20 years, whenever markets have corrected, low volatility strategy has corrected 10% lower as compared to broader market. So which means that in a difficult market environment, this strategy performs much better as compared to any other style. So you have to understand the market dynamics and then accordingly keep changing allocation across these factor styles. Or another way is the way I have described UTI quant fund, wherein based on, in the sense, cyclicality of these factors, we keep changing allocation across these factors. So you have to either determine which factor is likely to perform well in the next 2-3 year period, rather than getting carried away by past 2-3 years, because cycles keep changing every 3 years. The worst way of selecting fund is selecting best performing strategy without understanding which style that particular fund is following. So one should pay attention to these elements while portfolio construction.
Correct. And now come to a relatively less understood topic, and particularly very relevant for this audience, about arbitrage funds, and you both manage arbitrage funds in your respective AMCs. My first question is to Shailesh, if you can explain what is arbitrage in simple terms to our audience. You also mentioned about commodity arbitrage, but what is arbitrage? What does it mean? And how does it act as an alternative to fixed income?
Right. So yeah, so I think let me take through in a very, very simple term. To start with, am I audible, right? Okay, so let me start with simply arbitrage in a very, very simple academic term is a riskless profit. And what do I mean by riskless profit is, let's take in a very, very academic, that if you are, is everybody from Mumbai? Or, okay, so forget about Solo. Let's put it simply that you buy from an X market in India, and you sell in a Y market by making a profit. So let's take, if you're buying an apple in an X market, and you're selling and we are not taking the transportation cost and all, okay, we're just excluding that for the moment, and you sell the same apple in a Y market and by making a profit. This is nothing but a riskless profit, okay? In a very academic term, this is an arbitrage. Now, in an Indian context, okay, in an Indian mutual fund, what does it mean? It means that what we hypothetically do is that we buy equity shares of, let's take we are taking an example of a Reliance Industries, right? So Reliance Industries, we buy 100 shares of Reliance Industries at an X price, and we sell 100 shares of Reliance Industries futures. So basically the underlying, which is Reliance, remains the same. So you buy equity shares of the same stock, and you sell equity share of futures of the same stock. The futures could be either the current month or the next month. For simplistic, we'll keep the same month. Basically, so if we are in the February month, we buy the equity shares of Reliance and we sell the futures of the February. Now, if you really see, there is always a premium. Basically the difference. And what is premium means? The future will always trade higher to the cash. And why it trades higher? Because it works on the principle of interest rates. Now, why it works on the principle of interest rates is that in a future, you only pay margin. Okay, you don't pay the full amount to buy the lot. I think if everybody's traded futures, they will know that when you buy a future lot, you only pay the margin. That money is kept in the bank, that earns you interest, and that interest is nothing but the premium on the futures. So basically, the whole theory of explaining is that there always be a future should always be at a premium to the spot. Now, these futures, because you have physical delivery, which means that if you are a long future or a short future, you will either have to take delivery and on the expiry day, or sell delivery, okay, or give delivery. So let's take how the trade is settled for us. We are long equity shares, we are short futures trade. Okay, this trade, when we do the trade, we make money because the difference is basically already locked in. Now, if the price of Reliance goes up, we make money on the equity shares, we lose money on the futures. If the price of the Reliance goes down, we make money on the futures, which we are short, and we lose money on the equity. Now, why I'm trying to say is that there is absolutely no price risk, which means that we make money on one segment, we lose money. The difference between the cash and the future is our profit, which remains intact. Okay, once you have set the trade, the profit is locked in, your profit is intact, it is realized on the expiry day. On the expiry day, what happens is that because it's a physically settled, your futures will settle where the spot is, which means where the equity shares trade in, which means whatever profit you have captured or the difference you have captured between the cash and the future or the equity and the future is your locked in, and you make that money end of the day. This is absolutely how an arbitrage fund makes money in Indian context.
And also, are arbitrage funds in India allowed to take any net equity exposure? Just
okay. So let me put it simply. And again, sorry, I forgot to. I'll answer this question. But on the equity, on how the portfolio is constructed, if you invest 100 rupees into your arbitrage funds, and why these funds are comparable to debt funds, I missed that out. Okay, is that the first 22 rupees will go into your margin money. This is money which is kept at the exchange against your futures position. Then you have the 65% minimum, because it is an equity fund, taxed like an equity fund. You will need to maintain minimum 65% into your equity shares, your money. So your 65 to 70% of your money, depending on the fund manager, will go into the cash future arbitrage activity. The balance is kept into the debt. This is how the portfolio is constructed. Now, why these funds are superior to the debt fund? One, it is equity taxation. There is a tax arbitrage in these funds. Two, there is absolutely or virtually no risk in this kind of funds. There is no price risk because your positions are completely hedged right from the day of initiation. Long is hedged with the short, or the short is hedged with the long. So typically no price risk. The profit which is captured is your absolute profit. This will be realized at the end of the expiry. There are times when you can even realize profit before the expiry if the spread moves here and there. So here, if you compare, these funds are comparable to liquid and ultra short in terms of your risk and return. But they are superior in terms of return profile versus both the funds, because one, at the moment, the absolute returns are higher, and second, there's a tax arbitrage. So tax advantage is significantly. If you are holding a debt fund, you need to hold minimum for 3 years to qualify it for a long term, whereas in an equity fund, your holding period is only 1 year. So your differentiation is substantial when you are holding an arbitrage fund for a year and when you are selling a debt fund within a year. Now, the third part of the question was that you asked
So that was the question, that about arbitrage funds and why they are. comparable to the debt funds.
Right.
And now,
Sorry, on the open position. So no arbitrage fund in the industry at the moment takes any open position. At least for Tata arbitrage fund, I can assure you for the fact that we have never taken a single open position. Neither we will ever have a single open position. For us, it is very clear. The trades are completely hedged right from the very minute the trade is done.
Correct. And Shravan, as Sailesh mentioned, there is no price risk. But there is some kind of risk in the volatility of the returns. So what drives the return in the arbitrage funds? If you can explain that.
Sure. So as Sailesh mentioned that arbitrage funds are completely hedged at all point in time, which means that even if market corrects 10%, you will not generate negative returns on arbitrage fund because always same number of shares are bought in cash and same number of shares are sold in future. Typically, arbitrage funds perform much better during bullish and volatile equity market environment. The reason being, in a bullish equity market environment, people who want to take long position, they do through futures and they don't mind paying slightly higher spreads to arbitrage funds because as long as they make money in futures or in the sense as long as they keep making money in a bullish market environment, generally spreads are higher because demand supply is in favor in such market environment. Second, generally in a volatile market environment, in the sense, the churning opportunity from one stock to another stock is much better. Because in a volatile market environment, some stocks could be witnessing lower spread in futures, some stocks could be having higher spreads. So in such cases, we exit position wherein spreads are lesser and get into other stocks which are offering higher spreads. So generally, bullish and volatile market environments are much more better for arbitrage funds as compared to continuous weak equity market environment.
Thank you. And if people are confused with a lot of jargons, I would just simply put it, arbitrage funds are particularly for individuals who come under higher tax brackets. It becomes a post-tax better alternative to your fixed income products. And because it comes under equity taxation. So simply put this way. Thank you so much, Shravan and Sailesh.
I just want to add one point with the arbitrage fund. Every budget, there is always a discussion done that it will be taxed, it will be out of. I want to add that if you really read the budget document, 77,000 crore is the estimated STT collection by the government now. There is no way they can, logically they should not tax the arbitrage fund. It's a significant contributor to STT.
So there's always a debate with banks and the AMCs. AMCs want their products to be more tax effective, while banks want their products to be more tax effective. So that this debate goes on. Thank you so much, both of you. If we have any questions from the audience.
Yeah, hi. Either of you can answer. In your passives, how frequently do you rebalance, or the industry, how frequently does it rebalance? Is it monthly, quarterly, half yearly? And is that an important factor to look at for an investor while taking a decision?
I'll take it. So typically for most of the passive funds, rebalancing frequency is on half yearly basis. So simplest passive fund is Nifty 50, wherein this particular index is getting rebalanced on half yearly basis. So every year, March and December end, this particular fund is getting rebalanced, or this particular index is getting rebalanced. The logic for rebalancing is whatever essence that you are trying to capture through this particular passive fund, that keep changing. The fundamental data keep changing. So let's say in case of momentum strategy, you want to capture the essence of what is in momentum in recent times, right? So that's why every 6 months you are screening stocks based on best momentum strategy, and then likewise keep changing the portfolio. So typically most of the indices are getting rebalanced on half yearly basis. Some of them could be getting rebalanced on quarterly basis, but generally the proportion of such funds is much lesser as compared to funds which are getting rebalanced on half yearly basis.
And this frequency is set by the exchange, by the index launched by that particular exchange.
Absolutely. So in the sense, all the passive funds are constructed by index providers. Aim of AMC is to replicate the benchmark so that the fund generate returns which are very close to the benchmark. So that's the aim of any passive fund manager.
And one point that I want to put in, and I always want to communicate to all my investors, is that particularly in mutual funds and index funds, if they are rebalancing on their own, there is just transaction cost. There is no capital gains cost there when the mutual fund or an index fund is rebalancing. But when you are replicating it in a PMS or when you're replicating in your individual equity portfolio, you have to pay capital gains tax every time you rebalance. In mutual funds or an index funds, you have to pay tax only when you redeem the units. The internal churning of the fund doesn't get taxed. There is only transaction cost. So it becomes a lot more tax effective alternative when you're investing in an index fund or a mutual fund.
Absolutely. Just because of this feature, you can cover your cost.
Thank you so much, both of you. Thank you.
Thank you so much, sir, for the wonderful discussion. Now I would like to call Mr. Rajesh Sheth on stage to felicitate Mr. Sharvin Goyal and Mr. Sailesh Jain. Can we have please Mr. Rajesh Sheth? Yes, thank you. Thank you, sir. Thank you. Let's take this forward. Wealth creation is evolving beyond traditional investment avenues, with high net worth investors seeking portfolio management services, alternative investment funds, and gift city opportunities to enhance returns and diversify globally. These sophisticated strategies demand expert insights. Leading this discussion is Mr. Brijesh Ved, EVP and Head of PMS at Kotak AMC, who brings over 20 years of experience across asset management, alternate investments, and financial consulting. Having worked with ANAM, BNP Paribas, and KPMG India, he has a deep understanding of managing risk while maximizing growth potential. Joining him will be Mr. Bhisham Rathi, a finance professional with 18 plus years of experience in sales, mutual fund distribution, and advisory for corporate treasuries, family offices, and trusts. Before joining ABSL, he played a key role at Man Financial Securities, promoting commodity and forex trading on international exchanges. He holds a master's in international business from KJ Somaiya Institute of Management Research. Let's welcome Mr. Brijesh Ved, Mr. Bhisham Rathi, and Mr. Aditya Gupta on the stage.
Thank you, both of you, for joining us today. And this is a topic which excites many people. There are individuals in the audience which are very experienced investors. They have been investing into sophisticated asset classes, product classes. But there are individuals who have not explored a lot of product classes apart from mutual funds. So that's why I would start with a very basic question. I would start with Bhisham. What is a PMS? What is an AIF? And how are they different from mutual funds in terms of product structure?
Okay. Thanks, Brijesh. And thanks a lot for giving us an opportunity to share our perspective on this. And so, so PMS is portfolio management services, and AIF is an alternate investment fund. The whole idea is basically, the way we evolve and all, we start looking at it somewhere that if I can have a luxury of, kind of okay, so let's put it, AIF and PMS is like a, from the mutual fund perspective, it's a benchmark agnostic product. So if I look at it, a mutual fund, they have certain bindings, certain constraint that they have to have a long tail of the portfolio, that they have to, the theme, they have to align to that theme. They have certain constraint in terms of the, benchmark hugging. The portfolio management should be benchmark hugging kind of a thing. Whereas when I look at the PMS, so PMS is like a customization to the core for the investor, depend upon his risk appetite, depend upon his, kind of a holding period and all, we can design the product both on equity and debt. When I say AIF, somewhere it has a certain feature which is related, which is being borrowed from the mutual fund because it's a unit-based product. But parallelly, it has certain merits which is on the PMS side. That is, that it has a relatively concentrated portfolio than any of the mutual fund and all. So these are the two broad differences if I want to put across.
Yeah. Thank you so much. And Brijesh, when we talk about AIFs, alternate investment funds, there are 3 categories of alternate investment funds. If you can explain what are these 3 categories, what kind of asset classes they invest into, and particularly in a category 3 AIF or a PMS, what does a fund manager can do differently than a mutual fund manager can or cannot do?
Sure. So first of all, thank you. Thanks for having me. Good afternoon to everyone. Just to, explain in simple terms about the alternate investment fund, 3 categories as we know. Category 1, which essentially represents the entire venture capital opportunity. Now, as you know that, a lot of large family offices, large investors do venture capitalists through their own family offices. But, as investors, when we want to kind of, participate in companies at an early stage, category 1 is one category which offers us this flexibility to essentially participate in early investing. So I think, that's one of the primary kind of, vehicle which is used in category 1. Apart of that, there are a lot of funds which are dedicated towards socio-economic purposes, etc., which also is categorized under category 1. Category 2 essentially represents multiple facets of AIF, including, the credit funds, where, if people or investors don't want to invest directly through a mutual fund route or through a bank route and want to have a little bit higher risk appetite when it comes to allocating their fixed income allocation, the credit funds come into play specifically in category 2. A part of that, there are a lot of opportunities around, structured products on real estate, etc., which will also come under category 2, where, the fund manager will typically design a structure through NCDs and understand the businesses before investing on behalf of, investors. Cat 3 is one which is actually, scaled up quite a bit, and, that's one of the most scalable product within the AIF so far, is what we have observed. Now, category 3 essentially represents, and again, for that particular category, the minimum ticket size being 1 crore as prescribed by the regulator, also brings in investors who, who've had experiences in the equity markets over a longer period of time. It essentially represents 2 broader categories. One is long only, where, it's a pure plain vanilla, equity exposures that, fund managers will take. The second category within the category 3, and, these things are defined by the fund in the PPM when, the fund is actually, comes in for an offer, will be a long short. Now, we have all heard about, hedge funds. And when we talk about, globally hedge funds, these are the funds which actually, not only take a call on the market basis, being long on equities, but they also take calls wherever there are pockets of opportunity to short certain kind of, sectors or, specific companies. This long short category within AIF essentially represents the hedge fund category, which is what, globally it is known as popularly. The other part of your question was on PMS.
Fund manager, what he can or cannot do.
What he can, within the, let's say, category 3 AIF, which is, long only, as well as, long short and PMS versus a mutual fund. I think the key difference in my view, of course, it depends on the mandate of, each and every fund. But, I think the broader difference in my view is the execution capability of the manager. So, as we know that, the moment we buy a mutual fund product, we essentially bought large part of the existing portfolio, plus, incremental cash that we are contributing to the fund, which is where the incremental call is taken. As far as PMS is concerned, there is also a lot of customization possible. So, while many of the managers do kind of, look at model portfolio, but to time a certain kind of, exposure on behalf of our investors is pretty much possible in PMS. Let me give you a very simple example. Let's say, if my number one position is an XYZ stock, which I'm very bullish on, and it's quoting at a certain price to earning multiple, when a new investor comes in, it pretty much gives us the flexibility within the portfolio management services structure to really kind of, fine tune it, take a different weightage, do a little bit of customization. It doesn't mean that, just because I'm holding it for my existing investors at, let's say, 10% position, I need to go ahead and buy 10% at the current market value. So I think that's the flexibility that PMS offers. As far as AIF is concerned, long short, as the name suggests, it of course, gives the flexibility to short wherever, the fund manager sees the opportunity. And long only, again, a part of, what have been the features of, other funds. I think it also allows us to be a very, very concentrated kind of, portfolio manager, which may not be possible given that, mutual funds are extremely kind of, open-ended most of the times, most of the schemes. So I think, these are some of the flexibilities which will be available in PMS and AIF, which may not be available to us as a mutual fund managers.
Thank you so much. And my next question is to both. And as per my understanding, what I've seen across the industry, mutual funds are a more diversified approach. They take exposure into about 50, 60 stocks, some even more than that. Whereas in alternate funds, PMS, AIF, they are a more focused approach. And for the last 4 years, we have seen a broad-based market rally. And particularly the funds who have been index hugging, they have outperformed, whereas funds with very high active share, they have underperformed. So do you think that cycle would change or is changing, and it would be time for stock because market, good fund managers would do really well, and the fund managers who are not, or just index hugging would underperform those fund managers who are doing a good job on the stock picking?
Sure. So I believe that, whether it's mutual fund, whether it's PMS or an AIF, I think these are all vehicles, and, we'll get into more details of, whether it's either or and in terms of these vehicles from an investor perspective. But, just to, answer your question, I think, world in general and, markets have been quite volatile in recent time, or even otherwise, we've seen post-COVID volatility plus the bull run that we saw for a couple of years. In my view, I think, it's not about the structure, which is, whether it's a vehicle is mutual fund or PMS or AIF. I think at certain times, certain strategies and, certain investment philosophies of a certain house or a fund manager works well in a certain market cycle. In certain market cycle where a lot of large caps do well, it doesn't really kind of, typically outperform. Let's take an example, and, we all remember 2008, where there was this famous run about, Ritik stocks, where, 90% of the active managers underperformed, because even within Nifty 50, there were these, 5 stocks which led to 105% return, and everything else was, either negative or, it didn't contribute much. So I think a lot of these, whether, it's active or passive outperforming, I think more than the fund manager strategy is also driven by, the underlying market flows. Also, I must highlight to you that, during 2018, there was a large amount of passive flows which happened to come into India from global investors as well, where, vanguards of the world, etc., who were investors in India for a very long time, had never seen the kind of flows that we saw in that year for India. So I think, depending on the underlying market circumstances, depending on the investment philosophies of the fund house themselves, whether it's value, whether it's growth, would be largely kind of, determining whether, a certain fund outperforms during the market cycle at that phase more than the vehicle themselves. You'd like to add?
Yeah, I think I will follow, in Gujarati it's said कि कोई भी धंधा चालू करने के लिए कम से कम 1000 दिन देने पड़ते हैं. So somewhere I will align, the vehicle, obviously ultimately everything goes into the capital market, especially in the equity market. So if you are giving a, reasonable time and then you're aligning with that, I think, the performance will follow. And the country which we are talking, India, which has, multiple advantages, not on the geopolitical side, but probably the demographic dividend and the stable government, which has never happened in the last 70 years. I think all these things are somewhere giving us a really good green shoots that we are, in one of the best time ever. So from that perspective, I think 3 to 5 years is an ideal horizon. If you stay in that with the discipline and align yourself with the fund manager strategy, which suits your need and all, I think, it's the best place to win. That's.
Thank you so much. And there are some real estate and credit risk funds in category 2. They come in category 2 IFs. Both of your AMCs have come up with these products. What are the returns and the risk associated with these kind of funds, and what should an investor evaluate when exploring these options? Questions to both of you.
So first let's understand, it's a kind of a word which, a lot of people are talking, that the private debt or probably real estate and all, and let's understand the global perspective. So one, I think most in the audience and probably including us, we are convinced that India is, in one of the finest decade. From that perspective, you need capital. If you need capital, if you have to reach the $10 trillion economy and all, you need capital. Okay, that capital cannot be fueled by only the equity capital or the equity market. You need both. Then if you go and try to check what happened in some of the developed economies, be it China, be it Japan, or for that matter, South Korea or Taiwan and all. So there the private debt to their GDP is roughly around upward of 150 or 160%. Whereas India is standing at this point in time, it's only 55%. So if I club all those things that I'm growing, and then if I have to align somewhere with these developed economies, that's what my dream is. So the money will not be supplied to that growth by only the equity capital. Okay, it has to come from the private debt and all. So that is one. Second, just think from a promoter point of view. Whenever he is, getting into some kind of a venture, or probably the existing promoter getting into the new line of a business, for him, the cost of a equity is upward of 25 to 30%. Whereas on the other side, if he is okay with 15-20% or 15 to 18% kind of a cost, which helps him not to dilute the equity, which is very, very precious, which is very, very costly. So that is the second reason why, a lot of these private credit funds nowadays has been talked about, or real estate funds has been talked about. Now, if you ask me what is the risk, I will say the risk which I can foresee at this point in time, it's only the liquidity risk. So let's look at it, what happened in 2000, somewhere 18, when there was a credit crisis and, some of the companies have not been able to meet. So the whole idea was, it was I'll say like a vehicle which was lending to some of the businesses which are on the growth stage, and they were not certain on the cash flows. They are certain that there's a growth happening. They are certain that there is a superb opportunity available. They can bank on it. But the only thing is, it is about the timing and all. Okay? From that perspective, that fund was going through the mutual fund route, which is more like a open bus, where people can come anytime and get out anytime. So that was a mismatch. That's where somewhere the realization happened to an extent at the regulatory level, at the, at the financial consultant level, at the manufacturing level, that if we want to be part of the private credit story, if we want to be the part of the private credit industry and all, I think somewhere we need a different vehicle where we can have a like-minded investor who have the same kind of a risk appetite, who have a same kind of a holding capacity and all. And from their perspective, that's where the private credit or the real estate, come into the picture. And last 5 years, if I want to say, that industry has grown almost at a, kind of a last 10 years, the growth from mere 1 billion to around 11 lakh crore of an industry. And in next 5 years, it's expected to grow upward of a 30% CAGR, which will make it roughly around 20 lakh crore of industry.
I think just to add, I think, from an investor's perspective, I believe that, investors are always seeking something which was between a fixed deposit return and an equity return. So, for example, if we say that, long-term risk-free returns would have been, let's say 7-8%, and equity long-term would be 14-15%. There was a huge demand for, or appetite for investors to have a product which would take enough risk, but not as much risk as an equity, and generate a return of 11-12% or so over a longer period of time. That's more from an investor's perspective, and I think that's where the whole kind of demand environment comes from for this kind of funds. From a perspective of supply, I think there are a lot of SMEs where while they do need liquidity and it's available over a longer period of time as they execute and as they deliver the scale. But they do need commitment from the supply side, which as my colleague mentioned here, which could be lasting for 3 to 5 years, because they cannot expect any kind of withdrawal during that phase when, let's say, they are going through an expansion of capacity, etc. So I think there was a nice kind of opportunity available, and I think essentially these funds are capturing that risk appetite as well as the demand for money.
Just one more point, apart from this, I think, somewhere the India, on paper, the inflation is around 5.5-6%. And if I look at it, current offering on the mutual fund space and all, they were somewhere bound around 8.5-9% kind of a thing. And if I look at it more from a HNF point of view, the real return is, kind of a none to negative kind of a thing, where the, post-tax return falls somewhere around 5-5.5%. Whereas all these performing credit, which offer around 14-16% kind of a thing at the investor level, if I look at it, it's, kind of really a win-win situation. That's one more thing. And last but not the least is probably a regulatory point of view. If you look at it, there are a lot of regulatory development which has happened in the form of IBC, in the form of RERA, if I talk about, real estate and all. That has somewhere, kind of protecting the end user, be it an investor or probably the end consumer, I'll say like interest also. So that is also kind of somewhere favoring to a lot of these investors who are kind of trying to be part of this industry.
Thank you so much. My next question is to Brijesh. We have seen there are many boutique fund houses doing PMS, and they have been growing day by day. And you represent an institution promoting PMS. What can you do differently with compared with those boutique houses? What you can and cannot do compared with those PMSs?
So I think, firstly in our industry, specifically on the PMS side, the barrier to entry is extremely low. The capital requirement is extremely low. And, we have more than, I think, 600 plus kind of, providers, unlike, let's say, if you look at mutual fund where, the capital requirement, etc. is way higher. I would say that, some of my peers on the boutique side have done a phenomenal job. But I think over a longer period of time, I think what really counts, and in my experience in terms of, equity management for over 2 decades, is the ability to manage risk. Because, at times when things are good, markets are booming, what we really see is that, a lot of those basic criterias are kind of, missed out. Now, being a part of institution, while it gives us the flexibility when it comes to PMS, to have that concentration, to have a portfolio of 20-25 stocks, but at the same time, we have a very robust kind of, risk management framework, which, overlooks in case, if we are kind of, going overboard. So I think that's something which is very essential. The second, and the most basic part of our investment is always the research capability. Now, if you have a large base that you are managing, and, most of the institutional houses have a shared research between our broader mutual fund platform and the PMS and the AIF platform, it gives you a much larger leeway to kind of, play in terms of the universe, in terms of the corporate access, etc. So I think that those I would think would be the advantages. But of course, a lot of these advantages play over long-term periods of time during the entire cycle that plays out.
Thank you. Next question is to Bhisham. And everyone has heard about this word Give City. So if you can explain what is Give City and how is it helping Indians invest outside and also foreign nationals and NRIs invest in Indian markets?
So thanks. I think Gift City, I'll say like I'll say it's a new concept to India, but probably very known in the different part of the world, be it sometime Dubai, the Cayman Islands, and all these things. The whole idea is, it's a land, a foreign land on Indian premises, which has no, jurisdiction of India. That's how it is. The whole idea is that, it comes with a, when Mr. Modi was, I'll say like a chief minister of Gujarat, and at that time they wanted to target these forest economies, especially Japan, South Korea and all these. And from their perspective, they wanted an investment from that. And one of the thing is that there are a lot of bureaucracy in Indian perspective, coming, and then you need a lot of approvals, checklist and all these. So how can we, get away from that, and so that it become easy for the investor to be part of India growth story and all. It got momentum 2018 onwards, when a lot of Indian, so one of the thing which this government has did is basically try to go and capture, get the voices of Indian diaspora and all. And keeping these two things in mind, I think Gift City is a platform where any foreign national or a NRI can be part of India growth story by investing through that route. And there are multiple options available for the investor on the equity as well as on the debt side. And he need not to be pay any kind of a tax, or probably not to take much of the approval. Simply he can come, invest into the India, and can get money back to the respective country. And the entire taxation will be of that country and all. Now, when I say how can an Indian be a benefit? So as an Indian resident, we have a LRS limit where we want to remit money, and the purpose can be different. Maybe a diversification point of view. Maybe, somebody is building a portfolio for, for foreign assets, or probably somebody who wants the money for his kid education and all. He can utilize that LRS limit where he can invest money, or probably he can own some of the foreign stocks in his portfolio for diversification point of view. So that's how these vehicles helps investor in terms of a diversification, as well as the foreigners to be part of India growth story.
Thank you so much. And there are so many words that goes around in the industry, and I want to just ask those questions to you guys. There's also a word called accredited investor. So, Brijesh, if you can help us understand what is accredited investor and what are the benefits for being an accredited investor, and how anyone can obtain it.
Sure. So I think, with all due credits to our regulator, I think, the whole concept of accredited investors has been started with this thought process that, it's a class of investor who is well aware of the risks associated with certain kind of investments. And therefore, if you look at the criteria which have been kind of, which we have for, being registered as an accredited investors, include, for example, annual taxable income, which needs to be kind of, submitted for applying for that, upwards of 2 crores, and a net worth criteria of 5 crores. Within that net worth, half of that net worth should be in financial assets, or if, let's say, an annual income of 1 crore with net worth criteria of 7.5 crores, half of that net worth coming into financial assets. And then, of course, higher criteria for, corporate, which will be upwards of 50 crores. What it essentially gives is, couple of advantages. One, of course, there are a lot of fund houses who launch a fund with specific criteria where, there will be a large ticket sizes involved. and therefore, they can get a higher allocation towards that if they are accredited investors, because usually, it needs to be otherwise well distributed within the different investor class. Second is that, while not many people use it because, it's quite contradictory for the fact that, it's usually ultra high net worth individuals who will be kind of, getting this. But, it does allow you to invest in, let's say, certain structures like PMS for a ticket size or an AIF for a ticket size which can be lower than 1 crore. So, you can have multiple kind of, AIFs if you are an accredited investors, where you can participate for a lower usual ticket size, which is, stipulated by the regulator, which is 1 crore. So I think in a sense, I think, it gives a huge advantage to take higher risk, to have a structured products along with the respective fund houses, to really kind of, work on things where, one is wanting to take higher risk, including some of the early angel investing that can happen from Cat 1 and Cat 2.
Thank you so much. And my last question to both of you. Can you describe some of the best practices that are deployed at your AMC, particularly when managing alternate investment funds, PMS, asset classes that are not very common?
So I think, one of the things that we've been doing since last couple of years, and, that's really helped us in terms of, seeing a significant value creation for our clients, is really kind of, sticking to a very rigorous kind of, process that we follow in terms of research. So, any company, for example, which becomes part of our portfolio, usually one always sees that, when it comes to PMS and AIF, there is always this perception that, it should be a micro cap or a small company with extremely high weightage. What we've done is we've divided our portfolios into 3 parts, and, that's helping us a lot through that research process, is that, at all points in time, we have a part of the portfolio sitting in stable compounders, and these are businesses which are, extremely kind of, immune to what can happen in economic scenario. For an example, an hospital business, whether there are trade tariffs or whether there is a slowdown in economy, these businesses tend to continue to compound, given that, we are quite underbed in terms of the number of beds available. Secondly, what we've done is, as a second pillar, and, which is helping us in our process, is that, we tend to identify business, and our endeavor is to identify business early in the cycle. So, there will be one part of the portfolio which will be sitting on emerging businesses, but these need not be very, very small companies. These will be typically companies with 300-400 crores plus of, EBITDA in terms of size. And lastly, what we, internally kind of, learned and have implemented is this whole thought process of, buying business is cheap, which we traditionally call it as, value investing, which is also inculcated. So, largely we are growth at a reasonable price, portfolio house. But, when we speak about value within our team, and, this is a kind of, unsaid understanding within the research group, we don't look at anything which is a value if we don't see an inflection point. So, for us, value is when we can identify the inflection point, and we can see that, there are certain events or there are certain things, whether it's change management, new product, things like that, that can help us discover the value, should be part of the portfolio. Now, with these 3 pillars on place and a very strong research backing, it's helping us to kind of, really create value over a longer period of time. So I think simple things in terms of the process and, thinking, but, it helps a lot in terms of, long-term value creation.
So for us, if I look at it, domestic AIF and PMS, which is long on equity, I think we run on 3 broad principles. That one, consistency matter rather than be a hero. It's like, nothing taking away the credit. Don't try to be a Alu Arjun in terms of a Pushpa, but try to be a Amitabh Bachchan with the consistency and all. So that is one. Second, I'll say like, look for a tax adjusted and risk adjusted return, because, India is a market. If you play your cards right and you take care of the risk, I think return will banega. Because India in the global, if I look at it, it's only a market, country which is growing at a nominal GDP of 12.5%, 6% inflation and 6% GDP growth. So that's what we are talking. And if I add 2-3% of a ROE, try to look for the company which is generating 15% plus kind of a ROE, try to be part of those companies, and then add somewhere expertise of the fund manager that will, kind of add 2-3% more to it. That's what we are aiming. Now, when I say a risk adjusted, so for us, the whole, concept is don't try to be very, very concentration, don't run the portfolio with a extreme concentration. Try to be a mutual fund plus kind of a thing. In the sense, if I look at the mutual fund broadly, 45 to 50 odd stocks is there in the portfolio. For us, it's somewhere 25 to 32% is how we run our domestic AIF and PMS. So that's the second thing. Third, try to be, in the top 5 or top 10 holdings, try to be between 50%, not beyond that. So that is these are 2-3 things which help us to control the risk. Last but not least, I will say tax adjusted, because all these products, especially the AIF and PMS long on equity, have a tax on the fund level, the fund level or the investor level. The whole idea is, if you keep the churn in control, you will give the real return or probably the tax-adjusted return better to the investor. So for most of our portfolios, if you look at it, the churn is upward, lower than 0.5. That means that, the average holding wherever we are getting, we are talking 2.5 to 3 years. So it's not that we only tell or preach our investor, but we follow that when we construct the portfolio and all. So that's more on the, equity side, long on equity. When I say a debt, I think, for us, the whole concept is how can I add in my investor's portfolio a real return by 250 to 300 bips. Because the mutual fund universe, ends somewhere 8.5 to 9% kind of a gross return and all. So we have, a mutual fund plus kind of a product which starts from, 10 to 11% with the investor in the money market fund, which is around, 6 months to 1 year kind of investment horizon, and he can expect at least a 50 to 100 bips over and above what mutual fund is giving. Parallelly, if the investor has a little longer horizon, then I can look at it 14 to 16% kind of a return. With the clear-cut, a risk and compliance in place and all, and investor can expect somewhere, around 250 to 300 bips kind of a over and above real return in the portfolio. When I say a real estate, for us, the whole idea is, real estate broadly for us divided into the 4 broader buckets. A builder acquire a land, from there he takes approval, and then he, launch a project, and in that project he starts selling. So all these 4 concepts or probably 4 stages for any real estate project is there. So for us, we make sure that we enter when the land has been acquired, when the approval has been in place. We enter when the project has been launched, and we have to guard the risk more from whether that builder is putting money into that particular project, and is he able to sell that project in that particular market and all. So that's where we put our entire head, so that, because these are the variables which we can control better. I'm not saying the other variable can't be controlled, but as a house, we are very clear where we want to play. And in that, we always get into the real estate once the project is approved, when the land is acquired. It's on the launch stage or it has been launched. That's where we want to be part of that through our real estate offering and all.
Thank you so much. Thank you so much for your lovely insights. Any questions we have for the panel? Thank you so much, both of you, for joining us today.
Thank you so much, sir, for such a valuable discussion. Now, I would like to call Mr. Sharad Agarwal to felicitate Mr. Brijesh Ved and Mr. Bhisham Rathi. Thank you so much. That's my time. Now I would like to hand over the mic to Ria.
Thank you, Zaki. Taxation plays a vital role in wealth management, and while Budget 2025 left capital gains unchanged, it introduced several important updates for investors, from modified exemptions to policy shifts. These changes have influenced financial planning strategies. To break it down, we have CA Shubham Patel, Managing Partner, a taxation expert who will provide a simplified yet insightful overview of the tax implications of this budget. Let's welcome CA Shubham Patel and Mr. Ankit Garg.
Good afternoon, everyone. It's an honor to be here at Nivesh Milan 2025, and I would like to extend my heartfelt thanks to the dynamic founders of Wealthy Nivesh and the energetic team of Wealthy Nivesh for inviting me today. The budget 2025 has 140 amendments in tax laws, out of which we will discuss the key amendment that could impact your investment decisions and grow your wealth. So today, let's not just decode the taxation changes, but also find the opportunities and uncover the opportunities that can help us out. Or as per German literature, Saturday afternoon को better होता है कि regional language में बातें करें, so that could be more engaging with everyone. So our topic today is budget 25 की tax proposal and how it will impact us, right? So the agenda for the today's presentation is changes in income tax, TDS, GST, as well as I will discuss the tax planning. और एक इस बजट 25 का जो मेन जो एक कोर एरिया था, that was artificial intelligence. And हर बार की तरह लूप होल्स तो रहते ही है. लूप होल्स कुछ ऐड हुए हैं, कुछ गवर्नमेंट को जब पता चला कि कुछ लूप होल्स थे जिसकी वजह से हर कोई टैक्स इवेजन करता था, वो हटाए हैं इस बार. अदरवाइज लूप होल्स नहीं होंगे तो हम चार्टर्ड अकाउंटेंट्स की दुकानदारी चलेंगी नहीं, राइट? तो एक लूप होल जो है, सबसे बेस्ट जो लूप होल है, आई विल बेट कि जितने भी लोग यहाँ पे बैठे हुए हैं सबको 60,000 रुपीज़ का उसमें टैक्स बेनिफिट मिलेगा. आई प्रॉमिस कि आपको डेफिनेटली उसका टैक्स बेनिफिट मिलेगा. The first thing we will discuss is tax rates. See, tax rates जो है as per new tax regime for individual HUF, AOP, BOI, इसमें पहले जो 2.5 lakhs का हुआ करता था, the basic exemption limit has been raised from 2.5 lakhs to 4 lakhs now. इनकम रेंज का जो क्राइटेरिया है वो है 4 का मल्टीप्लायर, दैट इज अप टू 4 lakhs इट विल 0 टैक्स, देन 4 to 8 इट विल 5%, 8 to 12 10 एंड सो ऑन. पहले जो MMR का जो था क्राइटेरिया, दैट वाज द थ्रेशोल्ड was set at 10 lakhs. Now the threshold has been raised from 10 lakhs to 24 lakhs. अभी 24 lakhs के ऊपर गया तो ही आपका 30% टैक्स लगेगा आपको, राइट? सो बाकी फॉर अदर देन इंडिविजुअल्स HUF, AOP and BOI, for taxation, tax rates for partnership firm and other companies are unchanged. In fact, the surcharge for individual is also unchanged. Up to above 50 lakhs का अगर income है तो 10%, above 1 crores then 15, and about 2 crores है तो 25%, right? After tax rate, we will discuss the main जो सबसे बड़ा जो मुद्दा जो चल रहा है, that is rebate. Rebate under section 87A. Earlier the rebate was available to you only if आपका जो maximum इनकम थ्रेशोल्ड है वो अगर आपका 7 lakhs का है तो ही आपको रिबेट मिलता था 25,000 का. नाउ दैट 25,000 रिबेट इज इंक्रीज्ड टू 60,000. रिबेट इज नथिंग बट आपका क्या कह सकते हैं, अमेजोन का कैश वॉलेट बैलेंस, वो कैश अप टू 7 lakhs का है तो आपको जो टैक्स पे करना था वो आपको टैक्स में डिस्काउंट मिल जाता है. सेम वे आपको अप टू 12 lakhs का आपका इनकम है तो आपको 60,000 का रिबेट मिलता है तो उसकी वजह से आपका जीरो टैक्स हो जाता है, राइट? अब ये जीरो टैक्स में आपका जो है स्पेशल रेट इनकम जो होती है वो काउंट नहीं होती है. दिस इज द बिगेस्ट लूप होल. ये बहुत बड़ा लूप होल भी है और जो स्मॉल इन्वेस्टर्स हैं उनके लिए बहुत बड़ा टैक्स बर्डन भी है. वी विल डिस्कस इट इन एट द एंड. ये बहुत बड़ा लूप होल है जिसकी वजह से जो जिसको बेनिफिट होने वाला है इट विल बी अप टू 60,000 पर असेसीज को आपको इसका बेनिफिट मिलेगा. वी विल डिस्कस इन द लेटर स्लाइड्स, राइट? अब एक काफ़ी सोशल मीडिया में एक ये काफ़ी मिसकंसेप्ट चलता है कि अगर आपका सैलरी 12.75 lakhs है, मतलब डेट इज 12 lakhs का अप टू 12 lakhs जीरो टैक्स और 75,000 अगर आपका स्टैंडर्ड डिडक्शंस है तो स्टैंडर्ड डिडक्शन अगर आपका 12.7 मतलब टोटल इनकम आपका 1275 है तो आपको जीरो टैक्स लगेगा. बट व्हाट इफ माय इनकम इज रेज टू 12.76 lakhs? सोशल मीडिया में काफ़ी ऐसे वीडियोस चल रहे हैं कि अगर आपका 1000 से सैलरी बढ़ गया तो आपको 62,000 का टैक्स पे करना है. नो, मार्जिनल रिलीफ आपके पास है. मार्जिनल रिलीफ जब से इनकम टैक्स एक्ट आया हुआ है तब से है आपके पास अवेलेबल. आपकी जो मार्जिनल जितनी इनकम आपकी बढ़ती है उसी के ऊपर ही आपको टैक्स आएगा. लेट्स से कि 12.75 lakhs के ऊपर अगर 12.76 lakhs हुआ है आपका, मतलब 1000 ज़्यादा है, तो आपको 61,500 का टैक्स पे करना नहीं आएगा, ओनली 1000 ही टैक्स पे करना पड़ेगा. सेम वे देयर आर डिफरेंट एग्जांपल्स कि 1295 अगर है आपका तो टोटल टैक्स पेबल विल बी 20,000 ओनली. दैट इज अ टैक्स सेविंग ऑफ 43,000. सेम वे अगर 13 lakhs है तो डेट इज आपका 1275 से 25,000 आपका एक्सीड होता है तो आपको 25,000 का ही पे करना पड़ेगा, ना कि 63,750 एंड सो ऑन. ये अप टू 60,000 तक का आपका ये बेनिफिट रहता है. बट ये लूप होल वाला ये चीज़ नहीं है, अभी भी लूप होल तक हम पहुंचे नहीं है. लूप होल विल बी एट दी लेटर स्लाइड्स, राइट? अब एक वापस एक आता है कि जीरो टैक्स मुझे कब मैं कितना कमाऊंगा जिससे कि मेरा जीरो टैक्स आएगा. We will discuss it for the various type of taxpayers. Various types of taxpayers means कि कितने type of taxpayers होते हैं. एक salaried, या तो फिर मैं सैलरी इनकम होगी, या तो फिर मैं प्रोफेशन से कुछ कमाता हूँगा, या तो फिर आई एम अ बिजनेसमैन, या तो फिर मैं इन्वेस्टर हूँ. ये चार के अलावा तो होगा नहीं. इसमें सबसे बुरा हाल होता है इन्वेस्टर का ही, क्योंकि बुरा हाल नहीं, इन्वेस्टर को 4 lakhs पहले जो 2.5 जिसका स्पेशल रेट टैक्स जिसके ऊपर लगता है, तो प्योर इन्वेस्टर का 4 lakhs का अप टू 4 lakhs का अगर आपका स्पेशल रेट इनकम है, लेट्स से लॉन्ग टर्म कैपिटल गेन, तो तब तक के आपको जीरो टैक्स है. अबव 4 lakhs का अगर होता है तो उसके ऊपर आपको टैक्स लगेगा ही लगेगा. देन कम्स दी सैलरीड इंडिविजुअल्स. सैलरीड इंडिविजुअल्स के बारे में भी एक ये है कि अभी 1275 तक मुझे टैक्स नहीं लगेगा. बट आई विल अगेन शो यू द टैक्स, आपका जो टैक्स ब्रैकेट का ऑप्टिमाइजेशन, जिससे आपका और भी हम कैसे और ज़्यादा टैक्स सेविंग कर सकते हैं. लेट्स से आपका बेसिक सैलरी इज 12,25,000, राइट? देन उसमें आप ऐड कर दीजिए एनपीएस कंट्रीब्यूशन बाय योर एम्प्लॉयर. 1,71,000, राइट? तो इसका भी मैं आपको डिस्कस करूंगा. उसमें आप और ऐड कर दीजिए मोटर कार लीजिंग फाइनेंस 4 lakhs का. What is motor car leasing finance? If you are planning to buy a car, better उसकी ओनरशिप आपके एम्प्लॉयर के पास रहे. आपको क्या मतलब है, ओनर उसका आपका एम्प्लॉयर है या मैं हूं? तो डायरेक्टली बेटर है कि कार लीजिंग फाइनेंस में क्या एग्रीमेंट होता है, किसी भी कार लीजिंग फाइनेंस कंपनी क्या करेंगी, वो लोन जो रहेगा वो डायरेक्टली आपके एम्प्लॉयर को देगा और एम्प्लॉयर सेम वे वो आपसे वो चीज़ का इंस्टॉलमेंट में लेगा. लेट्स से इन आवर केस employer is giving the motor car leasing finance this agreement with the employee कि वो 1 lakh पर क्वार्टर के हिसाब से आपको कार यूज करने के लिए दे रहा है. 1 lakh पर क्वार्टर इज नथिंग बट 33,000 पर मंथ का रेंटल फॉर दैट कार, राइट? अब इसका एम्प्लॉयर को क्या बेनिफिट है? एम्प्लॉयर को बेनिफिट ये है कि उसको अपने असेट बुक में वो कार का भी मिल जाएगा, नथिंग बट उसका नेटवर्थ बढ़ेगा, नेटवर्थ बढ़ा तो उसका बुक वैल्यू पर शेयर भी बढ़ जाएगा. एम्प्लॉयर को वो बेनिफिट है. एम्प्लॉय को बेनिफिट ये है कि उसका डाउन पेमेंट उसको पे नहीं करना है और डायरेक्टली उसका टैक्स बेनिफिट भी वो ले सकता है, राइट? इसमें और आप गिफ्ट टू एम्प्लॉय ऐड कर दीजिए. अप टू 5,000 तक का आपका एम्प्लॉय टू एम्प्लॉय का गिफ्ट 5,000 तक के एग्जेम्प्ट है, राइट? तो व्हाट विल बी द टोटल जीरो टैक्स सैलरी? 18 lakhs का आपको जीरो टैक्स सैलरी हो जाएगा, ठीक है? दिस इज अंडर न्यू टैक्स रिजिम. मैं ओल्ड टैक्स की तो बात ही नहीं कर रहा हूँ, ओल्ड टैक्स का भूल जाएगी, ओल्ड टैक्स का भी कोई रेलेवेंस नहीं है, ठीक है? लेस इसमें वापस 18 लाख की सैलरी पे हमें रीच आउट करना है कैसे आपका जीरो टैक्स हो जाए. आपको वापस से एनपीएस डिडक्शन अंडर सेक्शन 80 CCD 2 दैट इज एम्प्लॉयर कॉन्ट्रीब्यूशन टू दी एनपीएस 1,71,000 का आपको डिडक्शन मिल जाएगा. देन मोटर कार फैसिलिटी जो 4 लाख की जो मोटर कार फैसिलिटी जो आपको एम्प्लॉयर ने दी थी उसका आपको 3,60,400 का आपको उसका एग्जाम्शन मिलेगा. हाउ आई डिराइव ऑन दिस फिगर, हम लोग इसका भी बस कैलकुलेशन पर आते हैं. अब इसका एनीबडी वुड लाइक टू कैलकुलेट इसका मेरा टोटल कितना होता है? तो अभी इसमें से और 75,000 स्टैंडर्ड डिडक्शन आपको मिला हुआ है. टोटल मेरी सैलरी हो जाती है 11,89,000, राइट? विच इज बिलो 12 lakhs. इसके ऊपर टैक्स कितना आएगा? जीरो. दैट इज 18 lakhs की सैलरी पर भी आपका टैक्स जीरो आ सकता है इफ यू ऑप्टिमाइज योर सैलरी इन दिस वे, राइट? अब जो एनपीएस कंट्रीब्यूशन था that will be maximum of 14% of your basic salary, right? तो 12,25,000 का 14% is 1,71,000. This is the most optimized figure. उसके बाद जो हमने जो नेक्स्ट ये डिस्कस किया था 1 लाख पर क्वार्टर के हिसाब से आपको आपके एम्प्लॉयर ने ये कार आपको यूज करने के लिए दिए थी. तो अब इसमें टैक्सेबिलिटी क्या आती है कि टैक्सेबिलिटी इज ओनली, हमने जबकि ये 39,600 जो टैक्सेशन फिगर लिया हुआ है वो भी मैक्सिमम लिया हुआ है. डेट इज 1.6 लीटर की बड़ी कार है अगर आपके पास, आपको एम्प्लॉय ने वो यूज करने दिया है. लेट्स से कोई फॉर्च्यूनर या एक्सयूवी यूज किया या इनोवा यूज करने दे रहा है आपको 1.6 लीटर से बड़ी इंजन वाली कार, तब जाकर के आपको 2,400 पर मंथ का टैक्स लगता है. प्लस 900 का आपको ड्राइवर का भी उसने बेनिफिट दिया हुआ है. इट विल बी टैक्सेबल एज ए परक्विजिट. तो ये फिगर आपका ईयरली आता है 39,600. तो बस इसके ऊपर आपको टैक्सेबिलिटी आती है. लेट इज 4 लाख माइनस 39,600 डायरेक्टली 3,60,000 का आपका क्लियर कट बेनिफिट है जस्ट बिकॉज एम्प्लॉयर ने उसकी ओनरशिप ली है और 5,000 डायरेक्टली आपका गिफ्ट है, राइट? नेक्स्ट वी विल डिस्कस द सेकंड नेक्स्ट असेसीज. नेक्स्ट असेसी मतलब हमने इन्वेस्टर देख लिया, देन सैलरीड. अब ये दूसरे असेसी होते हैं प्रोफेशनल्स. प्रोफेशनल्स के केस में जीरो टैक्स कब आएगा? जीरो टैक्स आ सकता है अगर आपकी जो मैक्सिमम रेवेन्यू है इज 24 lakhs. हाउ आई डिराइव दिस फिगर? अब प्रोफेशनल्स में कौन कौन आते हैं? ऑल दोज हु आर नॉन ट्रेडर्स या मैन्युफैक्चरर्स. इसमें कौन आ सकते हैं? डॉक्टर्स आ सकते हैं, चार्टर्ड अकाउंटेंट्स आ सकते हैं, लॉयर्स, इंजीनियर्स, फ्रीलांसर्स, आर्किटेक्ट्स या नॉन एग्जीक्यूटिव डायरेक्टर इन एनी कंपनी या इंडिपेंडेंट डायरेक्टर्स, वो इस कैटेगरी में आ सकते हैं. अप टू 24 lakhs की अगर आपका टोटल रिसिप्ट्स होती है देयर विल बी जीरो टैक्स. आपको 1 रुपये भी टैक्स पे करने की जरूरत नहीं है उसमें. हाउ आई डिराइव दिस फिगर? इसमें आपको डायरेक्टली 50% का आपको बस मार्जिन शो करना है, राइट? तो आपकी टैक्सेबल इनकम विल बी 12 lakhs, राइट? तो 12 lakhs के ऊपर तो मुझे कोई टैक्स पे करना ही नहीं है, ठीक है? अब ये प्रिजम्पटिव टैक्सेशन का स्कीम है. अगर आपकी टोटल ग्रॉस रिसिप्ट्स का आप मोर देन 50% अगर आप डिस्क्लोज कर देते हो तो यू आर नॉट इवन रिक्वायर्ड टू मेंटेन बुक्स ऑफ अकाउंट और गेट इट ऑडिटेड, राइट? तो इसका बस मैक्सिमम थ्रेशोल्ड है, हमने 24 lakhs डिस्कस किया, इसका मैक्सिमम थ्रेशोल्ड है 50 lakhs. आपकी अगर 50 lakhs तक की इनकम है तो ही आप इस प्रिजम टू टैक्सेशन में जा सकते हो, विच कैन बी एक्सटेंडेड टू 75 lakhs अगर आपका मोर देन 95% रेवेन्यू जो है वो बैंकिंग चैनल से आता है आपका। अंडरस्टैंडेबल। नेक्स्ट इज बिजनेसेस। बिजनेसेस में कौन कवर होता है? जो अभी पहले जो कोई नहीं कवर हुआ था इसमें कवर होता है, मैन्युफैक्चरर्स, ट्रेडर्स या हॉस्पिटल्स, ये सारे लोग जो है बिजनेस में कवर होता है। सेम एज इसमें भी। अब इसका क्या हो सकता है? जो प्रोफेशनल्स को 50% का मार्जिन का दिया हुआ था, बिजनेसेस को वो मार्जिन दिया हुआ है 8%। मतलब आपका अगर लेट्स से आप कितना भी कमाते हो उसका टोटल टर्नओवर का 8% अगर आप डिस्क्लोज कर देते हो, दैट इज मोर देन सफिशिएंट। अब इनके इसमें मैक्सिमम कितना हो सकता है? ग्रॉस टर्नओवर विल बी 1.5 करोड़ इन केस ऑफ अगर आपका नॉन डिजिटलाइज्ड ट्रांजेक्शन से अगर आपका आता है, और 2 करोड़ दैट इज इफ यू आर अगर आपका टर्नओवर जो है 1.5 करोड़ तक का है इन केस ऑफ नॉन बैंक रिसिप्ट्स, और बैंक रिसिप्ट है 2 करोड़ का, तो आपको 0 टैक्स पे करना है। हाउ आई डिराइव दिस फिगर? ठीक है, टैक्सेबल इनकम विल बी 12 lakhs। हाउ 12 lakhs? अगर आपका नॉन बैंक रिसिप्ट्स है तो यू हैव टू डिस्क्लोज एटलीस्ट 8% ऑफ योर टोटल टर्नओवर। 1.5 करोड़ का 8% इज ऑल्सो 12 lakhs, 2 करोड़ का 6% इज ऑल्सो 12 lakhs। ये अजम्पशन मान करके देर इज नो एनी अदर इनकम, हर के सिनेरियोज में भी वही पकड़ा हुआ है। ठीक है, अब सेम वे इसके केस में भी सेम है, यू आर नॉट रिक्वायर्ड टू मेंटेन बुक्स ऑफ अकाउंट और गेट इट ऑडिटेड। अब आप कहोगे ये तो इनकम टैक्स की बात है, जीएसटी का क्या? डेफिनेटली इफ यू आर प्रोवाइडिंग सर्विसेज तो आपका थ्रेशोल्ड 20 lakhs के ऊपर है, और इफ यू आर अदर देन सर्विस प्रोवाइडर देन आपका थ्रेशोल्ड 40 lakhs है। तो उसके ऊपर क्या, तो जीएसटी तो लेना ही है, बट आपको सिर्फ टर्नओवर का डिटेल्स मेंटेन करना है, बाकी बुक्स ऑफ अकाउंट मेंटेन करने की आपको जरूरत नहीं है, ऑडिट भी करने की जरूरत नहीं है आपको। तो इसका मैक्सिमम टर्नओवर विल बी 2 करोड़, 3 करोड़ इफ 95% से ज्यादा आपका रिसिप्ट जो है रिकॉग्नाइज्ड बैंकिंग चैनल। व्हाट इज रिकॉग्नाइज्ड बैंकिंग चैनल? बस आपका जो भी टर्नओवर आता है आपको पूरा का पूरा टर्नओवर आपको अकाउंट पे ही चेक एनईएफटी या इलेक्ट्रॉनिक क्लियरिंग सिस्टम से आपको या आईएमपीएस से आपको पूरा टर्नओवर लेना है, राइट? ठीक है, तो ये तीनों असेसीज हमने कवर कर चुके हैं, सैलरीड इंडिविजुअल, प्रोफेशनल्स एंड बिजनेसेस एज वेल। ठीक है, देन वी विल डिस्कस द अपडेटेड रिटर्न। सी द फिनेंस मिनिस्टर का क्लियर कट ये है अंडरस्टैंडिंग कि टैक्स पेयर्स आर नॉट इवेडिंग द टैक्स, दे आर नॉट विलिंगली इवेडिंग द टैक्स। इनका अभी इनको सब कुछ समझ में आ चुका है कि सोशल सिक्योरिटी का भी एक रीजन होता है। बेटर है ट्रस्ट, हैव फेथ इन आवर टैक्स पेयर्स, हैव फेथ इन आवर सिटीजन्स। ये जो पहले इनकम डिस्क्लोजर स्कीम, विवाद से विश्वास स्कीम, ये एवरी 3 years या एवरी 5 years फिनेंस मिनिस्ट्री को लानी पड़ती थी, सो डैट कि यू कैन वॉलंटरीली डिस्क्लोज द वॉट एवर अनडिस्क्लोज इनकम इन योर असेट बुक इज देयर। आपको बस डिस्क्लोज करना है, तो बेटर है आप ही खुद ही डिस्क्लोज कर दीजिए। पहले ये जो अपडेटेड रिटर्न की जो लिमिट थी वो अप टू 2 years फ्रॉम द एंड ऑफ द असेसमेंट ईयर, और डेट इज 3 years फ्रॉम द एंड ऑफ द फाइनेंशियल ईयर। तो इसको पहले 3 years था, अभी इसको 5 years फ्रॉम द एंड ऑफ द फाइनेंशियल ईयर कर चुके हैं। ठीक है, आप खुद से ही आपकी इनकम डिस्क्लोज कर दीजिए। एडिशनल टैक्स उतना ही लगेगा कि जितना आप एडिशनल इनकम आप डिस्क्लोज कर रहे हो, डेट इज अगर आप 2 साल के अंदर करते हो तो 25% एडिशनल टैक्स पे करना पड़ेगा ऑन द एडिशनल इनकम विच यू आर डिस्क्लोजिंग ओवर एंड अबाउ योर ओरिजिनल इनकम, जो आपने ओरिजिनल आईटीआर में जितना किया हुआ था, राइट? इसमें द ओनली थिंग इज कि आपका टैक्स पेएबल आना चाहिए। ठीक है, अब एक जो मैं कह रहा था कि लूप होल हटाया है, जो सालों से एक लूप होल चला आ रहा था, एक लूप होल अभी इनको समझ में आ चुका है, तो एक हटाया गया है। तो एक अकॉर्डिंग टू यू व्हाट इज द बिगेस्ट रीजन ऑफ अमलगमेशन या मर्जर? कोई भी कंपनी अमलगमेट या मर्जर क्यों करती होंगी? ठीक है, यू माइट से कि बिजनेस रीऑर्गेनाइजेशन या कोई स्ट्रेटेजिक इंपॉर्टेंस होगा या कोई कॉम्पिटिटिव एडवांटेज मिलता होगा। नो सर, ये बाहर चलता होगा, बट इंडिया में अमलगमेशन अब तक के सिर्फ और सिर्फ, नहीं सबका नहीं कह रहा हूं, सिर्फ और सिर्फ होता था टैक्स बचाने के लिए। अमलगमेशन का रीजन होता था कैरी फॉरवर्ड ऑफ लॉसेस ऑन अमलगमेशन। आई विल नॉट लाइक टू नेम एनी कंपनी एक्स। अगर आप किसी एक्स कंपनी को आप एक्वायर करते हो विच इज अ लॉस मेकिंग कंपनी, आप उसका कैरी फॉरवर्ड आप अपने बुक्स में उसका लॉस आप ले सकते हो, और वो लॉस जो है आप अब तक के 8 years तक के आप उसको कैरी फॉरवर्ड कर सकते थे एंड सेट ऑफ टू योर प्रॉफिट्स फ्रॉम द डेट ऑफ अमलगमेशन. डेट इज अमलगमेटिंग कंपनी का लॉस जो है, अमलगमेटेड कंपनी फ्रॉम द डेट ऑफ अमलगमेशन, और 8 साल तक वो सेट ऑफ एंड कैरी फॉरवर्ड कर सकती थी, जिससे कि उनका प्रॉफिट कम हो जाए, टैक्स कम लगे, राइट. अब ये लूप होल उन्होंने हटा दिया है. अब ये जो आपका जो कैरी फॉरवर्ड ऑफ लॉसेस है वो होगा जब से ओरिजिनली अमलगमेटेड कंपनी का जो ये ओरिजिनल उसका लॉस जब से इनकर करना स्टार्ट हुआ था, वहां से ही 8 इयर्स हम काउंट करेंगे, राइट. तो अब इससे ये बहुत बड़ा टैक्स इवेजन जो है ये रुक चुका है. अदरवाइज एक बहुत बड़ी लिस्टेड कंपनी ने तो कम से कम 25 साल तक कभी कोई टैक्स ही नहीं पे किया था. उनके कभी भी ऑडिटर्स या सीए कभी कोई बिग फोर्स नहीं रहे हैं. इनफैक्ट आप कोई भी बड़ी सबसे मार्केट कैप वाली देख लीजिए, उनके कभी भी ऑडिटर्स बिग फोर्स नहीं होते हैं, ठीक है. अब दैट वाज द रीजन कि मिनिमम ऑल्टरनेटिव टैक्स लाया गया था. डेप्रिसिएशन एज पर कंपनीज एक्ट कुछ और होता है, डेप्रिसिएशन एज पर इनकम टैक्स कुछ और होता है, उस वजह से इन्फ्लेटेड प्रॉफिट दिखता है, ठीक है. वो तो मैट काफ़ी पहले लूप होल आया, तो मैट की वजह से लूप होल हट चुका है. नाउ ये अमलगमेशन वाला जो लॉस है वो भी अब हट चुका है, राइट. अब ये नेक्स्ट जो सबसे बेस्ट जो चीज़ आई हुई है वो आई है स्टार्टअप्स का. स्टार्टअप्स के लिए जो डेडलाइन थी, इफ़ यू आर आपका जो इनकॉर्पोरेशन डेट है वो 31 मार्च 2025 तक का अगर था तो आपको स्टार्टअप्स के बेनिफिट मिलते थे. डेट इज़ आपको 3 इयर्स का 100% टैक्स एग्जम्पशन मिलता था ऑन योर प्रॉफिट्स फॉर एनी ऑफ द 10 इयर्स का जो ब्लॉक है उसमें से आप कोई भी 3 साल का आपको 100% टैक्स एग्जम्पशन मिलता था. नाउ दिस टैक्स विंडो हैज़ बीन एक्सटेंडेड बाय मोर अनदर 5 इयर्स. That is फाइनेंशियल ईयर 25 की जगह पे फाइनेंशियल ईयर 2030 तक के भी आपका अगर कंपनी इनकॉर्पोरेट होता है तब भी आपको ये टैक्स बेनिफिट मिलेगा. एग्जिस्टिंग जो जिसने बेनिफिट ले चुका है उनको तो मिलता ही रहेगा, राइट. तो दिस वाज रिलेटेड टू स्टार्टअप्स. नेक्स्ट वी विल डिस्कस यूलिप्स. ये बहुत बड़ा विच इज़ ये कंपनीज के लिए काफ़ी बेटर थिंग है, क्योंकि अब तक के यूलिप्स अगर आपका प्रीमियम जो है, इफ़ योर प्रीमियम इज मोर देन द 10% ऑफ द टोटल सम अश्योर्ड, तो वो यूलिप टैक्स एग्जम्प्ट नहीं होती थी. यूलिप के ऊपर का क्लेम या LIC, एनी सम रिसीव्ड फ्रॉम LIC और यूलिप्स, इट वाज टैक्सेबल. if the premium was less than 10%, it was 100% exempt. But if the premium is more than 10%, then उसके ऊपर टैक्स लगता था. अब वो टैक्स लगता था मैक्सिमम मार्जिनल रेट से, जो भी आपका MMR चलता आ रहा है. अब उसका बहुत बढ़िया जो रिलैक्सेशन मिला हुआ है. नाउ it won't be taxed at MMR, it will be considered as capital gains. उसको इक्विटी ओरिएंटेड म्यूचुअल फंड माना गया है यूलिप्स को. नाउ अब आपका म्यूचुअल फंड का जो नॉर्मल कैपिटल गेन लगता है, इफ इट इज लॉन्ग टर्म देन इट विल बी टैक्स एट 12.5%, एंड इफ इट इज शॉर्ट टर्म तो 20%. अदरवाइज पहले जो MMR के ऊपर लगता है, MMR इज नथिंग बट वॉट एवर मैक्सिमम रेट विच इज एप्लीकेबल टू यू. दैट इज इन केस आपका 10 लाख से ऊपर टोटल इनकम था तो 30% लगता था, राइट. नाउ इट विल बी कंसिडर्ड एज इक्विटी ओरिएंटेड म्यूचुअल फंड. अदर उसके अलावा कोई अदर यूलिप्स है तो डेफिनेटली इट विल बी कंसिडर्ड अंडर अदर सोर्सेस ओनली. नाउ वी विल डिस्कस अबाउट नॉन रेसिडेंट्स. नॉन रेसिडेंट्स के लिए भी सेम वे प्रिजम्प्टिव टैक्सेशन स्कीम आई हुई है. सेम जो हमने ये इनके लिए जो हमने लिया हुआ था प्रोफेशनल्स एंड बिजनेसमैन के लिए, उनके लिए भी सेम है. आपकी टोटल ग्रॉस रिसिप्ट्स का 25% डीम्ड प्रॉफिट दिखा दीजिए तो आपको डायरेक्टली बुक्स ऑफ अकाउंट मेंटेन करने की जरूरत नहीं है, प्रोवाइडेड योर सर्विसेज आर रिलेटेड टू प्रोवाइडिंग सर्विसेज टू द मैन्युफैक्चरर्स विच आर रिलेटेड टू इलेक्ट्रॉनिक एंड अदर गुड्स टू रेसिडेंट्स. सेम वे अबू धाबी इन्वेस्टमेंट अथॉरिटी को भी डेडलाइन इनकी एक्सटेंड हो चुकी है. जो इंडियन इंफ्रास्ट्रक्चर अथॉरिटीज़ में अगर ये लोग इन्वेस्ट करते थे तो ये 2025 तक डेडलाइन थी, विच हैज़ बीन एक्सटेंडेड टू 2030. सेम वे उनको कोई ये इंडियन इंफ्रास्ट्रक्चर फैसिलिटी में अबू धाबी इन्वेस्टमेंट ट्रस्ट, सोवरेन वेल्थ फंड्स या पेंशन फंड अगर कोई भी इन्वेस्ट करते हैं तो उनका कोई भी कैपिटल गेन्स भी अराइज होता है, डेट विल बी 100% एग्जम्प्ट. टैक्स रेट रैशनलाइजेशन, FIIs को अब तक के 10% कैपिटल गेन्स लगता था. जस्ट टू ब्रिंग द पैरिटी, नाउ दे विल ऑल्सो बी टैक्स्ड एट 12.5%. एक गुड न्यूज़ है, DTAA बिटवीन इंडिया एंड UAE में कोई चेंजेस आया नहीं है. अदरवाइज श्रीलंका एंड बर्मा के साथ में जो DTAA था उनका जो ये था उसका जो टैक्स एग्जेम्पशन मिलता था ऑन म्यूचुअल फंड वो हटा लिया गया था 2017 में, बट अभी भी स्टिल फाइनेंस बिल में कोई उसमें चेंजेस लाया नहीं गया है. देयर इज अ DTAA बिटवीन इंडिया एंड UAE कि अगर आपका देयर इज ए डबल टैक्सेशन अवॉइडेंस एग्रीमेंट इफ यू आर ऑलरेडी टैक्स ऑन दैट पर्टिकुलर इनकम इन इंडिया, तो आपको UAE में टैक्स नहीं पे करना है, और UAE में अगर आपका टैक्स लगा है तो इंडिया में पे नहीं करना है. तो एक आर्टिकल 13 है जो एक ये बताता है कि आपका म्यूचुअल फंड, अगर आपका म्यूचुअल फंड से अगर आप रिडम्पशन होता है इंडियन, इफ यू हैव इन्वेस्टेड इन इंडियन म्यूचुअल फंड, तो दैट विल बी अ टैक्स एग्जम्प्ट. ठीक है, तो आर्टिकल 13.5 में ऐसा लिखा हुआ है कि आर्टिकल 13.4 इज रिलेटेड टू शेयर्स, बट आर्टिकल 13.5 में लिखा हुआ है द पावर टू टैक्स ऑन दैट पर्टिकुलर स्क्रिप्ट इज विद द अदर कंट्री. That is, if the equity-oriented mutual fund has been redeemed in India, तो ये power to tax rest with the other country. That is, in our case, it will be UAE, right? तो UAE में तो कोई personal tax लगता नहीं है, तो it will be 100% exempt. तो उसके ऊपर भी कोई change आया नहीं हुआ है. Just you need to apply for TRC in UAE, then file form 10F in India, submit to the AMC. और इसका reference में एक सबसे बड़ा case law है ITAT Cochin bench, DCIT Kochi versus KE Faisal, which proves कि जो कर रहे हम सही है. Then there is one more simplification, self occupied property के ऊपर एक simplification आया हुआ है. पहले up to two self occupied property थी तो आपको tax exemption मिलता था, provided एक आप नेम में है self occupied property, you need to occupy that property, then only you will get the exemption on that particular thing. ठीक है, तो दूसरी प्रॉपर्टी आपको एटलीस्ट फॉर बिजनेस पर्पज के लिए आपको रखनी पड़ती थी. नाउ इसमें एक रिलैक्सेशन आ चुका है, अप टू आपकी 2 प्रॉपर्टी है तो उसके ऊपर कोई आपको टैक्स नहीं पे करना है. अदरवाइज आपको एक नेक्स्ट प्रॉपर्टी पर आपको डीम्ड टू बी लेट आउट माना जाता था. आपका जो भी सर्कल रेट है उसके ऊपर रेंट पे करना पड़ता है. लेट्स से एग्जांपल ऑफ विराट कोहली का अगर दिल्ली में भी घर है, मुंबई में भी घर है, तो उसको दिल्ली के घर जहाँ पे वो ऑक्यूपाई करता है वहाँ पे उसको हाउस प्रॉपर्टी टैक्स पे करना पड़ता था. अब जो अदर प्रॉपर्टी है उसको डीम टू बी वो करना पड़ता था. ठीक है, नाउ न्यू इनकम टैक्स बिल आ चुका है विच विल बी इम्प्लीमेंटेड फ्रॉम फाइनेंशियल ईयर 2026-27. सबसे बेस्ट मोटो है फाइनेंस मिनिस्टर का, ट्रस्ट फर्स्ट स्क्रूटिनाइज लेटर. हर किसी को सोशल सिक्योरिटी चाहिए कि हमारे पोथ होल्स है, हॉस्पिटल फैसिलिटीज़ ठीक नहीं है, तो क्लियर कट इनका ये है कि बेटर है गिव द रिलैक्सेशन टू द टैक्स पेयर्स. टैक्स पेयर्स आर ऑनेस्ट, हैव फेथ इन देम. बेटर है कि उनके ऊपर हम फेथ करते हैं और लेट देम डिस्क्लोज देयर इनकम वॉलंटरीली. पूरा का पूरा उनके ऊपर करते हैं. कोई टैक्स TDS का रिफंड है, पहले रिफंड उनको दे देंगे, उसके बाद में वी विल स्क्रूटिनाइज वॉट एवर वी वॉन्ट. देयर आर चेंजेस इन TDS एंड TCS एज वेल. द बिगेस्ट चेंज इज TCS ऑन सेल ऑफ गुड्स. अगर आपको कोई सेल करते हो, कोई आपकी 2 पार्टी के बीच में पहले सेलर ने बायर को सेल किया था, इफ द टोटल ट्रांजेक्शन वैल्यू वाज मोर देन 50 lakhs, देन 0.1% सेलर वुड कलेक्ट एज अ TCS. नाउ उसको हटा चुके हैं, तो जिससे कि ये बहुत बड़ा रिलैक्सेशन आया हुआ है. देयर आर चेंजेस इन TDS एज वेल. थ्रेशोल्ड लिमिट बढ़ा चुके हैं. देयर बहुत ज़्यादा रिलैक्सेशन दिया हुआ है इसमें, बहुत ज़्यादा. दिस वाज नेवर एवर एक्सपेक्टेड बाय एनी पर्सन, इवन बाय द अपोजिशन पार्टीज एज वेल, कि इतना बड़ा कभी रिलैक्सेशन आएगा. ठीक है, इसमें बहुत ज़्यादा थ्रेशोल्ड दिया हुआ है. एक थ्रेशोल्ड काफ़ी अच्छा जो रिलैक्सेशन दिया हुआ है दैट वाज रिलेटेड टू विनिंग फ्रॉम लॉटरी एंड क्रॉसवर्ड्स एज वेल. पहले इनको 10,000 का लिमिट था ओवरऑल एग्रीगेट विनिंग्स पर. अब किसी को 20 रुपीज़ का विनिंग हुआ, ये टोटल एग्रीगेट टोटल करना पड़ता है कि अप टू 10,000. नाउ इट हैज़ बीन कंसिडर्ड एज अ सिंगल ट्रांजेक्शन. अगर सिंगल ट्रांजेक्शन 10,000 के एक्सीड होता है तो ही आपको करना पड़ेगा. द नेक्स्ट वॉज रेंटल. रेंट अगर आपका 2,40,000 तक का है तो कोई आपको TDS डिडक्ट करने की जरूरत नहीं थी. नाउ इट हैज़ बीन रेज टू 50,000 पर मंथ. 50,000 पर मंथ इज नॉट इक्वल टू 6 lakhs पर ईयर. अगर आपका किसी मंथ में 60,000 है तो आपको TDS काटना ही पड़ेगा, इवन इफ इट डज नॉट एक्सीड 6 lakh रुपीज़. राइट, प्रोफेशनल फीस का पहले 30,000 का लिमिट था विच हैज़ बीन रेज टू 50,000. TCS में भी काफ़ी रिलैक्सेशन आए हुए हैं. पहले जो 7 lakhs से ऊपर जो अगर आपका ट्रांजेक्शन होता था फॉरेन रेमिटेंस का, विच हैज़ बीन रेज टू 10 lakhs एज वेल. नाउ द बिगेस्ट थिंग इज AI में गवर्नमेंट का बहुत ज़्यादा फोकस है. इनफैक्ट ऑल द प्रोसेसिंग विल डन इन द विद द हेल्प ऑफ AI. आपका सारा कुछ जो बैंकिंग ट्रांजेक्शन्स है वो AI की हेल्प से आपका प्रोसेस, रियल टाइम प्रोसेसिंग पर ज़्यादा फोकस है. जस्ट इनफैक्ट जो गवर्नमेंट का जो इनिशिएटिव है, वी आर ऑल्सो ट्राइंग टू contribute on that. We are also launching our product name Conso. Conso is nothing but a consolidation, console, consortium और consultancy का एक short form है. It will be launching soon. You can just go to the, you can just search the conso.in. You can just join the wait list and you will get the what services we are providing. It will be real-time consultancy. You can just convert, you can make a conversation with that avatar. It will give you the perfect answers. जो हमने मैंने कहा था कि लूप होल जो है सिस्टम में, नाउ आई विल डिस्कस दैट लूप होल. यू कैन सी कि ये लूप होल की वजह से गवर्नमेंट खोखली होते जाती है, तो दैट डिनोट्स दैट स्केलेटन. ठीक है, जो लूप होल आया हुआ है ना, 87 ए रिबेट के ऊपर आया हुआ है. I myself has sent a mail to the finance ministry कि ये आपका लूप होल है, अभी भी फाइनेंस बिल एक्ट नहीं बना है, तो ये चेंज कर दीजिए इसमें, अदरवाइज इंडियन पब्लिक के लूप होल का फ़ायदा उठाती रहेंगी. ठीक है, होता क्या है, ये जो रिबेट है वो आपको अप टू 12 lakhs की अगर आपकी नॉर्मल इनकम होती है तो रिबेट ज़ीरो है, बट दैट टोटल इनकम डजेंट इंक्लूड स्पेशल रेट टैक्स इनकम्स. स्पेशल रेट टैक्स क्या होता है? लॉन्ग टर्म कैपिटल गेन, जिसके ऊपर 12.5% लगता है. लेट्स से अब ये 3 सिनेरियोज लेते हैं. मिस्टर राम का सिर्फ इंटरेस्ट इनकम है, लॉन्ग टर्म कैपिटल गेन कोई नहीं है, टोटल इनकम इज 12 lakhs, उसको रिबेट मिला हुआ 60,000, दैट मीन्स टैक्स जीरो है. नेक्स्ट केस है मिस्टर श्याम, स्मॉल इन्वेस्टर, उसका लॉन्ग टर्म कैपिटल गेन 6 lakhs है, स्टिल उसको टैक्स पे करना पड़ता है 25,000. मिस्टर राम का 12 lakhs था, स्टिल उसको जीरो टैक्स है. मिस्टर श्याम का 6 लाख का ही टोटल इनकम है, स्टिल ही हैज टू पे 25,000 एज टैक्स. हाउ आई डिराइव, आई विल डिस्कस, वी कैन डिस्कस हाउ आई डिराइव ऑन दिस फिगर 25,000 का. नथिंग बट है 6 लाख का लॉन्ग टर्म कैपिटल गेन में से 1.25 lakhs का आपको बेनिफिट मिलता है, राइट? तो बचा हुआ 4.75 lakhs, 75,000 का 12.5% इज 25,000. अब आती है बात जिससे आपको 60,000 का बेनिफिट मिलेगा. मिस्टर गणेश का इंटरेस्ट इनकम है 12 lakhs, या बिजनेस इनकम पकड़ो, जो भी पकड़ना है आपको. लॉन्ग टर्म कैपिटल गेन इज 1 crore. अब उसकी टोटल इनकम इज 1.12 crore. टैक्स उसको 12 lakhs के ऊपर 1 रुपए भी नहीं पे करना है. ये सबसे बड़ा लूप होल है, क्योंकि रिबेट में सिर्फ और सिर्फ आपको नॉर्मल इनकम को ही काउंट करना है. तो रिबेट आपको 60,000 का जो आपकी इंटरेस्ट इनकम या बिजनेस इनकम या कोई भी इनकम, हाउस प्रॉपर्टी इनकम अगर आपकी 12 lakhs होती थी, उसके ऊपर आपको जीरो टैक्स पे करना है. टैक्स सिर्फ और सिर्फ आपको लॉन्ग टर्म कैपिटल गेन के ऊपर ही पे करना है, विच इज 12.5% ऑफ 1 crore. डायरेक्टली आपका 60,000 का फायदा है, प्रोवाइडेड ये लूप होल जो है गवर्नमेंट टाइम पर ठीक कर ले, अदरवाइज एवरीवन विल टेक बेनिफिट ऑफ दिस थिंग, राइट? नेक्स्ट, लास्ट साइड, चेंजेस इन जीएसटी. चेंजेस ज़्यादा कुछ है नहीं, राइट? अब ये सारी चीज़ करने की वजह से बूस्ट इन इकोनॉमी सुपर हुई है. 1 लाख, ये रिलैक्सेशन की वजह से 1 लाख करोड़ का इनकम टैक्स फॉरगो हुआ है गवर्नमेंट का. अब ये 1 लाख करोड़ की वजह से मोर कैश फ्लोज विद सिटीजन्स या बिजनेसमैन या जो भी है मार्केट में 1 लाख करोड़ आया हुआ है. 1 लाख करोड़ की वजह से मोर कैश इनफ्लोज की वजह से मोर कंजम्पशन एंड परचेजिंग पावर पैरिटी, मोर कंजम्पशन की वजह से हायर जीएसटी कलेक्शन. इवन इफ इनकम टैक्स का 1 लाख करोड़ का इनकम टैक्स फॉरगो हुआ है, पर जीएसटी कलेक्शन तो बढ़ चुका है. डेफिनेटली दिस विल हेल्प इन बूस्टिंग द इकोनॉमी. Okay, thank you so much, Team Wealthy Nivesh. If anybody has any type of query, they can definitely reach out to me on the number shown in the screen. You can just scan the QR code. कोई भी query हो आप definitely we can reach out. Thank you so much.
Thank you so much, Subham sir. That was great. As of now, we will not be taking any further questions for the panel discussions as we are on a short time crunch. So moving ahead, Riya will take you ahead with the discussions.
Thank you, Shubham sir, for such an informative presentation. I would now like to call upon Mr. Surendra Kothari to felicitate Mr. Shubham Patel. Mr. Surendra Kothari? Yeah. Sir, please come. Thank you, sir. Mid and small cap stocks have always been an exciting yet challenging space for investors. While they hold immense growth potential, but they also come with inherent risk, making strategic risk management crucial. To share their expertise on this dynamic segment, we have Mr. Ankit Jain, fund manager at Mirai Asset Management Company, with over 12 years of experience in investment analysis and fund management. His in-depth knowledge of market trends make him an invaluable guide in identifying opportunities in mid-cap and small-cap category. Let's welcome Mr. Ankit Jain to the stage.
Yeah, hi. Good afternoon, good evening, everyone. Yeah, thank you for this opportunity. So, let me start. Yes, I mean, as rightly pointed by the lady that I mean, mid cap and small cap is a very, very exciting segment of the market. It clearly comes with its own fair share of risk. Having said that, over longer term, I mean, I will try to show during my presentation that how the typically earnings growth to pan out and why it really, I mean, spaces become even much more exciting going forward. And we'll also try to discuss some of the themes, I mean, longer term themes, I mean, where actually we do see, I mean, longer term growth opportunities as such. So this will be like, I mean, the structure. So first, if we look into, let's say, last 5 years, how the space has evolved, is that there has been a multifold increase into the market cap across, particularly in the mid cap and small cap segment as such. I mean, almost 30% CAGR, I mean, has been the growth in the market cap. I mean, as far as December 19, which is a pre-COVID time, and December 2024. So roughly 5-year average CAGR, if we try to look into the market cap of mid caps has evolved from 22 lakh crore to almost 88 lakh crore. Almost 30% CAGR. The large caps has also grown at around 20% CAGR. And the one key thing which has been observed is that if you look into the largest mid-cap market cap in December 2019, which used to be 26,000 crore, I mean, that is now even at somewhere at around 270, 280th company, which is like, I mean, the largest small cap itself is now 33,000 crore. So there has been a significant jump in the overall universe space, balance sheets of the company, size, scale. I mean, everything has grown multifold as such. Another interesting aspect has been that with buoyant capital market and lot of IPOs coming in, many interesting newer businesses are sort of getting added, particularly in the mid cap and small cap space as such. If you look into, I mean, last 7-8 years, 2016 to 24, almost, if you look into 53 new companies has got added into the, I mean, into the Nifty Midcap 150 indices as such. So, which means that clearly, I mean, out of 150 companies, 54 companies currently, I mean, are there, which was not even existent, I mean, 7-8 years back. So, which means that clearly a lot more newer businesses and sort of investment opportunities are coming into the market in the mid-cap space when to invest in. At the same time, I mean, if you look into, I mean, many newer sectors are also coming in. I mean, if you look into many of the sectors which to offer relatively higher earnings growth potentials are having higher and higher weightages in case of mid-cap and small cap. Particularly, you look into, let's say, sector like cap goods, auto ancillaries, real estate, chemical, and then long list of capital market, hotels. I mean, so many subsectors are there which are
particularly part of the mid cap, and that is, and many of these sectors really do hold higher, higher earning growth potential over time because of various factors. So that's why at an aggregate, typically mid cap and small cap businesses do offer higher sort of earning growth potential over time, and which in a way also do drive typically higher sort of a return potential over a, over a medium term, standpoint. If you look into the profit pool comparison, let's say, how the mid cap share in the overall earning pool of the market is going up. This is like pre-COVID fiscal year 20 aggregate number is not the right sort of a thing to look at it. But if you look into fiscal year 24, almost 14% of the BSE 500, let's say profit pool of around 14 lakh crore, 14% was part of the mid cap. The same number is now has gone up to almost 16, 17 odd %. And as some of these companies do keep on compounding earnings at a faster pace, clearly this percentage share of profit pool, will actually further keep on growing. If you look into over a reasonable time frame, typically mid caps do exhibit pretty good double-digit sort of earnings compounding. If you try to look into this is like trailing 5 years sort of a number. So if you look into, this is fiscal year 4 to 9, this 5-year earning growth has been at around 19 odd % when it comes to mid cap. 9 to 14 has been 15%, 14 to 19 has been 14%, 19 to 24 also pretty good sort of a earnings growth. So typically if you look into at any block of 5 year, which is a reasonably good sort of a time horizon, 1 year, 2 year, there could always be a volatility at any given point in time, or maybe there might be one particular sector which can, which can impact the overall, earnings growth of the indices as such. But if we try to look into on a 5-year bucket, there has been a reasonable history of these companies to really sort of deliver pretty good, healthy double-digit earnings growth. In that context, if we try to look into even the ROEs, of many of these businesses are pretty good. At an aggregate level, 14, 15% sort of a ROE, which is a very, very healthy number. And another interesting thing has been that over time, these companies has delivered their balance sheet significantly. So if you look into fiscal year 9, debt to equity was around 0.8x, which has now come down to 0.3x, which means that as companies do grow in size, right, their ability to access capital also goes up, and which in a way do also helps in company sort of a deleveraging in a, in a very, very right manner. And to that extent, even overall, risk, aspect because of the delivered balance sheet also comes down over time. This is like CY 14 to 19. If you try to compare the earnings part of it, this was a relatively bad phase for the market where because, earnings consistently keeps on getting downgraded, right? So these 5 years, large cap earnings has hardly grown, like 5-year CAGR has been 2 odd %. While at the same time, mid caps has grown 7% sort of a CAGR, 14 to 19. Small cap and all, because of base effect, is looking very, very high number. But the point I want to want to mention is that at any given point in time, reasonable 5-year sort of a time horizon, earnings of mid cap and small cap can easily outpace large cap earning growth by at least 4 to 5% CAGR, and which is a very, very significantly higher number. Similarly, you look into, let's say, from CY 20 to CY 25 is now more or less done. This is like due to COVID and all the impact has been there. But since then, clearly, the one thing has changed and which has also dropped market post-COVID is that pretty good, consistent sort of earnings recovery, right? Even large caps has also delivered pretty good mid-teen sort of, earnings growth post-COVID. And if you try to look into in the mid cap, earnings growth again has been far, far higher, than that of large cap. So what again, I am trying to say is that given now company size and scale has gone up multifold, so overall even the risk proportion of it is also sort of coming down with pretty good return ratios as the balance sheets has got delivered. There is a now pretty good, better sort of a predictability of these companies sort of delivering pretty good mid-teen sort of earnings CAGR. And even if you try to look into going forward as well, the earnings expectations are again pretty healthy pretty healthy mid-teen sort of a CAGR. Currently, I mean, last 2-3 quarter now we are in a phase of bit of an earnings downgrade. That's why. But even after that, I mean, if you try to look into next couple of years, I mean, large cap earnings growth is like 12-13% expectation, while mid cap and small cap earnings growth expectations still remains very, very high at around 20% sort of a, I mean, CAGR. Now, let's try to discuss some of the structural, I mean, investment themes where we do see a lot of opportunities and a pretty good sort of earning compounding from the visibility standpoint. One is onto the consumption side of it, more so consumer discretionary. I mean, as we see that India is a very, very young demography with median age 29-30 years of age. So clearly, as the per capita income is sort of seeing a jump up, maybe in line with at least the nominal GDP growth, which is 10% CAGR. Currently, we are at maybe $2,400 as such. But clearly, I mean, if you try to take cues from the Western world, $3,000, I mean, sort of an inflection point, right? We are more or less there. So in that context, I mean, as the per capita income catches up to $3,000, a lot of spending, significant incremental share of wallet clearly goes into the discretionary spending side of it. So many of these businesses, while let's say incremental spending on the food side does not go up that much in line with the higher per capita income, but across many of the other spaces, if you look into on the discretionary side, clothing, footwear, healthcare, transportation, travel, tourism, recreation, education. I mean, I think many of these sectors do clearly see a disproportionate spending over time. And we are clearly sitting at an inflection point in that case from the $3,000 per capita spend point, so which clearly do offer a significantly higher headroom for growth in many of these sectors, which fits into either you can say, let's say, consumer durable, discretionary, retail side of it. I mean, many of these businesses do clearly offer a pretty actually longer runway for growth as such. Second is on the pharmaceutical side of it, and within that also the even more sort of a exciting segment has been the contract research and the manufacturing side of it, which is we do call the CRDMO, contract research and development, I mean manufacturing side of it. One, if you try to look into clearly as the outsourcing sort of increasing, global CRDMO industry is growing at a pretty good pace. I mean, if we try to look into global CRDMO industry is almost $200 billion. Last 5-year growth has been around 9% CAGR. And going forward also, if we try to look into the expectations are that this industry will keep on growing at almost 9% sort of a CAGR to reach almost $300 billion. Within this, if you look into some of these smaller biotech companies, are also, I mean, has actually also seen pretty good sort of a funding time, right? So that's why their R&D spending is also going up. And if you try to look into, let's say, global R&D spend, which is growing at around 7-8% sort of a CAGR. And within that, I mean, these relatively smaller pharma biotech companies are seeing their spending growing at a much faster pace. And that's why their ability to even outsource much more because of the cost advantage goes up. And where really fits in India in a very, very beautiful way that that maybe I will try to show in the subsequent slide. But clearly the message here out is that top-down basis R&D spend is growing at around 7% CAGR. Within that, share of outsourcing is even growing at a faster pace. And because of this Biosecure Act, as well as the Indian CRDMO industry, I mean, growth, if we try to look into the expectation, I mean, it is, as of now, is hardly $7 billion, I mean, dollar. Like, I mean, on a $200 billion global, global spend, I mean, we are at this point in time is hardly having 3% share. And expectation is that this is going to grow at a 15% sort of a CAGR. And also because of, if you try to look into due to Global Biosecure Act, Indian players are seeing even much more sort of inquiry pipeline, and the and actually benefits of that can clearly be reflected in India share going up, because we have got all the right sort of a talent pool available here, clear cost clearly cost advantages being there. So and also there has been a pretty good history around India sort of a pharmaceutical industry as such. So here, I mean, also if you look into the China share, which has gone 10 to 11 odd % is expected to come down because of, you know, again, Biosecure Act. I mean, pretty good China plus one story has to play out here. To capitalize on this, I mean, if you look into the many companies' share of capex has also been going up meaningfully. If you look into, let's say, on a, I mean, 2-year average basis, I mean, if we try to look into the capex number, which used to be around $700-800 million, has now almost gone to 1.3 billion odd dollar per, I mean, per year basis. So, so to that extent, I think this again remains a very, very exciting space which can offer a pretty good mid-teen growth, I mean, growth CAGR going forward. This another theme has been this India electronics manufacturing EMS space, which has been a, I think, very, I mean, very, very high growth sort of a segment, and the Bay government is trying to capitalize on this. One, to reduce the import substitution. Second, try to capitalize onto the export side of it. I think it is building up in a actually very, very good way with pretty right support of the government through PLI as well as the capex rebate, I mean, schemes as such. And here, if we try to look into, the idea is that to increase electronics manufacturing by almost $300 odd billion, including the export, where share of exports has to rise many fold. We have already seen a pretty good success from the mobile, I mean, manufacturing, mobile manufacturing side of it, which has almost seen a production jump of 4x from $30 odd billion to actually $126 odd billion. And this is what, I mean, the government targets are to reach this overall electronic production to almost $300 odd billion. So here, I mean, at this point in time, India again is having a very, very minuscule share out here, 3 to 4 odd % of global CMS, global EMS segment. And which the only advantage earlier used to be the cost side of it, which with government support, I mean, if we try to look into all these schemes put together are giving support to the tune of 7 to 8 odd %, 4 to 6% by way of PLI schemes, and then there are various other schemes. So all of these things put together comes at around 8 odd % versus China. If we try to look into, this has been the cost sort of a disadvantage, right? 7-8 odd %, which is by way of, let's say, raw material, because India is still the entire component ecosystem is not being there. It's still on the RM side. Costing is higher versus the China, but by way of many of these schemes, as size goes up, even component ecosystem developing, I think fitting in very, very good from the, I mean, from the costing point of view. And we have already been seeing, I mean, the actually pretty good success sign of this with actually many of these companies, I mean, growing a very, very faster, I mean, sort of a growth as such. This another theme has been this entire energy transition, which if you look into as the India, I mean, if you look into, let's say, even the manufacturing share of India GDP has to go up. And even a lot more power consumption is coming by way of newer business application, AI, artificial intelligence, data centers and all, right? I mean, overall, the power growth, which has been, let's say, in last decade might have grown at around 4 odd %, 4.5%. The expectation is that this actually has to grow at least 6-7% sort of a CAGR going forward. And within this, clearly, as a result of energy transition, a lot more investment is happening onto the renewable, I mean, renewable side of it. And there, I mean, if we try to look into, clearly, I mean, this gray bar is more like thermal sort of a capacity addition, which expectation is that is going to remain flat, maybe very, very marginal sort of a growth. Clearly because of the decarbonization, I mean, renewable side investments has to go up in a meaningful way. And within that, I mean, if you try to look into solar and then this wind side of it is going to see a much, much faster growth. And we have already been seeing that a lot more investment is happening in this particular space, and not only onto the IPP side, because of higher growth in many of these segments like solar plus wind is almost 17% CAGR from 23 to 30. And as a result of this, even this entire energy transition value chain, we have been seeing a lot more investments happening around here. I mean, if you look into, let's say, on this entire chain manufacturing side, we have been seeing a lot more investment onto the module manufacturing, WTG, which is wind turbine generator manufacturing, then one more step of backward, integration around battery, battery manufacturing. So many of these areas are seeing a significant investments, and and I think with the right sort of a growth profile being in place, at the same time, government again try to putting in to develop domestic ecosystem. They are trying to put in a lot of tariffs to actually reduce, cheaper imports. And as a result of that, they are also in a way making sure that industry, whatever is putting up capacity, they also do keep on earning a decent sort of a ROI on their investments. So if you try to look into, across the value chain, significant investments is happening. These are like some of the numbers which are, which at every value chain, manufacturing side we discussed about, generation developer side, because again, if you try to look into 1 megawatt of solar is like, 5.5 crore sort of an investment. And when we are talking about almost 150 gigawatt newer capacity coming in, you can really see how much investment has to go into this particular energy transition. And then if you look into, because to evacuate all of those generation, lot of investment is happening onto the transmission and distribution, side of it as well. So a lot more companies within this space is also, is actually also getting lot more ordering. And then there are like newer use cases which are like maybe 5, 7, 10, 10 years ahead. Some of those areas are also going to see a lot more investment, maybe green, hydrogen, EV we have already started seeing, built up penetration out there. This another, last theme which I am talking about is on the logistics, logistics side of it. It has been about a scale play onto the improving infrastructure. As we see that, infrastructure, has improved significantly all over the country, right? Not only roads, railways, DFC commissioning, we have been seeing that there has been improved infrastructure. Now, in fact, government is trying to struggle that bear more to add roads, right? That's why if you look into in the budget and all, maybe the total budgetary outlay towards roads, expressway and all is sort of a flat, because they are not even able to now identify any incremental newer projects which can significantly add on to the infrastructure. Because of improving infrastructure, there is enough and more headroom for India logistic cost, which is a very significantly higher number, almost 13% of GDP. Which, almost 13% of GDP, while if you try to compare this with China and all, numbers looks like China cost is higher, but then you have to look into the share of GDP as well, right? Because India manufacturing share is low, despite of that logistics cost as a GDP is higher, while China manufacturing share is far, far higher. Despite of that, logistic cost is almost similar to India, because typically as the manufacturing share goes up in a GDP, clearly the percentage is spent towards the logistics, because you have to move around a lot more things from one place to another. That logistic cost also goes up significantly. But having said that, how the China logistic cost has fallen over time, from 17-18 odd percent, they are right now at around 14-15% of the GDP. India at this point in time, despite of lower manufacturing share in the GDP at around 23-24 odd percent, while government stated target is to increase this, increase this share, that cannot happen without logistic costs sort of coming down, because this remains one of the key aspects from the cost effectiveness standpoint. And with improving infrastructure, we believe that there is a lot more scope out here, because this is also a very, very fragmented sector. And because of fragmentation also, I think the cost inefficiencies, are there in the system. And with improving infrastructure, I think many of the bigger players do offer do have enough sort of a headroom to really take benefit of this and try to bring in cost advantage and keep on gaining market share in a significant way. These are like, again, various other sort of parameters where actually India do scores versus others. So yes, we are like, stack out decently well. It is not like it is very, very inefficient, but having said that, because of improving infra, on many of the counts, there is a significant headroom to actually, improve on to this particular aspects as such. And with this Western, dedicated freight corridor sort of getting commissioned maybe in another year's time, clearly rail coefficient is going to go up. And as we know that rail freight cost, percentage cost is clearly lower than the road freight. So to that extent, I think with the rail coefficient going up and all, there could be a significant cost savings out there, and many of these companies, many of the companies in this particular segment can see a significant benefit as such. Within logistics, another subsegment is around e-commerce side of it, where again, very strong, longer sort of a runway for growth. Here, if we look into, China, again, trying to compare with the China is that they are spending around $1,200 billion onto the e-commerce side of it. This, if you try to compare, versus the India, the share is, share is very, very low. Penetration-wise, we are maybe 7-8%. From the e-commerce penetration standpoint versus China is almost 3x of that. So as again, I think the shopping behavior and the spending pattern goes more towards the online side of it. There will again be a significant growth around this entire e-commerce logistics side as well. So very, very long pathway for growth out here. So I think these are like broadly 4 to 5 themes I have tried to discuss. A lot more companies within this particular space are actually part of the maybe mid-cap universe far more, and actually looks very, very exciting from the medium-term standpoint. Yeah, thanks. That's it from my side. Maybe we can take questions maybe after the next speaker or whenever convenient. Yeah, thank you.
Thank you, Mr. Jain, for such an insightful presentation. I would now like to welcome Mr. Pawan Agrawal to honor Mr. Jain for sharing his expertise with us. Sir. Thank you, sir. India's evolving consumption landscape presents a compelling investment theme driven by rising income, shifting consumer preference, and rapidly growing middle class. Understanding this trend is key to identifying high growth opportunities. To shed light on this, we have Mr. Amit Sinha, Fund Manager, Equity at HDFC Asset Management Company, with 19 years of experience in equity research and fund management. Having worked with Macquarie Capital and now HDFC AMC, his deep insights into India's consumption story and investment potential are invaluable. Let's welcome Mr. Amit Sinha to the stage. Thank you, Mr. Sinha, for your valuable presentation. I would now like to invite Mr. Kamal Kumar to honor Mr. Sinha for his time and expertise. Mr. Kamal Kumar. He's coming.
Yeah.
So over there. Thank you, sir. I would like to invite Mr. Sunil Dwivedi to felicitate Mr. Kamal Kumar, who is our investor. Sir, please be there. Yeah. So please wait. You have to felicitate one person.
Okay.
Yeah, just wait. आप रुकिए ना, अंकुर दलाल को बुलाओ कोई तो। I would like to invite Mr. Sunil Dwivedi to felicitate Mr. Ankur Tayal, who is our client who has come all the way from Muzaffarnagar. So over there, in the center. Thank you, sir. Now I would like to hand over the mic to Miss Shrishti Sangal.
Thank you, Ria. Moving forward, this journey would not been easy without constant support of our vendors and Wealthy Nivesh team, who are our backbone in each and every milestone that we accomplish every day. Now, I would like to call on stage Mr. Sushant Singh to felicitate Mr. Ankit Tayal from Tech Enhance. sir. Now, I would like to call upon stage Namrata Ratnani, our Senior Operations Manager, to come and receive this token of love. Namrata has also completed her 2 years with us today.
So I want to make a special mention for Namrata. So Namrata, I never told you this thing, but when Namrata joined us, we were passing through crisis mode in operations side. And for last 2 years, we never had any crisis in operations, all thanks to Namrata. There are many clients over here who would be more comfortable talking to Namrata than me or Aditya. Thank you, Namrata. So as Namrata completes 2 years with us, we are promoting Namrata today to Senior Operations Manager. Thank you, Namrata. Thanks for all your help. Next. Now I will like to invite Florence. So the part of India that I come from, Western UP, over there is one कहावत कि लड़की ने अकेले टांग पे खड़े होकर पूरा काम करवाया, and that's what Florence has done for this event. Everything and anything was done by Florence only for this event. Thank you, Florence. So Florence joined us a year back, and recently we promoted her to Senior Wealth Manager. So we have a plaque in for completion of 1 year as well for Florence. Next, we have Utsav. Utsav again joined us a year back. He has completed 1 year recently. And Utsav is our analyst, senior analyst, and somebody who is very meticulous with numbers and markets. किसे बुलाना है? नहीं, उसके लिए सब इनसे करवाना है या किसी और से भी करवाना है? Thank you, Sushant sir, for traveling all the way for the event. Thank you, भैया.
Usually ऐसे इवेंट्स में आने के मैं पैसे लेता हूँ. यहाँ पे उल्टा है. मैंने इन्हें पैसे दिए हुए हैं, इसलिए आना पड़ गया.
So thank you for trusting us with your money. Yeah. So next, I would like to invite our beloved Mamaji and our client as well, Mr. Krishna Mohan Atri. Next, we have got Pranjul from our team. So Pranjul is again one of those resources जिनसे client हमसे भी ज़्यादा बात करते हैं. Pranjul handles operations with us. Pranjul also completed 1 year with us recently. Next, we have got Sonal with us. Sonal is one of our giant killers. Sonal has recently acquired CEO of one of the biggest commodities companies in the world by herself. So all kudos to Sonal. And for facilitating Sonal, I'd like to invite Mr. Nikhil Kapadia, one of our earliest clients. अंकल आंटी कहाँ है? हाँ, तो एक तो अंकल आंटी को, एक मम्मी को. अरे सर को रोको ना, उन्हें रोको. So So a lot of you must have across a lot of social media content from our side. So next I'd like to invite Zaki, who handles social media for us. And for felicitating Zaki, I would like to invite Gupta uncle to do the honors. Okay, madam. So next we have got Ria with us. Ria joined us from Valikar campus. She's again a very senior resource, and within 6-7 months she has proven her mettle, and we get very good reviews about Ria from our clientele. For felicitating her, I'd like to invite Konika. So Konika is triple friend for us. So our kids are friends. Me and her husband is friend, and certainly Konika and Srishti are also good friends. So next we'll invite Samarth Choksi, who is our technology head, our chief technology officer. Samarth has joined us from BITS Pilani. And a lot of technology work that you can see over here for the event also was done by Samarth only. For felicitating Samarth, I'd like to invite Mr. Nareshan, who is our senior from IIT Roorkee, and who has been my client for more than a decade now. So one of the items that we have put in our return gift is our monthly flip book. So I'd like to invite Shrihan, who has made a monthly flip book for us. And for felicitating him, I'd like to invite my mother. Acha, niche. So there was a time when I used to be the senior most banker in Wealthy Nivesh, but now I have got somebody who has got even more experience in banking, that is Siddesh. So Siddesh has joined us from HDFC Bank. He has worked across ICICI Bank, Yes Bank and HDFC Bank last. And he has also got experience in African markets. So welcome Siddesh. And for felicitating Siddesh, I'd like to invite Shankar sir. Shankar sir is ex-MD of BSc and a very esteemed alumni member from IIT Mumbai. Now, it was demanded by Mallika that she should be felicitated by Sushant sir only. So I'll have to invite Sushant sir again. So Mallika has recently joined us, and so typically in a wealth manager's journey, when they join, they get all those clients who are inactive. And Mallika has done phenomenal work on that set of clients, all because of her persistence. Great work, Mallika. Yeah. हाँ हाँ आप रुको ना एक मिनट. So next we have got Arushi. Arushi has recently joined us from ICFI Business School, and she is doing phenomenal. So all the VAS agreements that I have shown you during the slide, Arushi has worked on them very diligently, and she has got many tie-ups for us. So next we have got Hitanshi. Hitanshi has joined with Arushi and doing phenomenal work on client activation and client engagement. Thank you, Sushant sir. So next, so one of the highlights of today's event was India's story. So I got the most compliments on India's story only, and the girl who made the PPT was Jinal. So next in line is Jinal. So I should really appreciate her for bearing up with me. I kept on giving her more and more improvements, and she kept on still doing them. Great work. And for facilitating Jinal, I'd like to invite Gupta auntie. महाभारत में जब कौरवों और पांडवों के बीच में बट रहा था कि किससे कौन सी सेना में क्या मिलेगा क्या नहीं, तब पांडवों ने कहा था कि हमें श्री कृष्ण चाहिए सारथी के रूप में. तो सारथी इज समबडी हु शोज यू डायरेक्शन एंड टेक्स यू टू प्लेसेस. तो आई विल नेक्स्ट लाइक टू इनवाइट विक्रम फ्रॉम आवर टीम, फ्रॉम वेल्दी निवेश टीम, हु इज आवर सारथी. विक्रम, प्लीज कम. And for felicitating Vikram, I'd like to invite CL Arora sir, who is our esteemed senior from IIT Roorkee. नहीं वो आपको देंगे. तो एज पार्ट ऑफ वेल्दी निवेश जर्नी मेरा लेट घर पे बहुत ज़्यादा आना होता है, और मुझे दो ही लोगों से डर लगता है, विक्रम से और सिम्मी से. बट दोनों ही कभी मुझे नहीं टोकते कि आप इतना लेट क्यों जा रहे हो घर. डन. सो थैंक यू एवरीबडी, थैंक्स फॉर कमिंग. इट वाज रियली. लिख कर आओ. So next we have got our latest recruit, Anjali. Anjali has joined us recently only, and for felicitating her, I'd like to invite to Mr. Sachin Shingare. So as part of one of the formality, I am supposed to give a vote of thanks, which has got 3-4 paragraphs, but I'll say what I feel from deep within only. For last 1 month, the whole team has been working on this event. But as happens with any event, the biggest challenge is always to get as many participants as possible. And we are very thankful to everybody who has come from as far as Muzaffarnagar, Delhi, Bangalore for this event. That shows that beyond professional terms also, people love us. That's our biggest asset. And certainly I won't like to thank the team because they are the host of the event, so they don't deserve thanks. They deserve appreciation from all of you. So if you can just give a So I have no shame in accepting that against the industry culture of hiring experienced people only, we typically hire from campuses only, from freshers only. And one of the reasons certainly is not affordability, but reason is that we want to build a culture with wealthy Nivesh, and we believe that when we hire fresher people, we can mold them in that culture. One of the gifts that we give to our client is a book, No Rules Rules, which is by Netflix CEO. And a very big validation came by reading that book, because when I read that book, I realized that there are many things that we have been already implementing. I hope that culture continues with us. So to cite you some examples against typical corporate bureaucracy of giving bills for reimbursement, then applying for leaves, then leave policy, etc., we have got very discretionary. We never ask our employees for bills for any reimbursement. There is an Excel which is floated to them. They put in money and they are reimbursed without asking any question at all. So that's the kind of culture we are building. And I hope that's the culture that's got passed on to clients as well. Now coming to Wealthy Nivesh journey, again, I gave you how we have grown in last 2 years. And this is again from the depth of my heart. When people appreciate us for all the progress that we have made, I always mention that the biggest component is that some people trusted us when we were zero with their lifelong savings. For me, wealth management has always mattered that people's lifelong savings are being trusted by us. They trust us by parking their lifelong savings with us. And the bigger responsibility comes when I was working for one of the biggest institutes in India. I had a brand value. But when we started this firm and we went to people, there were people who trusted us that these are young kids, I hope I can afford to call myself a kid. But they trusted us, and that only made our work even more difficult, because then we need to ensure that we work best to our capabilities. So thank you to everybody who has trusted us. Thank you for coming over here from places like Pune, Muzaffarnagar and Bangalore. And we look forward to working to best of our capabilities. Thanks again. So now we can break for the tea. We have got tea and refreshments, and we can have networking, and then we can carry on our discussions by the side. Thank you. Thanks once again.